Yo, what's good? How are y'all doing? I swear I didn't even press I was live yet. I was gonna give it a second, but I want to actually go in here and I actually kind of want to backtest an actual model, and the model that I kind of want to backtest is I've been seeing this, and it's kind of finally gonna be able to. I'm finally going in there and gonna backtest the model. And when I say backtest, whenever I backtest, you don't know already. I'm pretty much just going over there and just seeing what happened throughout the day. Like I'm not going in there to try and take trades. I'm going in there, going into that chart like I was actually in it, and then I'm annotating my thoughts on that chart. So, give me 1 second. I'm gonna create a journal tab for this. It's pretty much looking for a liquidity sweep and high resistance signature. Which, whenever I say high resistance signature, I'm pretty much saying where price should not go at all. So basically, if we take um, buy side, major buy side, then we take minor buy side, and we have an SMT, like that would be a version of a high resistance signature. So as you can see on this day right here, this is a random date. This is like 2011. We're well above midnight open, so we'd be looking for only shorts. But as we can see, the underlying order flow is kind of bullish. We have dropped down here to this order block, and it looks like we could expand to these highs, but we're kind of rejecting that a little bit. ES, pretty much the same thing. And we're just gonna backtest this and yeah, see what takes us. It's pretty much looking for a high resistance signature and then just any fair value gap, pretty much. Kind of like a 2022 model. All right, so 9:30 happened. We've swept buy side. I could have been a short, but that was 9:30. 9:30 pretty much opened. We're gonna give it some time. We're now above midnight. Let's see. We have a fair value gap SMT here, where NQ is traded back down to a fair value gap. ES is not. See, in this case, there's nothing yet. Buy side liquidity. Do we have SMT here? Wow, bro. I'm not. These charts are spotty. I'm not gonna lie. I'm just gonna pull up ES over here. I think that'll be easiest. I want to show me midnight open over here. We're still above that midnight open. That could have been a short. Hold up. I don't like I don't like looking at spotty price sections. Let's go to a different day. Let's go to like 2019 when the markets are a little bit better, you know? Like it's crazy how far we've come to seeing like efficient market conditions, and like going back to data that is a little bit spotty is like wow. Let's do 2019. Let's do March 20. All right, now we've officially started. Yes, it's a little bit better. So let's just get a underlying feel for what the market's doing right now. So currently, bullish IOF. We've just had a pretty fast adjustment here. We've taken sell side. Looks like we want to draw to all-time highs. It's a Tuesday. Yeah, we're just gonna go throughout the day and see when it occurred. Okay, this is FOMC. I'm just gonna use TradingView. I think TradingView I like TradingView for backtesting, and then just using contract codes. Yeah. I can never decide which one to do, but it's been decided now. Let's go to NQH 2019. And we're just gonna see like when it happened, when it formed. But pretty much just looking for a high resistance signature at or near, and only longs above market or true day at or near true day, and only shorts below or near true day. So here we just have expansion. We just have expansion. We never get offered a long. We just expand off of 830, and therefore classic buy day with manipulation in London. So pretty much times when you won't get a setup is when there's gonna be a classic buy day or sell day. You don't have time to trade. I mean, you could always yeah, that might be cooked. That might be cooked. So right here we have buy side liquidity that we sweep. Oh, this is NFP. New day opening gap. $9.30 opens. We never come into that fair value gap. Here we have a inversion. Look how well that gets respected. Then we head up to buy side. Buy side taken. Market structure shift. Fair value gap. Write that down. Where's true day open? We're still above it. We're still below it. $9.30 opens within a new week opening gap. Manipulation has occurred around 8:30. and then boom, expansion lower, imbalance right here. Fair value gap never gets traded into. And then we have another sell model in the PM. What a day right there. What a day. Buy side swept, new week opening gap above true day. We have fair value gap we originally respect. Market structure shift. Fair value gap right here. We're just trading back up in the fair value gap. During a macro, we can trust this. We still have low resistance liquidity. We've just swapped minor sell side. Come up, imbalance. And then we sell off to a new week opening gap. Pretty nice right there. Right here below true date, market opens. We initially push out, take buy side. True days at that new day opening gap. There's not really anything there. We're above true day, so we're looking for shorts. Then we get below it. We put a low in. Sell side liquidity rated. Imbalance here. But we get a market structure shift. Now we have an imbalance. That's your 2022. Kind of a big imbalance here. Come down, new day opening gap. Stop at this low. Above true day. Market opens here. Buy side. And we've taken this level of buy side. So that would be a high resistance signature. We might have SMT here. Pull back, imbalance, fair value gap. There's not really, this fair value gap could work as well. Put your stop at that high. And then looking for these lows and a new week opening gap. Because this is just a minor sweep of sell side. Just a minor. She's just a minor. Here. Buy side swept. So we have a liquidity rate here. High resistance signature. Breakdown. Market structure shift. We're waiting for that fair value gap. We're stalking it. I guess it's just the 2022 model. Imbalance right there. That's after sell side's taken, but we can still trust this. Write it down to new day opening gap. That's your partial. New week opening gap. Look at constant encroachment of that. That's beautiful. That's beautiful. $9:30 opens. Push up above true day. New week opening gap. New day opening gap perfectly. Now we're waiting for a fair value gap. We never really get one. We have a volume imbalance though. Which that is really me month. I don't know if I would ever really, at least for me now, I don't think I would ever enter on a volume imbalance. But right there, your volume imbalance. And whenever volume imbalances support price or resist price, that's pretty telling to what price wants to do. Here we establish a failure swing. Then we have an imbalance we draw back into again and again. New week open gap, constant encroachment. Come up, new day opening gap. That we reaccumulate within. Also within this inversion as well. Within this fair value gap right here. We don't have this high though. We don't. That would have been nice to see, but we don't. Up to new day opening gap, up to these stacked highs. This is happening at true day. look at where we come to the tick. We end up selling off. So right now we're in a deep discount. We just had a big sell off. Probably swept some type of lows. Then we have another rate of sell side. Change state delivery. Just looking for a fair value gap. Right here we have a big imbalance. We might have a higher time frame for value gap, such as like a 4-minute there. I want to go this whole week. I just want to what's this weekly profile? Bro, my nose is still bugging. It's gotta be someone at my desk. So this is I would say Wednesday low of week, or kind of like a Wednesday reversal here. Monday we put initial high a week. We have a reversal here. About this week, Monday, Tuesday. Don't really have any manipulation here. High. Thursday reversal. Friday come back into Thursday range. This kind of is a profile that we just had this past week, where we kind of just consolidate, or we don't really have any true manipulation Monday, Tuesday, Wednesday. Thursday we end up having a big reversal, and then Friday we trade back into Thursday's range. Monday, dude, I almost got that fly. Wednesday, reversal. Wednesday, weekly reversal. Thursday, retracement. Friday, trades back into the weekly range. Monday, Tuesday, we put in low of the week within new day opening gap. Thursday, caps the weekly range. Friday, we just consolidate. Monday, no manipulation at all. Just accumulation there. Tuesday, we get displacement lower. Wednesday, we get another drop lower to have a Wednesday low of the week. Thursday, accumulation. Friday, come back up into that new week opening gap. Here's the current new week opening gap. We drop Monday, low week, Tuesday expansion, Wednesday retracement into new week opening gap, and then we have expansion. That's nice, bro. Look at that. True support and resistance. Monday, manipulation. Tuesday, no, Monday's right here. Monday, expansion. Tuesday, retracement. Wednesday, trade back inside that range. Let's look at the intraday action here on the 5-minute real quick. Sell side taken below true day. Come back to that imbalance. Then we create a buy model out of that. Fair value gap in, fair value gap out. Look at new day opening gap, constant encroachment. Look at the bodies. The bodies are telling the story. Wednesday. Oh my god, dude! New week opening gaps are just truly getting respected here. Oh, to the tick. Right here. Sell side liquidity. Market structure shift. Market structure shift right there on the 2-minute. There's your shift. Fair value gap in, fair value gap out right there. Boom. from here to here, how much percent is that? Okay, that's 25 points back when we were at 6,000. So now that would be like 40 points. That would be like 50 points. The inflation is crazy. The inflation on NQ is crazy. Absolutely. Absolutely not really is. 10 a.m. We open up in a premium. We're above Monday's high. This is Tuesday. Then you get fair value gap in, fair value gap out. But you're taking buy side here. Displacement. All the way back down to a. It's taking the sell side. And then we enter a buy program. There's got to be a 2 minute. Well, I mean, there's a 5 minute fair value gap right there. Yeah, pull back to this order block here. Let's see. I kind of want to make it. Oh, look at that. It's gorgeous. Look at the bodies of those candles. Then we see buy side. You see this imbalance first for an upside draw. Then we come back down. We accumulate more longs up to another imbalance here. That's nice. Accumulation around market open, displacement, new day opening gap, expansion. All right. I always I never stay focused. I'm always going from one thing to the next. But I do want to go over the 2023. I think I should just stick with that for now, honestly. Just keep on backtesting the 2023 year with ICT's tweets and also while using that content for reference. I think that's the best. I gotta find that archive someone sent into my Discord. That thing has got some sauce. You can literally see every single one of his tweets. Alright, I gotta see where I left off. /19.
Where you are. And if you've been there
I swear I had 2023 tabs open. NQ8 or NQ. We now created a swing high here on the daily chart. It's a Wednesday.
Into London.
Yeah. I've watched that. Thursday we just get consolidation. Get initial push up at market open, displacement for value gap. You write that down to new week opening gap. Yo, what's good? We're here for sure, for sure. Oh, yeah. Okay, so I've already gone over this day. So we reprice. Wait, is that? I don't know what day this is. This is definitely not the right day. All right, so here's Thursday the 19th. So 9:30 we open up. We're rebalancing this inefficiency. The bodies, they're holding that. What are the wicks going to? Wicks looks like they're going to a. Not even like a new week opening gap though. So we get a Judas swing higher initially in the AM session. Buy side taken. Fair value gap in. Fair value gap out signature. This imbalance holds after a market structure shift. So market structure shift, pull back imbalance. Where are we at in relationships to true date? Okay, so we're in a deep discount here. Buy side taken. Do we form an SMT at all? Oh, this is beautiful. Buy side, rest above here. We have a change state delivery on the 5 minute. SysDE. Imbalance with new day opening gap right there. Also have a mitigation block right there. Here's the breaker, the 5 minute breaker. Oh, look at the bodies respecting the 5 minute breaker. Then we have another fair value gap here. Well, it's constant encroachment this high or this wick. Lowest entry, equilibrium, we consolidate. We almost use that as support. And then we see our silver bullet. So it's like a lunch buy model. Lunch MMXM in play. Do we have an SMT at all at these lows? Does not look like we do. Look at that order block perfectly getting repriced too. With the mitigation here, we don't have as strong as a breaker on ES. We don't. But we still come up to take buy side there. So we form high resistance. Buy side taken once. We have a 3 drive. 3 drive. 3 drive. What higher time frame PD array are we reversing from? We have sell side taken there. You don't really. Yo, what's good, Luca? 3 drives lower. Oh, that's just beautiful. Reaccumulation. Where's the draw on liquidity? Sell side taken. Market structure shift. After a 3 drive, pullback, imbalance here. We come up, we reprice to this order block. Last up close candle. Then we retrace, we reaccumulate here. We've got to have some form of like little SMT here between the two. Look here, 1208, 1208 low. Do we take 1208 low? No, we don't. SMT, smart money's accumulating Nasdaq here. And then we get displacement again, another displacement leg. Where's price pull back to? This imbalance. Also, what's that new day opening gap? New day opening gap pretty much was getting respected. Two-minute gap. I don't know what this is. I don't know what I put that on for. And then we also have this mitigation right here. This is all happening below equilibrium. And below true day open. True day open. So I think this is the best setup. Better setup. There'll be another area of mitigation here. Imbalance there on the 5-minute. Imbalance there. Come out to take buy side. You just posted some screenshots. I'll take a look. I don't know. I would say yeah, keep it up. I don't like to use OTE. That's me. I don't even like to refer to OTE at all. That's just me. 17 on the verge of profitability is cool to see someone else my age trying to figure out the markets. Best of luck. Hey, appreciate it, bro. You too. Best of luck to you. The youngins out here are gonna get it. I really think that like all of us as traders that are younger have so much more of a benefit over like anyone that's in their 30s, anyone that's in their 40s. Because like not only do we understand social media to where we can like use that for our benefit and like be able to learn and gain knowledge from that, but also we like I have so much more time than someone that has like a whole desk job. We almost hit -1. That's like pretty close to that. How about this fulcrum point? -2, -2.5 will get respected. Oh, it's like some oatmeal, bro. Some cinnamon oatmeal. My nose is absolutely torched. Yesterday, sorry. My annotating ain't as depth as yours because I'm in it quick. You can see it on your own charts too. That made no sense. You can see it on your own charts too. Well, no shit. No shit, Luca. Oh no, this is morning for me. I just woke up. Very nice buy model there. And we come back. Where do we close at? Close at a random level. Where you from? I'm from Colorado. I'm from Colorado. It's like 12:30 a.m. I don't know. I went to bed at like 7. I went to bed at like 7. I guess I took a nap, bro. Recently, what I've been doing is I've been just taking a nap for like taking like 4 or 5 hour naps at once. That's what ICT does. But I'm not riding his meat that hard to where I have to do whatever he does, you know. That's crazy. I'm my own person. Friday, we just get expansion here. We close that day right within the new week opening gap. You ever thought of demo trading seriously to feel losses even though they're not real? They help me visualize taking losses and becoming numb to them while I improve on only taking my setups only. You ever thought of demo trading seriously? Yeah, I have. Currently, I don't even demo trade because I don't have a model. Like, I would say the model that I look to incorporate is a market maker buy and sell model because that's how the markets move. It's just a way to internalize price, but I don't have a specific entry model to stick to. Like, am I going to enter on the first stage of accumulation? Am I going to enter on a fair value gap? Am I going to enter on a order block? So, like, anytime I would trade, my entry would kind of change every single day. And I feel like I wasn't making consistent progress. So I was like, bro, let's just take a step back and let's just demo trade. Or let's just not even trade. Let's just retape. And honestly, I think it's just a lot better for me, at least. Like, just having your draw on liquidity and just saying, hey, this is where my draw on liquidity is, and then let's see what price does. And then just reading what price does and not necessarily trying to enter. It looks like we have SMT here with the 510 low. We take a 625 low, do we? Shallow. We don't have any news. Dude, I'm trying to have zero emotion. That's why like, how I view it is I'd rather desensitize myself, like, as much as I can right now. And, like, while I'm still in that learning phase, because, I mean, it would make sense. Why would I try to force things in a learning stage when I know I'm not there? Like, I'm accepting the fact that, like, I'm not gonna be as good as everyone else right now. Oh, look at that daily mitigation that we retrace back to. Do we have that on NQ? The daily mitigation block or order block? I always just call it a mitigation block. Always. We do have an SMT here, though. This is a classic buy day. What is this level? Oh, that level's nice on the 15-minute. Yeah, I would say the only roadblock for me right now is just having a model and just sticking to that. But like, I'm not in a rush to try and get there right now. Here we have a manipulation fair value gap. I do think the 2022 model is kind of where I should start. Draw right back into that inversion. How many times do we like reaccumulate within a new day opening gap? I feel like I always have it. -4 hits. -12, we kind of get a run on stops here. And then just a repricing higher. Buy side liquidity that rests there. Oh, that's not even close to the right day. I'm just gonna mark this imbalance here. I mean, equilibrium of that price leg could also be a draw on liquidity. Do we form SMT at all? Even here. Oh my, look at the delivery. Perfect delivery. Reaccumulation zone as well. Very nice buy model there. This is the 19th. I'm gonna go to the Twitter. Oh, this is the 20th. So we had SMT at those lows. So what do we have here? Sell side liquidity purged. Displacement higher. Fair value gap created. No fair value gap within here. Then we kind of have invert balanced price range there. 930 drops lower. Takes this low resistance liquidity. Reprice higher. Imbalance. Then we displace again here, forming an order block. These three down post candles with that fair value gap. And now we're seeking buy side. So there's a 1 minute fair value gap within here. So we have a Judah swing, sell side taken, new day opening gap gets respected. We've already had SMT, classic buy day. Let me see expansion. Where's true day open? Oh, right below true day open. Notice that. The Judah swing offers smart money. Area of accumulation. Oh, that's gorgeous. That's nice. I'm gonna take off the 1034. Seek buy side. He favors this fair value gap. Oh, it's a 15 minute. So none of this is really. I guess we have imbalances down here, but that's in too far of a discount. Also overlaps with this. This would be a balanced price range. Should not need to head back down there. Therefore, this fair value gap is going to be a. Oh yeah. I was watching this video. We don't have any red folder news. No red folder news Monday. Price doesn't really manipulate. Let's see. Do we have an SMT between the two? I mean, there's not really a manipulation that takes place. We got to be within a new day opening gap. Yeah, that's why. So once we displace above that, we don't really want to manipulate. Where's true day? We don't manipulate below true day at all. So market opens within the. Oh, look at this delivery. Look at that fair value gap delivery. Then we come back down, new week opening gap within a balance, and then we zoom up to buy side. And then what does this create? This creates a dealing range right here, from high to low. Come back down, we reclaim this imbalance, Market opens, and then we send price higher within that new week opening gap. I guess stops are already taken. Five-minute BISI is reclaim. And there's a lot of tweets on this day. So we have an imbalance within that breaker. What do you see? What's the sell model here? Probably 5 handles. That's my alarm. All right, so that's the day. I wish I had 1 minute data right now. There really isn't any other valid entry. ES wasn't a lot weaker. Go to a MMXM model and draw a box on the top and tell me what you see. What do you mean? What do you mean, like a full on market maker sell like this? This is a sell model here. All right, that's really all for this day. Honestly, there wasn't really much opportunity to add. You kind of had this one on the 5 minute. That's how it's gonna be. We have a drop here and we have a lunch. Buy program, kind of sloppy though. We have S&T at these lows. Nasdaq fails to take them. Then we reprice lower to a new week opening gap here. It doesn't show up on NQ. Here we kind of have a 5 minute entry here. This becomes a breakaway gap. New day opening gap. Draws price lower to a new week opening gap. Mark off that high, then go to the last high before the place. You saying this? Drag. Is that what you're talking about? Will you do forward? I honestly do not have an answer to that. I don't really have an answer to that. You know, drag to the recent high. This? Like that? Stay on the market maker sell model. Yeah, I don't have like a good answer for when I'll be forward testing. Well, I kind of do. I've just been tape reading, and like in a sense, I guess I am kind of forward testing, but it's a little bit different. Like if you watch them, I'm more so testing my draw and liquidity. That's pretty much what I'm doing when market's open. All right, you want me to stay on this model? I'll give you one more minute. Are you trying to show me something? You're saying head and shoulders? Oh, you're showing me your strategy? You take a break out of that? Got you. Look how more explosive NQ was there. And then we kind of just consolidate. And then we expand from new week opening gap. Market opens. SMT at lows. We still have an SMT. Oh, this is Tuesday. I thought it was Monday. We had 9:45 news. Market opens with SMT. Where's the low resistance liquidity? At market open. SMT at the lows. We expand at market open. We have an order block right there. Then we have a small imbalance. Very small imbalance. We have a little imbalance here. We flood up to buy side. Do you check crypto as well? Not really. I'm not so much into crypto. Then we come back down. This SMT holds. We then end up having fair value gap in, fair value gap out, balanced price range. $104. Look at this on ES. Sell side taken. Notice how the balanced price range. You have a nice order block here.
And in the upper left-hand corner, this one up here, that's the hourly chart. And the lower left is the 15-minute time frame. And the larger chart to the right is the 1-minute chart. All the same market, just different time frames. All right, so if you're not following me on Twitter, you're probably not going to appreciate as much as those individuals that watched the outline this morning. It was really short, but I'll give you the context as to why I was drawing everyone's attention to the buy-side liquidity and what we may or may not see going forward for the rest of the day. So the topic I want to talk about is conquering fear of being wrong versus the focus being on profitability. So if you're starting with me or in trading in general, it's easy to get inundated with the fear. And I promise.
February 24th.
So the topic I want to talk about is conquering fear of being wrong versus the focus being on profitability. So if you're starting with me or in trading in general, it's easy to get inundated with the fear. And I promise it won't be a long, drawn-out, boring session, so I'm going to take you into the charts. But I kind of want to build a foundation here as to why I'm going to be talking about this topic and why it's something that it's important for you to tackle early on. But it's also something for you to minimize as a concern. In the beginning, when you first start learning how to trade, and you're watching these charts and it looks like a foreign language you've never learned before. Pressuring yourself to try to find correct entries, correct stop placements, targets, which time frame, which market should you be following, what approach or model or technique are you going to employ. Those are all normal things for a new student or trader to be concerned about. But the most significant factor in a developing student's mindset is conquering the fear of being right or wrong, and more specifically, the fear of getting it wrong. There's nothing wrong with doing it incorrectly, but there is a lot of things wrong with doing it incorrectly, recklessly, with over leveraging, over trading, and just gambling. So there's a lot of things that I teach in price action that are repetitive in nature. They tend to repeat when conditions are prone to produce the outcome that we're looking for. Now, there are times when even myself, I'll go in and I'll expect a certain price delivery, something to bring in a certain response in price action. And I try to align myself with that mindset through the charts, through my teachings, so that way my students that are following me on Twitter are alerted to where I'm thinking the market's going to go to next. Now, don't do it yet, because the tweets are already there. I can't change them. I can't edit them. Okay, you can see the responses from people that were watching it then as well. I don't delete any tweet. Sometimes I'll do a typo. I may or may not catch it, but whatever tweet I put out, it stays. So you can grade my consistency based on all that, as well as the precision. So when we're looking at being correct or trying to avoid being incorrect, what we're placing on ourselves is an unrealistic expectation, because nobody is perfect. I'm not perfect. I do get it wrong. Sometimes I mistrade. Sometimes I enter a trade and it will hit my stop loss and I never get a profit out of it at all. And there's nothing wrong with that. It doesn't mean that the model that I employ or the concepts that I use and create, they fail in my use because I'm the operator, not the concepts themselves. I've misinterpreted price. So there's a great deal of responsibility that is placed on me as the analyst slash trader, while I'm trying to keep the gambler that's in all of us at bay, trying to preserve equity and keeping the hands of the gambler out of the equation. So when we look at charts, and what I'm lending you in my experience is, by being on Twitter, I point to levels that I think are the next draw on liquidity. I think that providing that tool, that resource, allows my students to at least engage, and this is my opinion now, okay, it doesn't mean I'm correct, but my opinion, my thought process is, if I've been doing this for 30 years, I think it's reasonable to assume that I would have a better understanding where price is going to go than that of a new student or a new startup or someone that's casually just viewing my tweets or my content. Can I show before the fact where the market's likely to go to next and what narrative behind that exists? So if we're looking for repetitive patterns or delivery and price that should be consistent, doesn't mean it's going to be 100%. It just means that over a long sample size. What's a long sample size? Well, it's relative to whatever you think is reasonable. I think reasonable is a year. 1 year of consistently being able to see the market real time, call it beforehand, tape reading, practicing. Then I think, in my opinion, and you may well, I disagree with this, but after a full calendar year where you see all of the seasonal factors that come into the marketplace, all the seasonal tendencies, the geopolitical tug of war things that create, well, reverberations through the marketplace, because those shock waves will be seen in these candlesticks. So having a full year behind you allows you to have the confidence that you've seen enough to know that this is worth pursuing. While I'm talking about this, I'm watching the 4032 level. There's buy side up there. So as I'm talking to you, I'm just thinking out loud. It doesn't mean I'm taking a trade. I'm already done for today, and I'll show you why I did what I did, and we'll go over that. But I want you to think about how learning from a book, okay, learning from a course, learning from static texts that come in a PDF format, okay, they all have their place in our learning. They all have a certain measure of value. But seeing something demonstrated repeatedly over and over again, week after week, day after day, taking your focus into a specific location and price action, and then watching that price deliver real time from an alert that comes through a tweet that says, note this on your chart. This morning I noted in a tweet, I said 4028, note that level, that's your buy side liquidity. The reason why I sent that tweet out was I was watching price in here. You see how it's relatively equal here? Now, retail traders, and I apologize, you're going to hear one of my boxers, Bella, she's barking, she's trying to get my attention because she knows I'm upstairs in the office. This area here, it looks like resistance to retail traders. So whenever the market looks smooth like this, I have an expression I like to use all the time. Smooth edges like to be made jagged in the marketplace. Much in the same vein, you see these relative equal lows. The market goes through them multiple times and then reacts. This level, in response to this shaded area, I'll cover that also, because I mentioned that in a tweet before the fact too. But I want you to think about how the things I'm showing in my tweets and in my recordings and my executions, because you're seeing one right here, it's based on things that repeat over and over again algorithmically in price. So when I'm looking at price and when I'm trying to teach you as my students, I'm not trying to put your mind into the framework of looking for pattern's sake, which is equivalent to what indicator traders do. And allow me the liberty to say that without feeling like I'm beating anybody over the head, because I know there's traders out there that use indicators and they're profitable. But I want you to just take a step back and think for a moment. If you're using, by contrast, I want you to think about what I'm teaching and what other traders do with indicators. If you look at an indicator and you're measuring the bullishness or bearishness of a particular market on a specific time frame using any indicator, it could be stochastic, it could be RSI, CCI, MACD, you name it, whatever it is, you're attributing a religious belief that that indicator in its compression and manipulation of data, which is the open, high, low, and close that's already happened. That's all these indicators do. They number crunch. They take something that's already happened, which is what you've already seen here in this chart. These candles are representative of the raw data that the indicators use to compress and crunch and spit out some kind of overbought, oversold, or continuation or something to that effect. And when I first started as a trader, it was important for me to figure out what indicator I should be using. And over time, I learned that it's not all that important, because I got caught up in, I just want to take a quick look at NASDAQ. The indicators are not the secret. Not when I first started, I thought that it was. And I had a lot of indicators on my chart, lots of them. And it became a pursuit of finding the pattern in indicators. So one can argue, and this is my argument here, that if you're looking at indicators, you're no different than someone that looks at just a classic chart pattern. You're looking for the pattern of price delivering on the heels of something you've attributed to with a religious belief. And there's a lot of atheists in this marketplace that are still religious because they have their faith based on something that may or may not be the real catalyst for why price is going where it's going. And that to me was a big shock when I discovered that my faith that was in indicators and the use of them wasn't needed. At least for me, it wasn't needed. And it provided clarity when I removed them from the chart. And I take a step back all the time and I try to think about how I'm going to present this in a way where I won't offend someone, because invariably I'm going to offend a group of listeners or viewers. It's not my intent. Okay, my intent is for you to just think about it for a moment and think about how this may or may not be true for you. But when I took away the indicators, it was scary for me because I felt like I was blind. Like I didn't know what I was doing. I was trying to drive in the dark with no light. That's scary, right? So what it took for me to grow in trading naked with nothing on the chart, no indicators whatsoever, I had to understand why I'm even anticipating a specific price move in the first place. So I'm looking for reasons why the market should go higher. Okay, why should it go higher? Well, the market has gone to a specific level. It's shown a willingness to go higher. It's punished those individuals that have already tried to go long. And there's a area where traders that would be profitable as the market dropped, where would they have their stop loss? And I started thinking about the market from a cannibalistic stance. How can I devour the less informed traders? That was the mindset. So instead of going in and looking at price action with indicators of the chart, I started thinking about where are all the traders out there right now in the marketplace, where would they have an order resting, whether to get in the market or get out? Where would they have a protective stop loss? And The logic that most retail books would promote is this is resistance. So therefore, as the market drops, where would be the easiest place to place a protective buy stop protecting that short position? It would be above these highs. That's exactly what every person that does any kind of retail level trading when you first get into the marketplace, that's the first lesson they learn. That's the first sip of the Kool-Aid that poisons your entire outlook on price. I did the same thing. I'm guilty of that too. It's hard to believe that they would allow all these books out there with all this misinformation, but yet they do. Misinformation, in the hands of someone that's reckless, can cause blown accounts. I've done that. Depression, I've experienced that. Repeated failure, I've experienced that as well. That changed when I stopped forcing my treasured authors and mentors who I had foolishly placed faith in because they've shown me static examples that they didn't actually trade themselves. So there's a limitation in terms of what you can learn from someone, even me. If I would have never started doing what I'm doing here, or when I was doing mentorship and showing my students daily, like you're getting the experience of right now on Twitter, stop asking me to join because I'm doing it for free, right in front of everybody. Everybody's here listening. Everybody's able to watch my tweets, okay? That's the mentorship. You're all part of it when you go there. It didn't cost you anything but the time invested. But it's going to take you time to divulge, or for me to divulge everything that is that I want to cover. And I think a minimum reasonable expectation in terms of time is a full calendar year because there's seasonal tendencies coming in the marketplace. But you're going to see a recurring theme that repeats itself, that I'm taking your attention to the most important level next. Contrast that with, all right, we're going to do a market review, and here's the trade I did. I think I got in here, and I poke fun at people that's on YouTube like that. If you've taken a trade, you'll show that you've taken a trade. Why wouldn't you? Why wouldn't you do that? So it's an unfortunate thing that we as new students, new traders in development, and I was like that in 1992, we place a great deal of faith on logic that we've not proven ourselves, and we've not seen the teacher themselves prove that they understand it as well. So one of the things I set out to do as a trader is figure out why the market should go where it's going to go next. There's lots of things that you can use, even from a retail trader's perspective, to get into a trade. Getting into a trade is easy. Understanding why you're getting into that trade is more significant and more important. I'm just checking down real quick. Also proving that your video isn't frozen. So knowing why the market should go where it's going to go next with a great deal of probability, statistics behind the faith that you hold in that price movement panning out in your chart. What's the logic behind that? Days, weeks, months of backtesting, forward testing, and tape reading. You can't become precise with your trading without doing that. No trader, no mentor, no teacher, no course, no program, no black box thing that you can follow that gives you signals. None of that is going to bridge the gap between you trusting in the core being of who you are, the thing that you're doing and risking potentially if you ever decide to do this with real money. You have to have the faith that no person, no other teacher, other influence can remove your faith in what you're doing because you've done it, you've handled it. So when I set out to figure out what it is I'm looking for in price action, I wanted to target and victimize the less informed traders because I was tired of being one of them. And I took that anger and that resentment I had on all the time, the money I invested in things that weren't able to be profitable for me, blown accounts, failed continuously. I couldn't find traction. So I was looking for a way to take away all of those things that I discovered were the very vices that caused me to put this unrealistic expectation on myself that I had to be right. I had to be right about the direction, yes, but I had to be right about the market too. Which one was I going to trade? Because I was a commodity trader when I first started. And what time frame would I trade on? I had to be right about all those things, folks, just like you are. You're holding yourself to the flame. And if you don't know what you're doing, you get too close to the flame and it burns you. So I have to take away all the distractions in my perception about price and focus on where's the pain going to be. I'm going to trade because I was a commodity trader when I first started. And what time frame would I trade on? I had to be right about all those things, folks, just like you are. You're holding yourself to the flame. And if you don't know what you're doing, you get too close to the flame and it burns you. So I have to take away all the distractions in my perception about price and focus on where's the pain going to be? Where's the pain? Where are those bullseyes that are sitting in the marketplace? There's the stops. Above the marketplace, there's buy stops. This is buy side liquidity. This is buy stops that are pending. Their orders are just sitting there. I don't need a heat map, gimmick thing that some brokers offer. I don't need to look at level 2. I don't need to look at a DOM, depth of market. I don't need to look at any of those things. I have 30 years behind me knowing that this is where everybody's going to have their stop. This is where everyone's going to have their religious faith placed on their system, their pattern, their approach, their indicator, whatever it is they're using. And that's why the market's going to go there, because there's real orders. The market is not aware. The algorithm has no idea about harmonic patterns or supply and demand zones. Okay, that's not how these markets book. The price generates movements and price runs based on the first premise of time. If it's not the correct time of day, day of week, it's not going to deliver a specific way, whether it be bullish or bearish. Certain times the markets are predisposed to go into consolidation and range bound. That's an important factor of understanding why time is a crucial element to knowing what you're learning here. This generates movements and demand or indicator, whatever it is you're using. And that's why the market's going to go there, because there's real orders. The market is not aware. The algorithm has no idea about harmonic patterns or supply and demand zones. Okay, that's not how these markets book. The price generates movements and price runs based on the first premise of time. If it's not the correct time of day, day of week, it's not going to deliver a specific way, whether it be bullish or bearish. Certain times the markets are predisposed to go into consolidation and range bound. That's an important factor of understanding why time is a crucial element to knowing what you're learning here. This is algorithmic theory. I'm not teaching you classic chart patterns. In fact, I will show you how those chart patterns fail, when they're going to fail. Fake bull flags, fake inverted head and shoulders, triangles. In the books they tell you once it breaks out of these triangles, these wedges, then you go in the direction of the breakout. I don't like that because I fell victim to that. And to me, it's guessing. It's equivalent to the people that you see on social media. They'll draw a level line going up. If they think it's going to go up, it's going to go here. And if it's going to go down, it's going to go down here. I don't do that. I tell you exactly where it's going to go next. If I don't know that, I'm saying nothing. I'm staying silent. And there's nothing wrong with that because it's about being profitable, not being right. If I wanted to be right, my pursuit of being right was the reason why I'm even teaching. I'd be tweeting 1,000. It's equivalent to the people that you see on social media. They'll draw a level line going up. If they think it's going to go up, it's going to go here. And if it's going to go down, it's going to go down here. I don't do that. I tell you exactly where it's going to go next. And if I don't know that, I'm saying nothing. I'm staying silent. And there's nothing wrong with that because it's about being profitable, not being right. If I wanted to be right, my pursuit of being right was the reason why I'm even teaching. I'd be tweeting 1,000 times a day telling you the very next 1 minute or 5 minute buy side liquidity it would be reaching for, or inefficiency it would be reaching for. I could do that. I could drive you nuts. But that's not the point. The point is I want you to understand how to take everything off your chart and look at the market the way the algorithm that books price. I have floor traders in my community. Now, these folks, they were on the floor, open outcry, guys screaming, sell 5, give me 5, give me. They're in the trenches, or they were. Now, electronic trading, they're dinosaurs now. And it was a lot for them to transition, and some of them were unable to transition from that way of trading into electronic trading. There's a feel that you get down on the floor that the students I'd listened to that were floor traders they would tell you. You'd see the tide turning. They don't have a chart in front of them. They have the number. They have the orders coming in. What do they have to work with? The actual orders coming in the marketplace. So that was the first clue to me, and I learned this idea from George Angel. Okay, he's an author, wrote a bunch of books about trading, specifically the S&P, and I liked more about the things he remarked about that were not that many really, but when he talked about being a floor trader and his experiences being down there and how they would sense the turn of the tide, where the direction would change in the marketplace based on the order flow coming in, the fevered pitch of how much action was coming in, and they didn't need to see a chart. And I started thinking to myself, if these floor traders are making their money without a chart and they're interpreting the future price fluctuations based on the orders that are coming in, that means that I should be able to visually see where these orders are way before a floor trader even reacts to what would naturally be when this high and this high here is taken out here. You know what's going to happen. There's going to be a flood of orders coming in. There's going to be a fevered pitch. The market's going to be inundated with market orders coming in because these buy stops, once they're activated, they become market orders. And that intensity, that number of contracts that are coming in the marketplace that are being exchanged, that's predictable when it's down here. Become market orders. And that intensity, that number of contracts that are coming in the marketplace that are being exchanged, that's predictable when it's down here, 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 and here. Even down here. If you look at my tweets this morning, I mentioned that there was SMT divergence. Some of you are probably thinking, okay, what is that? I'm going to show you an indicator. Okay, this is one of my top secret indicators. You ready? Look at that. That's crazy, right? This is not oversold. This is just simply the price on a line chart on the low of the NASDAQ. Okay, you can create this on TradingView. If you're using TradingView, up in the upper left-hand corner, there's a little plus symbol. If you click on it, it'll give you new pane, puts it down, and you do overlay like this, testing the relationship between the lows of the S&P versus occurring down here. We had higher lows forming in the NASDAQ. That's SMT. I mentioned that this morning in my first tweet. I said there's decoupling in the stock indices, and there's SMT divergence at the lows on September. I'm sorry, on the S&P here, and that of the NASDAQ. So that set the stage for the manipulation aspect that I felt it was worth taking on the risk of going long. So if I'm seeing price, not an indicator, that's all this is, I'm comparing actual price action of closely correlated markets. I'm looking at the relationship of years, decades of experience looking at when this occurs around the opening at the opening bell at 9:30 in the morning, New York time. If I see that, and there is something like this existing in price action, which is these of closely correlated markets, I'm looking at the relationship of years, decades of experience looking at when this occurs around the opening at the opening bell at 9:30 in the morning, New York time. If I see that, and there is something like this existing in price action, which is these relative equal highs, that's a smooth area in price action. The market does not like to leave smooth edges. Now, by itself, doesn't mean much at all. But when you couple that with the fact the market's been going down, and then as this is going lower here, we've taken out a smooth area here. This is going to be viewed as what in retail mindset? Support, right? And then when it breaks through it, traders that would look for this level here as support, and they don't want to trust that it's going to go higher there. They expect it to break. They want to see that support broken, turn what? Resistance. So how are they going to be right about their trade? They're going to wait for it to come back up into this level here, and they're going to try to go short. So the traders that are in the market up here, short, they're right if it never goes back up to this level here. I'm not worried about being right or wrong. I'm looking to devour, to consume the less informed traders. And they're willingly laying their necks on my blade. They're willfully walking into the crosshairs of how I trade. They're not aware of me. They're not aware of you as my students that internalize a market like this. They're just looking at their patterns. They're looking at their indicators. They're looking at the things that their religion says should equate to profitability. But none of that stuff has any bearing on why price is going where it's going. And it's easy to convince yourself, like it did me when I had, well, very few opportunities where it panned out in my favor using specific indicators. And I know this lesson painfully because I'm preaching you what it was that I discovered how I was wrong. Because when I was doing it with these indicators, and the market was predisposed to go up anyway, and I was only focusing on being a long trader, I didn't understand going short. That idea of only focusing on being a buyer when the market was likely to go up, well, it stands to reason that's the only reason why my trade panned out. It had nothing to do with the indicator, it had nothing to do with any price pattern. It was the fact that the market was going to go up anyway. So the realization I had one day, sitting in Gunpowder State Park in a hammock, looking out, reading, how I was trying to do something, enforcing correct outcomes, avoiding incorrect outcomes. There's your buy side I just mentioned, by the way. It's one of those cherry pick moments. The necessity of holding on to right or wrong as the outcome versus am I making money? Am I consistently able to find a way of harvesting, taking money out? And the only way you're going to be able to be assured that that's going to continue week after week, daily, every single time you sit in front of the charts that opportunity is presenting itself is understanding liquidity. Because if you don't understand liquidity, liquidity is the orders that rest above highs, buy side liquidity, buy stops, or below old lows, which is sell side liquidity, sell stops. Understanding who's going to be targeted next. Why should they be targeted next? So I don't want you as my student, if you're new or if you've been here for a while, some of my students communicate grief in their results, in their tweets. They'll say, oh, I messed up, and they almost flog themselves publicly in a tweet. And I know why subconsciously we as humans like to do those types of things. You're looking for the community, or maybe even me as the educator, the mentor, the hero that you look at me as, which I'm not. You want me to coddle you. You want me to give you a pat on the back and say, don't worry. You'll learn how to do this one day. That's not how you are supposed to be doing it. You never, ever record anything negative, whether it be a tweet or in your journal or in your notes, or vocalize it, because your subconscious is going to remember that painful moment. And that's the very thing that anchors to the reason why you're fearful of being incorrect. Think about it. Social media has created a firestorm of that. Everybody's responding to what? Stimuli. You don't like me, I don't like you, that type of thing. Right here. There's your buy side next. Let me make sure I have it on the chart over here. Sorry. discussion. So there's buy side liquidity at 40, 41, 50. So you're not trying to be liked by everybody. I don't feel bad when I win and someone lost. I don't have any concern for that, because when you open up a trading account, you understand the same risks that I did when I opened up mine. So if you lose money, whose fault is it? It's yours. When I lose money, whose fault is it? It's mine. But that problem of balancing and being responsible with the risk, as a new student, as a new trader, it's easy for someone to say, well, those brokers did it to me. And sometimes that's true, especially if you're trading Forex. But when you're trading a futures market, where it is what it is, everybody has the same high and low. It's a pure medium. But you're still going to be haunted and plagued by the desire to be right, because you think being right is safe. No one can judge you. If you're right, you should have made money. But how many times have you watched the charts and been right, but you didn't have a trade on? So you can't argue that's the reason why it's important for you to be right, because you're not even making any money when you're right. Or even if you place a demo trade, you didn't make any money. You can't go buy groceries with that. So are you still doing things properly by placing the emphasis on being correct or right versus profitability? So you have to peel that onion back and get all those dead layers off of things that you're worrying about, which is normal. Everybody's done it. Everybody will do it continuously in the future. After I'm long gone, people that will come into this industry, they're still going to have the same problems that plague them, fearful about doing it wrong. And it's normal. You know what it was like when you made the mistake of telling your spouse, your friends, your coworkers, whomever, that you're getting ready to start learning how to trade. And they probably gave you every reason why you shouldn't do it, right? Oh man, you're going to lose your rear end. I know a guy that lost. That's the first thing. That's the first thing they're going to tell you. And what are you going to remember? That. And all you wanted to do was share your excitement about wanting to learn something new and do well. Here's a news flash for you. Your family and friends, they don't really want to see you succeed. Just stop inviting them into your business. They have no business in sharing the spoils and your victories. They didn't work for it. They didn't take the risk that you're doing. They're not putting in the work that you're doing. Stop inviting them in the conversation, because they're only going to bring in their perspective of why they would never do this themselves. But in your heart, you're thinking, if this works for you, you're going to help them by getting them on the same page. No, it's not a team sport. If they want to do it, and then when you succeed, trust me, you will have to beat them off you with a stick, because they're going to be bothering you constantly. Hey, can you do this? Can you help me? Can you trade my account for me? My family members do that all the time. I have family members that I cannot help. I've given money. I've bought homes for them. They still lose everything. You can't help some people. In this industry, you are by yourself. Even though you may be mentored by someone like me or someone else that's well-meaning in terms of trying to protect you from yourself, knowing what it's like to do the wrong things, and also guiding you away from unrealistic expectations, because you're expecting to be right all the time, never wrong. And even if you're wrong, that's going to be when you're in demo, not with your live account. That's unrealistic. You need to have a disconnect from the equation of right or wrong. It's about being profitable. And the number one thing you want to do is focus on removing all those distractions. And the first one in that is social media. Your Instagram, your Twitter worships, your Facebooks, whatever it is, whoever you're worshiping, whoever you're following along and lifting up on a pedestal. And this is why I strike down everybody that says I'm the greatest of all time, the GOAT, the king. I can't stand that. I'm not. I'm just a guy that's been blessed with this information, and I'm trying to help you with it. I want you to do well. But you have to make decisions along this process that either you're going to listen to everything I'm saying, or the results that you're aiming for are going to be skewed. And that's exactly what I get from students. Some of my hardline critics are students of mine that failed themselves, not because my concepts don't work, because they themselves had the wrong mindset. They're impatient. They expected something that was unrealistic, and they didn't do the things I told them to do, which is what I'm putting all of you through this year. And some of you have seen that it's a lot more work than you thought it was going to be. Some of the folks that started this very first video of the year in 2023, first mentorship video, big, huge list of views, 200 some views, 200 some thousand rather. And as the videos would go up, less viewership, because they can't perform. They don't have the wherewithal to do it, because inside their mind they're thinking, I was expecting this to be easy. And it takes them back to that fear of being right or wrong. If it's this hard, I'm probably going to be wrong. Or ICT himself, a scammer, because he has rental properties and he probably sleeps there too. No. You're going to have everybody and everything give you perfect excuses why you shouldn't do this. If you're swayed by that, you're not a trader. Because come hell or high water, someone that's really dug their heels in and says to themselves, I already know this is going to be hard. I already know it's going to take longer than I probably want it to be. But I've seen enough to know that this is exactly what I want to do with my life. I want to pursue this, and I want to master myself. Notice I said master myself and not master the markets. I have not mastered the markets. I will never master the markets. How's that for a reality check? Now, I'm pretty precise. I'm pretty consistent. I can see certain things in the marketplace, and I've demonstrated that for years. My students are able to do that as well. None of us are mastering the market. The only thing we can do is master ourselves. And how do we do that? Number one, we wrestle with the idea, and we hold it at bay, the idea or notion that we have to be right. Right is not always profitable, and wrong is not always unprofitable. There's many times I get into a trade, and I expect a specific thing to be reached for. Like, for instance, we're staring at right now the 40, 41.5 level. I like the idea of it trading up there, but it might require going over lunch hour before it does it. Or it might just shoot up there while I'm talking to you. It doesn't make a difference to me. I'm not in the trade, but it's an expectation I have. So if I place that in front of you, you're all watching me live. If I say I believe that 40, 41.5 is likely to be traded to today, and it doesn't, what did I lose? Nothing. For some of you, you think, oh, you got that wrong. And you'll overanalyze, how did you get that wrong? Here's what he didn't see. And you'll bring all your retail stuff as to why I should have trusted that versus what I've been doing for 30 years. I don't care about the opinion of other people. That's not going to change my perspective on how I teach, what I use, what my students make money with. They're not looking at their bottom line and thinking how many times they were correct and how many times they were incorrect. They're looking at their bottom line growing. That's why you're here. You don't like me as a person. I don't give you fashion tips. I'm not here showing you lifestyle stuff. You're here because you know that I'm showing you something that repeats. And that's exactly why I want you here. That's it. You're not going to have dinner with me. I'm not going to come over to your house. I'm in your house every day, but I'm not going to visit you. Your relationship with me is I'm a conduit. I'm a pathway between where you are right now and where I know you can be. Your visibility may be limited because of experience, because of doubt, the people you hang around with, where you came from. All those things are going to be factors in why you're placing so much emphasis on being correct and never get it wrong. That's unrealistic. You need to put it aside and dismiss that. Don't worry about that. That will be an impediment to your development as long as you hold on to it. I'm going to put you through drills. Live streaming. I'm going to tell you, watch this fractal here. Watch this move here. Let's see if it goes to this level next. And we're going to record how much time it took, how much drawdown from the time that we would anticipate the move beginning until it trades there, or where it goes to a level that would be no longer valid for that price run. For those of you that are listening, you're thinking, that's it. ICT's giving us a secret signal. Okay, that's the buy and sell we're looking for. If you do that, you are cheating yourself of a learning experience that you cannot get otherwise when you don't do it with money. If you place a trade based on the things I'm saying when I'm doing live streams, you're ignoring the benefit that's available by you not being swayed by the outcome. See, if I say, I think it's going to go here, and this is what we're watching the reaction here, and it should go here next, and it shouldn't go here. That's enough for someone with reasonable understanding to say, okay, he's just said, this is where the stop would be, because if it goes there, it's no good, and this is where he thinks it's going to go, and he's saying right now is the time it should react. So that's the buy, or the sell, the stop, and the target, right? Right, I'm aware of that, but I'm not telling you a signal. I'm teaching you how to read price. And here's what's going to happen. Folks are going to go in there, they're going to press a button based on what I'm doing, and it's going to move. And then they're going to go to my Twitter feed, and they're going to try to high-five me. And they're going to say, thank you, ICT, I just got my funded account, I just passed it, or I'm getting my first payout because I just took that trade. I'm not going to like your post. In fact, it offends me because you're not listening to me. That's the number one reason why I refrain from doing these types of things, because it's not helping you. As much as you think is that little bit of a monetary push, you will not be able to do it on your own. If I stop doing it, you're going to be back in that square one of, I'm afraid if I do it, I'm going to get it wrong. Versus watching the tape with me live when we do it live over the charts. Putting aside the requirement for it to be on a trade that makes money or loses money. Because if you're thinking about the money, you're placing yourselves in the same category that I attack in my trades. When I'm doing my trades, I'll many times annotate, sometimes facetiously, I'll say, imagine you were short here. Would you feel comfortable with your stop here? And invariably, it goes right to that area where the stop is. When I'm looking at these candlesticks, I'm reading the hearts and hopes of traders out there that are just trying to do everything they can to make money with things that will never deliver that. I can never meet them. I can't get them. I can't tweet them. I can't text them. I can't call them. I can't send them an email and say, hey, you're doing it wrong. Let me help you. So I don't have any moral dilemma here. They knew the risks. And when they lose, they'll either learn how to do it better or stop trading. Either one of those outcomes is favorable. I'm still going to sleep the same way, whether those people still have an account after that loss or not. But you, as a developing student, you're placing so much foolishness on things that are controllable. And you're not placing emphasis on the things that are requiring a lot more of your time and due diligence, which is studying without any monetary commitment. Demo, not even that, no. Tape reading, what I'm putting you through. Watching the tape. When I tweet, I say, this is the next level, watch that, note that. If it's above the marketplace, at the time I tweeted it, my bias is what? Bullish. I'm expecting it to go up. To what zone? No, to that level, to that price level. It might sweep through it, that's fine, but that's the level I want you to be following and watching when the tweets go out. If the market price that I'm telling you to note on your chart is below the market price at the time of the tweet, I'm signifying that I believe the next run that we focused on is going down. Isn't that pretty easy? Now, I still get criticized, and I don't give a rat's rear end, from people that just simply want me to spoon feed them. I am spoon feeding you. I have a 24 karat spoon every day on Twitter. All you have to do is show up. You have to study the things that are in my videos, and you'll see your pattern form. The thing that you're going to be utilizing to make your trades on your own, independent, without me saying anything, that will come by you watching the tape, using my experience, borrowing my experience of where I think the market's going to go next. There's going to be times when I get it wrong, but there's going to be far less than you would have been doing it.
Yo, what's
All I'm
good?
suggesting is to use it as a crutch. In the beginning, there's no shame in that. No shame at all. There's no shame in learning how to trade in demo. There's no shame in teaching in a demo. If an educator goes out there and says, hey, I'm responsible. I don't want to see any of you hurt, and also I want to protect myself because I'm not a licensed trade advisor. I'm not. I'm not a financial advisor. And by talking about charts like this, there was no button being pushed on. In fact, I've actually told you not to do it. But the skill set of reading.
Yeah, good to see you too, bro.
By doing these exercises and spending time with someone that knows how to do it, whether they're doing it as a demo, whether they push a button or not, if the market pans out continuously over time, repeats, there's something there that's worth mining. There's some kind of insight that's worthwhile. I'm not a licensed trade advisor. I'm not a financial advisor. And by talking about charts like this, there's no button being pushed on. In fact, I've actually told you not to do it. But the skill set of reading and interpreting price action, by doing these exercises and spending time with someone that knows how to do it, whether they're doing it as a demo, whether they push a button or not, if the market pans out continuously over time, repeats, there's something there that's worth mining. There's some kind of insight that's worthwhile to extract from that medium or person. And if you foolishly place a trade on anything that I say or someone else says, and you don't know the logic as to why it's being considered as a trade, your attention is not going to be on the things I'm going to say, draw reference to. You're going to be watching the profit and loss up and down as the fluctuations occur. You're going to zone out. You're not going to hear the things that's going to be more pertinent to you.
Currently watching the stream on the 2023 mentorship.
To know how to do this independently, because you're fearful of what? The outcome now not being profitable, and you're not going to listen to anything else. It's the same thing that everybody does when they watch a book or join a course, or they follow somebody that thinks they're the bee's knees in trading, and they're talking about where the market's going to go next. And you're all out there trying to line up to do trades based on whatever they say. You have no idea what made that person say it's going to go where it's going to go in their analysis of their call or signal. To me, that's the epitome of gambling. You have no reason why you should trust that. What's the logic? Contrast that with me. I'm literally trying to explain to you why these price patterns should form, when they should form, how you can trust them when you know they can fail. And I'm also teaching you, in certain instances, there's an environment that you don't want to be taking a trade in because the risks are too high versus the potential reward. That's a skill set that you can't learn from a book. You have to be side by side with someone. There's literally no way to learn that except for walking hand in hand with someone on a daily basis, a weekly basis for months, in my opinion, a full year. You'll appreciate managing the risk more appropriately by doing it. And at the end of the year, you're going to look back and say, you know what, I'm glad I didn't push myself into trying to trade before I was ready. I'm confident that I did managing the risk more appropriately by doing it. And at the end of the year, you're going to look back and say, you know what, I'm glad I didn't push myself into trying to trade before I was ready. I'm confident that there are going to be many of you that won't listen to what I just said. You're zoning that part out because you need to make your ends meet. Groceries are more expensive, bills are going up, rent's higher, gas and electric, natural gas, even eggs. 400% increase in egg prices. I get it. But you can't speed up progress. You can't. Your progress is going to be uniquely your progress. And don't measure it against somebody else that you may be seeing do very, very well. You might see someone that your friends with online. They came to the same place that you're at right now. They're trying to learn this stuff. Great. And they may do far better, faster, or give you the impression of doing it better. And you might think, well, that means I'm not good enough. I'm not a good enough student. I must be slower mentally than that person or everyone else. I have students that started with me in 2016, paid me money, and learned the same lessons that people that are making money right now learned that they can't do it themselves. And the common denominator is how much they put into it, what they're holding on to in terms of fear, just doubt, and just doing the work. And the work is sitting in front of these charts and watching price action. You might not be a trader that has the ability to trade intraday. It may not be within the realm of, possible for you. You might need to trade a higher time frame. Don't discount what I'm showing you because everything that occurs in these 1 minute charts is applicable to a daily or a weekly. It's the same things. It just takes a lot more time to pan out. So there's no reason for you to have these unrealistic expectations about being right or wrong. It's about being profitable. And your ability to be profitable Once you latch on to whatever it is that I'm teaching that you like, it might not be a fair value gap. It might be an order block. It might be the breaker. That's your only model you care about trading. That's it. That's your multiplier. That's the thing that you're looking for. Okay, what's wrong with that? Just because your entry is going to be different from somebody else, you might make less on your trade than the next trader. Is that trader going to give you any of that profit? No. Is it realistic for you to expect them to do that for you? No. You should be content with enough. If all you do this year is develop a skill set that allows you to reduce some of your overhead costs living day to day for you and your family, is that not a success? How many of you considered that? That was the reason why I made that ends series on my YouTube channel. Just ground some of you younger folks that are just so worried about going out there trying to get Ferraris and Lamborghinis and such. They're fun. I get it. But once you own them and everybody knows you have them, nobody cares anymore. And you're still stuck with the insurance, the upkeep, and the worrying about somebody scratching it. And you're never going to want to park it somewhere and walk away from it because those types of things happen. More money, more problems. Reverse it and say, how can I use this skill set to help remove anxiety? Whereas right now you're using it as, this is the reason why I'm anxious. This is the reason why I'm having anxiety, because I can't figure this stuff out. When you just need to relax and understand that not every single moment of the day is an opportunity, and it's not realistic for you to see it. You're still learning. But being fearful of the outcome is always attributed to because you have money on the line. That's not to say that when you start trading with live funds, should you decide to do so, that you shouldn't be concerned about the risks. Yes, you should be. But it shouldn't be paralyzing. I'm about to work with my son Cameron. I mentioned the other day, he said he wanted to do a funded account. He watches my videos, and obviously you see the advertisements, people run ads on YouTube, and he watched this Top Step thing. I have no affiliation with Top Step. Okay, I'm just being open with you. I know my son said he wanted to do it, and he does not want to have a Twitter account, doesn't want to have a YouTube channel. And frankly, I think that's great. And his words were, I don't care about anybody else liking you guys. If I can make money with it, that's all I care about. How proud, how proud was I hear him to say something like that? Because, I don't see that as somebody that's selfish and greedy. That's someone that's got it figured out early on. If you're going to do this, only do it because you want to make money. I don't care who likes me. You shouldn't care who likes you. Do you think it's going to matter when you figure out what you're doing and you conquer this fear of being right or wrong and you're able to find consistency? That means making and losing money, but over time, you're making more than you lose. That's trading. Do you think that anybody is going to convince you that you've wasted your time when you start making money? No. You're not even going to give them the time of day. And to hear my son say that he's not interested in that, he only wants to make the money, that's the proper mindset. But he admits that he has a fear, which is reasonable, of pushing the button. Because I can see that fair value gap. But I'm afraid if I go in and I push the button, Dad, I'm afraid it won't pan out for me. And I don't want that transaction to be painful. He plays video games. So he's trained himself, conditioned himself into what? New high score all the time. New high score all the time. New high score all the time. And that's fine for video games. But this is not video games. This is financial ruin if you let it happen. So it's important for you to understand there are times when right or wrong is important. But right or wrong isn't terribly important while you're learning. You need to learn how to balance that. And one of the things that I'm going to teach him, and I'm going to teach you all as a result of being a part of the program with my son being a developing trader, is that I'm going to put him into situations where I desensitize him. I was afraid of putting on trades like that too. And hearing it come from my experiences, it only has so much help. So I have to show him how to desensitize yourself from fear of doing it wrong. We will be doing live streams. I'm thinking about this because I know there's people out there saying I do this all the time. I do reset my account for other reasons, but this is the demo account I showed you guys the other day. I saw some joker say, "Oh, you blew his account. That's why he's talking about something else." Screw this up here. Now I tweeted. You can see all the dates and stuff here. It's only been 2 trades. This is nothing. It's paper trading. It's stupid. Okay, but I'm gonna reset this account. Okay, to 50,000 because I'm going to be working with my son Cameron. He wants to get a $50,000 Top Step funded account. That's his goal. That's what he wants to do. He works a job. I make him work a job. And it's important for him to make his own money. If I just dole out money to him, which is what I've done with one of my children, and it did not help. It made things worse. So now, because of that experience, I don't have the shame and guilt that I felt by having a lot of money and not just giving it to them like I wanted to do when I was a younger man. By making them work for it, it conditions them. It's work hardening. It's important. That's what gave me the work ethic that I have now. But he has this fear of doing it wrong because he's viewing it like a video game. Because in this, if you lose your account, unless you have more money to put into the account or reset with these funded accounts, I think that's what they call resetting. It's something like that. Well, if you blow the account challenge, whatever, you pay another fee to start it up again. So if it's not reset, I'm saying it wrong, I apologize. But he doesn't want to fail and do it wrong. And it's in his head about pushing the button. So I'm going to teach him how to desensitize himself. I'm physically going to be on the live stream. You'll hear me talking to him. Now, I'm not going to do it daily, but I'm going to force him, and you all have the benefit of hearing me tell him exactly, this is my flesh and blood. This is the son that was given to me on Valentine's Day, the day I was married to my wife. He was supposed to be born on March 5th, but the Lord seemed fit to give it to him, give us him that day, which is great. I'm not going to give him advice that I don't wholeheartedly subscribe to. So that way you can trust the things that I'm teaching you. I'm talking to him right now. This entire discussion has been to him. But you think I'm talking to you. All of my videos are to my children. And when you watch us and listen to me and him engage over live data, and I'm trying to tell him, do this right now, and tell me what you feel while you're doing it. For some of you, it's going to be very entertaining. Others, you're going to learn a great deal about yourself and how you see price as it's happening live. And I'm going to try to get him to be honest and tell me exactly how he feels in his own words. He may or may not do this because he's about to turn 18. He's Mr. Macho. You know how teenage boys are. He's way bigger than I am. He looks like a freaking linebacker on an NFL team, but he's a softy at heart, and he doesn't want to be judged. So I believe he has the makeup in him. If I turn him into a savage, he will be a menace on social media. If any of my kids are going to be like that, it would be him. But he's also cognizant to the fact that he is not there yet. He wants to be, but he's also admitted to his father that he's scared to push the button because he doesn't want the results to be negative, and he doesn't know what that's going to feel like because he's doing it with quote-unquote potential to make money. Now, this same son of mine has only listened to me about trading. He has never sat down, ever. Never, ever, ever sat down, did it on his own, started a demo account, started working. He's never done it. He has next to zero experience. So if he gets out here in live and he does this, and he flounders in the beginning, that's exactly what it's like when people do it. It doesn't matter if ICT's his dad, because he's going to push the button. I'm not pushing the button. So it's a matter of grinding your way through it, because if I pass away and he doesn't learn his skill set, then guess what? He's stuck where you are. It's only in the videos. And I want my youngest son to learn like he will hopefully see Cameron do it and understand it. He had fear, he had anxiety about performance anxiety. You know, you want to do it, but you're attributing the failure and success on an individual event or transaction in one trade. And that's what makes this difficult, because everybody can afford to lose 1/4 of 1%, no matter what they have in their account. If you can't, then you shouldn't be trading. Yes, I said 1/4 of 1%. When you're learning how to trade with real money, that's where you start. Not 2%, not 1%. And the folks that are out there saying, you can't make money with a $50,000 funded account or a $50,000 trading account or with 1%. These same people don't know how to trade, period, because you're basically saying you don't know math. How can someone say that you can't make real money with 1%? Now, are you saying you can't flip your account every month or every 3 weeks, risking 1%? Then yeah, I agree. That's a true statement. But you can make 6 figures a year making trades with less than 1% in terms of risk. I'm not saying you're only making less than 1%. I'm saying to incur risk or open yourself up to risk at 1% or less, you can still make 6 figures a year doing that. How can you do that, ICT? It's math. All you're going to be doing is looking for something that repeats over and over again. You're looking for your cookie cutter, but right now you're afraid that your cookie cutter isn't going to give you the cookie that you want. That's why you're fearful of it. You have not handled it yet. You have not worked with it yet. You have not seen it perform in price data that's live. And it will desensitize you and remove all the doubt that you have right now. You're fearful that you can't do this because you haven't handled it yourself. Most of you are sitting on the sidelines and waiting for me to do these live streams. Call moves, call this, call that. And then if I do it right most times, then you're going to take the initiative to do it. Okay, it's fine. That's normal, I guess, in a lot of ways. But there still will be people that even when I show them results, they're not going to be willing to do it. Because there's a barrier there. And it's not with me. It's not with the content. It's not with the concepts. It's in them. And you have to press into that. When it feels uncomfortable, that's exactly where the growth occurs. That scary feeling of, I see it there. I know it's only a demo. I'm going to push the button, but I don't want to see the bad result happen because it's just going to make me feel like I'm never going to learn how to do this. That's exactly what you press into. You press into that moment right then and there. There it is. And you log the experience without having any of the negative self-talk. You always positive self-talk. You find the silver lining in everything and you record that in your journal. You record that in your charts, in your annotations. You never emotionally charge it with a negative link to a bad reaction or regret, because your subconscious remembers that. and it will be an impediment to you pushing the button when you need to on the next trade. That will be perfect, but you will be thinking and beating yourself up mentally, and social media invites us to do those types of things. You don't want to do those things as a trader. You want to guard your mind, filter in only positive. If anybody out there is toxic, they should be removed from your attention. If I am a distraction to your trading, don't follow me on Twitter. If you already know how to trade and you know how to use my concepts, the worst thing you can do is listen to me on Twitter, because I might be looking at a setup that would be contrary to yours. And I have students have done this. Man, I wish I never saw that tweet, because it made me second guess my trade that I'm in a larger time frame, and I got out too early, and I would have made this much more. Yeah, whose fault is that? It's not my fault. I'm teaching. I'm not aware of your trade. So you need to be responsible with your actions or inactions and own the results. If it's good, you earned it. If it's wrong and you did something incorrect and you have an adverse reaction, you own that too. There's nothing shared in trading. I have students out there making real money. They're not sending me parts of their winnings because they feel like they owe me something. They earned that. When you do this work, you get all the results, and you own it, good or bad. But being fearful of the outcome is rooted in you not knowing what it is you're trying to do. And you're trying to make that because they feel like they owe me something. They earned that. When you do this work, you get all the results, and you own it, good or bad. But being fearful of the outcome is rooted in you not knowing what it is you're trying to do. And you're trying to make that like a boogeyman scenario. Like you're going to be a victim of something outside of yourself when it's just you. Your broker didn't make you push the button. I didn't make you push a button. Your spouse and your circle of influence, friends and family, co-workers, none of them forced you to put on a trade. None of you will ever be able to justify your pushing of a button on anybody else but yourself. You own that. So doesn't it make sense for you to desensitize yourself from the experience in the beginning, doing it the right way by not having money attached to the transactions, studying price, getting a close read on price, and knowing when not to trade, when to close the charts and be done, and not being fearful of missing out. If any of you are in the listening audience right now, and you put on a trade, maybe you took a couple trades, and you made money, the times I tell you in Twitter to close your charts and turn them off, doesn't that feel like I'm asking you for your firstborn? What? I might be able to take another trade. I need to get my funded account challenge finished. I just need that $5 more of a move to get back that last bit of drawdown. It's a Friday, ICT. I gotta do this, or I'm not gonna be able to live with myself this weekend. I'm not gonna close my charts. I gotta go in there one more time. That fear of missing something. If you feel that, that's infancy as a trader. That's not maturity. Maturity is knowing that you have the discipline to follow sound advice. I'm not saying there isn't going to be fluctuations in price. I'm just saying, do you have the discipline to say this is enough? Close the charts. I'm inviting you to forge discipline. And some of you, most of you, if I'm being honest, doesn't register as sound advice. You think I'm just, oh, well, he's done, doesn't mean I should be done. No, I'm teaching you to remember there's a time when you can be content and close the charts. Then you're not inviting the wrestling match that happens with, I need to be right on my trade. And you know what it feels like when you still keep your charts open and you go out there and you wreck yourself. And then you tweet to me. Or you want to tweet to me, but you know I'm going to say these types of things to you. I told you not to do that. Everything I'm doing and saying and teaching on is meant for my children to do well. You are all guests in my house. That's it. That's the way we do things here. I'm teaching my children. You are just invited into the conversations. But when you make bad decisions, much like my own children will do it, meant for my children to do well. You are all guests in my house. That's it. That's the way we do things here. I'm teaching my children. You are just invited into the conversations. But when you make bad decisions, much like my own children will do it, they're going to be told the same way. Eat it. It's good medicine. It's going to help you become the trader that you don't even realize is in the making. That formidable, profitable, consistently sound logic, not afraid, not swayed by emotions. You know exactly what you're going in there for. You know why you're doing it, and you know where you're going to be wrong so that we can measure and define risk. You're going to weather losing trades. That's fine. That's normal. Every trader has losing trades. Every trader has drawdown. Better traders control drawdown and mitigate systemic drawdown. Those are skill sets that you learn by getting in the trenches and being in these charts and pushing a button. But you want to learn those lessons when there's no money attached to them. And most of you are attributing being right or wrong and the fear that of being wrong because you're trying to do it with live money when you're not even ready to trade. You have no idea. Can you honestly say, and be honest now, think, can you find 15 profitable setups between now and the close of the month of January? Do you have the experience in you to know that you can absolutely frame that many high probability setups between now and the close of this month? If you can't do that, why on earth would you be worrying about the transactions being right or wrong and having so much emphasis on it? You're now in you to know that you can absolutely frame that many high probability setups between now and the close of this month. If you can't do that, why on earth would you be worrying about the transactions being right or wrong and having so much emphasis on it? You're placing unrealistic expectations on yourself. I don't ask that of you or any of my students. So why are you asking it? You're asking to be a gold medalist Olympic trader because you watched a video series by me. I don't expect that of you or my viewers. But that's the equivalent of what it is you're doing. It may not feel like it, but that's exactly what you're doing. And that's irresponsible, it's unrealistic, and it needs to stop. Because you're holding up your progress by doing those things, thinking about it like that. So when we tape read this year and we're watching price action and I'm taking you through the charts on Twitter, you need to be engaging and not thinking about how much money I would have made on that. That's the worst thing you could have done. Worst thing. Because you are not taking advantage of the time I'm investing in you by showing you how to read the tape, watch these candlesticks paint, and you have no outcome to worry about. You're not going to make any money on it. You're not going to lose any money on it. And you have all of the focus on what? Reading how price behaves between the time I send the tweet and when it hits the level. There's lessons in that that I can't even articulate because it's going to be on an individual, unique basis. You're going to discover, wow, I really am impatient. It took 11 minutes for the trade to go there, and it felt like a lifetime. I'm really impatient. Yes, that's what this market will do. This market is a mirror. It's going to show you every character flaw in you. And you can try your best to try to ignore it. Pretend it's not there, and it will just compound and show you in reckless trading. You got a superiority complex, you're on social media, you're going to try to be better than everybody else, and you're going to break every sound logic rule in trading. You're going to over leverage, you're going to martingale, you're going to push, and you're going to say, I should stop, I know I should stop, and you're still going to do it on your live streams and roast yourself. These markets are a mirror, and they're going to show you and the world, if they're watching, the real you. And if you're new and you haven't even discovered how to trade yet, why would you invite other people to cast their judgment upon you when you don't even know who you are as a trader yet? You're trying to rush to do too many things, and there's more important things to be worrying about. Sound logic, patience, knowing what to look for. What do these patterns look like on a day-by-day basis, week to week? Over time, what that does, it's a desensitizing event that you see these things panning out. It doesn't mean that you should be expecting to see the same thing when you first find me. Some people, I've watched your entire series. I studied all your videos, which means I watched all of them. And I'm still struggling with bias. Okay, that's what this entire year is going to teach, bias. I'm trying to figure out how to find the right fair value gap. That's what I'm doing this year. Hear the last word in that sentence? Year. You will not learn the correct bias or narrative in watching one video series. I can't write a book. I can't condense it into a 5-minute trainer. Nobody can. You have to walk it with me. You have to see it daily, weekly, over months throughout this entire year. And then you'll be able to reflect back on all the journal entries, all the times, the events that we walk through live, either on Twitter or on live streams. You'll have that experience, and it'll mean more to you because you walked it. You lived it. You went through it. And some of you are kicking and screaming, I don't want to do it, ICT. And damn it, you're not going to make me do it. Right, okay. Stay mediocre and unprofitable. Because that's what you're saying. Because whether you realize it or not, long-term continuous success in trading is doing this anyway, every day. You think you're not going to be looking at charts? How are you going to make money? I don't want to watch data. I don't want to watch the charts. I don't want to backtest. I don't want to do any of that stuff. What? How are you going to trade? How are you going to find the setup you're looking for? You've got to put your nose in the charts. I ain't got time for this. Right, you're saying that you're in a hurry to lose. You want to fail. You're on a fast track to failure. Go ahead. Have it your way mentorships are out there. Do it. I'm here, and I'm talking to the folks that are ready to learn. They're not expecting pie-in-the-sky results real fast. They're not trying to get Lambo lifestyles. No, you can get that real quick. Learn how to trade, and then make your analysis available to other people. They will pay you gladly for that. And you will make millions of dollars doing that real fast. You can get Lambo life just like that. So if that's really what your passion is, put the work into it, learn how to do this, and there's lots of other people that want to copy whatever you think is going to happen. If you're consistently profitable, your analysis is correct, believe me, there's more people on this planet that are willing to pay you for that skill set than you can take as trades. And you can make more money doing that. And that's this whole argument, oh, if you could do it, you wouldn't teach, you wouldn't charge money. That's bull. That's bull, okay? If I needed to make a lot of money, real fast right now, all I got to do is put a PayPal link up and say, here, join my mentorship. I don't need to do that. I'm teaching you to trust me. I am not selling you a mentorship. I'm giving you my life right here for this entire year. I'm pouring it out. I'm giving you the experience. But don't let other people tell you if this is what you want to do, that you want to go out and you want to teach what the market's going to do next using this newfound skill set you're learning. Don't let anybody tell you that's something that you should be ashamed of. Get your bread. Get it. Because these same people that are going to criticize you and cause you to doubt, they're not going to be there handing out something when you need it. When your utility bill is high, you can't pay it, they're not going to help you. So why you give them the time of day worrying about it? It's the same thing you're doing to yourself when you sabotage yourself. Doubting. Oh, I got to be right. I got to be right. No, you don't have to be right. You have to be responsible, knowing what it is you're looking for, and it has to fit your personality. If you're trying to find a model that I'm maybe even covering, later in the year, you might even see me talk about, in this move here, I expect this type of price action, and this model is XYZ. If it doesn't resonate with you, don't force it like you have to because I maybe did something correct and it panned out. Don't do that. I have people that have never left the simple optimal trade entry pattern, which was my flagship pattern on this YouTube channel. Even though I've taught everything, the new fair value gap model, the whole core content from the paid mentorships up on the YouTube channel, and they have still never left optimal trade entry, and that's what they make their money with. Hey, you are the poster child of who I'm trying to represent here. They're not influenced even by me. Once they find their model, they don't care. They might watch my stuff, but it isn't changing anything, right? It's not having any impact. They're not tinkering with what already works. When you buy a new sports car, if you pay a lot of money for it, how quick are you to want to open the hood up and move things around underneath the hood? I ain't touching that stuff. I don't understand it. I ain't gonna shame in telling you. I'm not tinkering with something that is already perfect as the way it is. So when you find your model, you find your approach, don't let other people, whether positively or negatively, let them have no impact on your trades. Nothing, not your model, not anything. Let me talk about this real quick. NASDAQ is really, really sloppy here. Really sloppy. Gun to my head, maybe a higher high looks likely on this one. I don't know if it wants to run this high here on the 15-minute time frame. Let me just drop a line on that. I'll refer back to that later on. I'll start stopping to the same time we have lunch. Let's see here. Take a look at the Dow. That's the outcome of a trade or an idea. Some of you are just plagued with, you don't think you deserve to learn how to do this. And some of you are afraid of success. As weird as that may sound, that's exactly what some of you are fearful of. Is it going to change you as a person? It will. And it takes a whole lot more energy and effort to resist being ugly. And when I started making a lot of money when I was a younger man, that really made me arrogant. And you have to be careful with that. And it's something probably that you should be concerned about if you're a young person, especially a male. Females not so much, but the males tend to be braggarts and want to show their peers that they're worth listening to. But I'm going to cover what I did this morning, and then we'll close this because I could turn this into 4 hours easily and probably bore the socks off of you, but I want to make it useful. So if we have the you can see it's not a replay, by the way. So we had the SMT divergence down here, and that is here. We have the lower lows, but not seen in the NASDAQ. See that? So this is the SMT divergence. And what this is, what's actually occurring here, as the S&P market is dropping lower, it's going below the sell side liquidity here. So I'm going to take that real quick so you can see, follow the logic. This is what's going on in my head as the trader. Below here, sell stops. Okay, so that's what we call sell side liquidity. So the market taps into that here, and then once more here, and right there, we're getting divergence between the lows of the NASDAQ, and I'll show you what that looks like with the candlestick. See how we went lower here? This low, this low, this low, respectively. On the NASDAQ, it's higher each. Okay, so it didn't make a lower low on this pass on NASDAQ, which is the lower chart I'm pointing to, at the same time that the S&P went lower. So that's what I call SMT. SMT, I've never really settled on a name specifically what the SMT stands for. I've interchangeably used smart money technique, smart money tool. Okay, and that's why it's always just referred to as SMT, because otherwise I would have had the full 3 words as the name. But creating a language for y'all when I was on Baby Pips, that's what we settled on, and that's never really changed. But that divergence there was enough for me to look at this liquidity as a raid, especially if we run a short-term high, which is what we get. Let me minimize this. That short-term high right there, it runs through it there. Once it runs through it, let me zoom in a little bit more. All right, this short-term high right there, we run through it there, that candle. So we have technically a shift in market structure that's bullish. Now, a shift in market structure, this is where your notes. Oh, you didn't bring your notepad. Well, send yourself a text. A market structure shift is just a short-term change in market sentiment, and it will deliver on a short-term basis. A market structure break is where the entire tide of the marketplace changes, and we go into a longer, higher time frame delivery of price, where if it's been bullish, and then we have a break in market structure that's bearish, then what we're saying is there's a change in trend, if you want to call it in retail logic. A shift in market structure is not equivalent to an outright reversal. It's just a change in short-term market sentiment. And that's all we need to capitalize on in terms of intraday price action. So when we see the short-term high changing here, right there, that candle, once it passes through it, this is for your notes also, a shift in market structure does not require a higher close above the short-term high. It just needs to trade above it. The algorithm is not basing its next run on price because it closes above that. It just needs to run through it. Once it does that, that trigger now starts a macro. Macro is a short list of instructions that the algorithm is of intraday.
Wow, there's some sauce right here.
Price action. So when we see the short-term high changing here, right there, that candle, once it passes through it, this is for your notes also, a shift in market structure does not require a higher close above the short-term high. It just needs to trade above it. The algorithm is not basing its next run on price because it closes above that. It just needs to run through it. Once it does that, that trigger now starts a macro. A short list of instructions that the algorithm will run in the price engine that creates these fluctuations in price. It matters not how much buying and selling pressure. That's a misnomer. It's a lie. Okay, that is not how these markets book. I don't care who tells you otherwise. Okay, it's not the volume. Because if it was the case, then why do we study volume? And price is going higher, making higher highs, but volume is receding, going lower. The volume didn't put it up there. It's being booked there. It's being priced. It's being offered there. Regardless of how many people buy and sell, it doesn't matter. Markets do not top because it runs out of buyers, and it doesn't bottom when it runs out of sellers. You have been lied to. I know it's hard to take that. It sounds, what? There's no way this guy. I'm telling you, spend the rest of the year with me. You're going to be convinced of it. I promise you're going to be convinced of it. In fact, hold me to it as a challenge. I guarantee you I'm going to convert you, at least in that respect. So once we get below the sell side here, we run through the short-term high. There's a shift in market structure. Now it's bullish. So your eye goes to what? My eye goes to where's liquidity. So the first thing I want to look for as I pan back is I want to look for, is there a relative equal high, something smooth? Well, these highs are basically almost the same, right? So it feels like a ceiling. If you're in your room, if you're indoors right now, look up. You see the ceiling where you're at? That's like being down here, looking up to the ceiling. That's the ceiling right there. Retail thinks that's the highest it can go because that's what the books tell them. They say in their mind, okay, this is the highest it can go because that's resistance. I train you to think it's going there and going above it because that's exactly where the money's resting. That's where the victims are holding up signs. I'm heading to Loserville. Give me a ride. Okay, that's a hitchhiker I want to pick up every time. When the market trades down to the sell side here, and then I'm watching, does it shift bullishly? There's a shift in market structure with that candle right there. It does not need to close above it. So now, in my mind, I go back through what just took place. Well, we just ran sell side. We have S&P divergence. Not using an indicator, just comparing correlated markets. The Dow, the NASDAQ, and the S&P. I'm comparing the price action between those three. Those three instruments. If I'm anticipating the likelihood of something bullish, I'm already expecting the S&P. I'm not using the divergence as a trade selection. It's a confirmation tool. It qualifies something that I had already anticipated. This was there's three instruments. If I'm anticipating the likelihood of something bullish, I'm already expecting the S&P. I'm not using the divergence as a trade selection. It's a confirmation tool. It qualifies something that I had already anticipated. This was too smooth. We were going below sell side. We went through it. If we went through it and we didn't diverge, and if the NASDAQ made lower lows with the S&P, then I would not expect this. So then some of you are probably thinking, can you just tell me what you were trusting and what you wouldn't have trusted? I just told you. If the NASDAQ would have made a lower low like it did here in the S&P, I would not have gone long, even if it went above this short-term high here, because then I would have expected this fair value gap to be something to be monitoring. But because we had that divergence with the NASDAQ lows not meeting the lower low that we see in the S&P here, then I want to watch and see, does it show its hand to me? Does it tip its hand to me and say, Michael, this is what I'm about to do. I'm going higher. Get on board. I'm going to give you a fair value gap. it runs above the short-term high here, there, and as it's coded, just like it's supposed to, this candle's high. Look at this price here, okay? Right up here. This candle's high, and this candle's low. That's what I'm framing here. That's the fair value gap. Now, it drops down. What time is this? 9:45. That's when I told you the news was coming out. Now, that news report, I'm not afraid of that kind of report. It's not the same thing like a CPI. CPI will rip your face off. Like, it's you do not ever want to be trading ahead of the CPI number. Ever. You don't ever want to be trading ahead of a rate announcement. Ever. Because it will tear your limbs off. You don't want to do that. But other market reports, they will just be fuel to something you already anticipate and see. So this 9:45 candle, notice it does wick through the fair value gap. But does it take out the low? No. Your stop could originate here at that low, buying this candle's low. That's your first entry. You can use that. You can use the consequent encroachment, which is the midpoint of the gap, which is this one candle. So when I'm talking about things on Twitter, I'll say ES 1 minute chart, and then I'll give a 09:42. I'm not saying I did it for this one here, but the other ones I'm going to refer to, I did. If I'm telling you 09:42, and I'm telling you 1 minute ES, I'm telling you to look at the ES chart, find that time on the axis at the bottom of the chart, and put it right on that candle, and you'll see exactly what I'm looking at. I won't have to say this is a buy. I won't have to say this is a sell. I'm just saying watch that. Note that, because you want to annotate that in your chart. And then watch how price reacts and goes towards what we're looking for, which was, I tweeted after the S&T divergence, I said, note the 40.28 level. That's buy side. So the market dips back down into this area here on the news, comes back up, and the candle closes here. The next candle opens, trades one more time. What's it trading into? The fair value gap one more time. This is the only other opportunity you have. If you're going to be using that fair value gap, you got to buy it, smack it right as it goes into that candle's low right there. It goes a little bit past it, but not much. But what is it really reaching for? Look at this wick from the high, I'm sorry, from the low of the body, which is the closing price, to that low. Eyeball half of it. Boom. And it's also inside the fair value gap. When you watch me talk about price live, you'll see me refer to these things as they happen. And you're going to be floored how it respects and responds to many of them. I'm going to get it wrong. Don't get me wrong, because I'm looking at 1 minute charts. 1 minute, there could be something that happens, a little flurry of something that comes in, and I'll be off. Okay, no problem. But I have no fear of doing it with you, showing you that this is what you can do. Then it rips through this short-term high. This is a bullish breaker. What is that? The low here makes the high, and then a lower low. So this move up, you were focusing on the highest up close candle. Extend that range out. So as it's digging into this here, this is a return into that bullish breaker. If, okay, this is what some of my trolls and detractors like to say. Oh, this is only an old high, it's resistance, broken, turn support. Here's how you classify retail support resistance as the real levels to be trusting, okay? If that high has a low prior to it and a lower low after it, after this high forms, then it comes back down to it, then yes, you can trust it as resistance, broken, turn support. The narrative behind why it should be that way is what makes my breaker the breaker. It broke anyone that was holding stops below here. It went lower than that and then ripped through this short-term high. This in itself is a shift in market structure. Notice that? Same event is occurring with this short-term high here when that candle passes through it, is occurring with this high, with this movement right there. The logic is that we've done damage with this candle being a high here. It took out and broke. It broke the backs of anyone trying to go long on that low. When it ripped up higher like this, then it went down one more time to knock them out. There's liquidity taken here and absorbed. What kind? Sell side. Who would want to take out sell side? Individuals that want to go long. Smart money. Buying those sell stops up. They're being counterparty to it. And then using the fair value gap as it drops into here. And then one more time here. And it rips through the short-term high here. Let me take this off. And it comes right back down into that high. But more specifically, it's a bullish breaker. And old high, yes. And there's a fair value gap right there. You have three things qualifying that level. Now compare and contrast that with Larry's school of logic in trading, retail books. They're cherry picking levels in the past. Look at this trend line. This diagnosis is how you could have bought this. I thought all that stuff in the beginning. I thought that's exactly what people do. I thought that's how it was going to be profitable for me, and I couldn't make it work. So I had to go in and figure out really what's going on. So when we trade back down to this high with the fair value gap, and it's a breaker, look at the perfect close. Look at this right here. Look at this price right there, folks. Watch that price. When this candle's high, what is the high at? 4020.50. This movement back down into the fair value gap. What's the low of that candle? 4020.50. Folks, listen. I'm not aware where you're at, what neck of the woods you're from, what country you're in, okay? But perfect is perfect. It's not a fluctuation short. It's not a fluctuation past it. It's dead ringer right on the actual tick. I'm sorry if it hurts your feelings, if it doesn't line up with your treasured guru mentor, okay? I'm sorry. But this is it. This is the thing you're looking for. You're looking for something that works, that you can trust the logic behind it, and you want something that is delivering with no opportunity to improve upon. This is it. This is the reason why I talk to you the way I talk. And it sounds arrogant, but it's just confidence. I know what I created. I know what I'm holding in my hands, and I'm giving it to you. All you have to do is spend time with it. And you'll fall in love with it. I promise you. I promise you, you will fall in love with this. But if you sit on the side, tick. I'm sorry if it hurts your feelings, if it doesn't line up with your treasured guru mentor. Okay? I'm sorry. But this is it. This is the thing you're looking for. You're looking for something that works, that you can trust the logic behind it, and you want something that is delivering with no opportunity to improve upon. This is it. This is the reason why I talk to you the way I talk. And it sounds arrogant, but it's just confidence. I know what I created. I know what I'm holding in my hands, and I'm giving it to you. All you have to do is spend time with it. And you'll fall in love with it. I promise you. I promise you, you will fall in love with this. But if you sit on the side and just hold on to your fear and struggle with the work ethic that's going to be required to learn it, then obviously, it's easy to cast judgment because it's easier to talk about something you haven't really worked for. But everybody that's worked for it and that's got it, they don't care who believes me, who doesn't believe they're doing it. You're not going to either. But you're never going to get to that stage until you press through. This right here by itself is a trade. It moves from 421.50, which we'll just do the low. You could have went long on that at the low, using the logic I already taught. I'm not cherry picking anything here. 40.21 and a quarter. All it has to do is trade to that level there. You could be a buyer. From 40.21 and a quarter, right there. It doesn't even have to go into the old highs back here, which is what it was going to be aiming for. But this candle here, as soon as it trades to 26 and a quarter, right there, that price right there, bumping above these relative equal highs right there, that's 5 handles. And you don't need to be right about trading to the buy side liquidity. That's the difference between worrying about profitability versus being right. You can be a buyer down here on the breaker in the fair value gap, run the short-term high, and not need these highs to be taken out. If you can get 5 handles in that, guess what? That's exactly how you start. That's how you start. That's your first rung objective. Your expectations on what is it you're trying to do as a trader, that's what you're trying to do. Know where it's likely to go, what you're reaching for. Where's the market more likely to go? I'm giving you that with my tweets. I'm telling you. I'm telling you where the market's likely to go to next. It won't be 100% of the time. Nobody's 100%. I'm not. I've never said I was 100%. But I promise you, you're never going to find another person walking this planet that's going to be as more precise as I am. And that ruffles feathers, and I don't care. You got something that's better, bring it. But 5 handles is an easy, low-hanging fruit objective. But once it clears those buy stops here, above those highs, right here, paid the trader. That was the tweet that came out. 40.28 hit, done, booked, it's over. Move to the sidelines. But what if it, who cares what if? That's not the next trade. And that's the other thing I want to talk about. Every time I do something and I call it and it pans out, there's always this flurry of the same people. Franklin, does this mean that we're going to go short now? Like, I'm sitting here buying and selling every swing high. I'm not doing that. I can. I've done that before. But that's not what I'm promising you this year. I'm promising you how to go in, find low-hanging fruit. Something you can go in there and get 5 handles. 5 handles. 5 handles on one mini is $250. Do you make $250 in a day working your job? I'm not trying to be rude, but do you make $250 a week? In some countries, you aren't. And you don't need to have these extremely irresponsible mentors out there trying to tell you that you could be making 6 figures a month, or that they're aspiring to make 6 figures, and therefore, because they're saying they're trying to do it, that means it should be realistic for you to try to do. I don't do that, folks. But what I'm saying to you is, what if you could just find one of these per week and had the diligence and responsibility to stop for the week, and you did it every week, every month? Wouldn't that help you with your utility bills and maybe your car note? How much of a life-changing impact would that be to have that thing off your neck every month? If that's all you got, your grocery bill was paid for. Wouldn't that mean a whole lot more to you in terms of building your confidence to keep doing what you're doing and grow from that same 5 handle? Yes, it would. And if you're saying no, it wouldn't, turn this video, don't come back to my channel again, because you are a gambler. I cannot work with gamblers. I'm not trying to promote gambling mindset. I'm not trying to promote somebody get rich quick stuff. I'm not teaching that at all. But listen, if you take the things I'm showing you here and you want to get rich, who's stopping you? I'm not. Nobody else will be. Only you are. But I'm not teaching you that. I don't want you walking into this thinking, I'm promising you getting rich. I'm promising you you're going to work your rear end off. Because you have to overcome a lot of these character flaws that you're going to have, that you don't even realize you have. But you can make this into whatever you want it to be, big or small. Now over here, this low here, this random reaction. Let's take a look at the hourly chart here. All right, so I tweeted this also. I said, pull up on your hourly chart, your 60-minute chart, the Monday 23rd of January's hourly candle. Note that that's a fair value gap. Okay, that rectangle is the same rectangle that's being shown over here. This chart that I'm looking at, the big one on the right hand side, that's a 1 minute. The same market is over here, just being viewed from an hourly chart. So every candle represents the interval of the highest high and the lowest low of each hour. The candle on the bottom lower left, each candle represents the highest high and the lowest low.
I was gonna screenshot the chart.
then it rips through this short-term high. This is a bullish breaker. What is that? The low here, this low here is a random reaction. Let's take a look at the hourly chart here. All right, so I tweeted this also. I said, pull up on your hourly chart, your 60-minute chart, the Monday 23rd of January's hourly candle. Note that that's a fair value gap. Okay, that rectangle is the same rectangle that's being shown over here. This chart that I'm looking at, the big one on the right-hand side, that's a 1 minute. The same market is over here, just being viewed from an hourly chart. So every candle represents the interval of the highest high and the lowest low of each hour. The candle on the bottom lower left, each candle represents the highest high and the lowest low of every 15-minute candle. You can see that rectangle here. If I take it off, watch, it disappears from the other charts. If I Control Z, they'll go back. So it's going down to that level based on the hourly chart. It trades down to it here. It trades down to it here. That reaction is what I tweeted. I said, note that when we were inside the fair value gap here. I taught last night that you can look for inversion levels. If you extend the fair value gap in time, look where the bodies are collected inside the fair value gap. It trades right back up to this candle's low, does it here, hits it, hits it, hits it, hits it, breaks lower. Goes exactly where I said in a tweet on Twitter, the hourly fair value gap. There's 5 handles there. So 10 handles offered without really expecting a lot in terms of risk. There's risk every time you take a trade, obviously, but in terms of movement against the idea, once I tweeted it, very little fluctuation or what would be considered drawdown. The market then rallies, returns back up into the area of what? Let me make this larger again. It returns back to this pool of liquidity there. Then it comes right back down into this right here. Take this off. This candle here and this candle here is one order block. An order block has nothing to do with the depth of market or level 2 data. It has nothing to do with actual orders. When I say it's an order block, what I'm saying to you is the algorithm refers back to this as an order block. It has nothing to do with mitigating. Order blocks don't get mitigated, okay? The market, when it trades back to this level here, you want to take the opening price, extend that in time. I hope you guys like it. I'm having fun today. Hope you're learning something.
Sure am, Michael.
All right, so this order block, okay, this run lower and then shift in market structure. Where does that occur? Right there. That candle right there. It's a shift in market structure. What took place? The sell stops or sell side liquidity resting below here has been purged. So if we take this level here, put it right there. I told you when we were here to put that level, the blue shaded area on your hourly chart, to note that. If it was up here and I tell you down here, where's my bias? Down. How far? To that fair value gap. Once it hits it, what do? You log it. Does it offer 5 handles? If it does, you annotate your chart and you say, this is what I seen, and you put in annotations like you observed it with foresight before the fact. And by doing that and putting it in your chart, technically, if you're going to be highly critical, you're technically lying to yourself in your annotations because you're giving yourself positive self-talk like you saw it coming. When you look at your charts on the weekend and you refer to your annotations, what's actually happening is it's very aesthetically pleasing to see positive self-talk in your charts, but it's also subconsciously reinforcing the positives of what it is you're supposed to be retaining in price action. And you're teaching yourself subconsciously to remember these things as what? Worthwhile endeavors. Not, I'm afraid that I'm going to get it wrong. Do you see what just took place there? There's a subtle shift, that paradigm shift is required for people to filter out negativity. Never invite it in your annotations or your logging in your journals, or even in your social media posts. Never post regret. Not because I don't want students to see that they're failing. No, that's not what I said. You can say, I lost on this trade. I did this and it didn't pan out. Okay, great. But it's also subconsciously reinforcing the positives of what it is you're supposed to be retaining in price action. And you're teaching yourself subconsciously to remember these things as what? Worthwhile endeavors. Not, I'm afraid that I'm going to get it wrong. Do you see what just took place there? There's a subtle shift, that paradigm shift is required for people to filter out negativity. Never invite it in your annotations or your logging in your journals, or even in your social media posts. Never post regret. Not because I don't want students to see that they're failing. No, that's not what I said. You can say, I lost on this trade. I did this and it didn't pan out. Okay, great. That's responsible. That's also sharing the community. Hey, look, I tried it. It didn't work, and I'm moving on. Not, I blew it today. I'm so stupid. I'm going to quit. I can never figure this out. This is so dumb. I'm done. You know, do you see the difference between that and the former? It's too toxic. People reading that, I guarantee you, they're thinking, man, this person's a wreck. And you are if you're doing that. Because what you're trying to do is you want to be coddled. I don't coddle. I'm going to tell you if you made a mistake, I'm going to say, okay, log it, learn from it, and don't repeat it. It may sound insensitive. Maybe that's not the response you're looking for. But the response you're looking for, the sugar-coated, candy-coated ICT mentorship guy, that doesn't work. Okay, that does not work. Candy-coated mentorships and mentors are never going to give you the meat and potatoes that you want on your bones as a trader. There's no way to say it other than that. You want the real truth? The real truth is, this is hard. You're going to earn it. It's going to feel uncomfortable sometimes, and that's normal. You press into that. And every time you do, and you get more insight and more confidence, It's harder for you to be defeated by yourself, your old self. That old self has to die. You got to put it down. And you're going to renew yourself into a new mindset, replacing positive. Everything in your life will become, you're seeking the positive. And you're going to take a different approach in everything you do because of what you do with your money in this trading endeavor. It's going to transform you into something totally different. And you won't even recognize yourself at the end of the year. You won't recognize you. And that's a good thing. Don't be fearful of it. But this down close, these two down close candles, that's an order block. The algorithm, what's doing is once this shift in market structure occurs here, like it does right there on that candle, right at that moment there, the algorithm says, okay, I need to reprice higher. It's going to start booking price higher. It doesn't matter, folks. Jim the Trader on Instagram, okay? It doesn't matter what he says. His cousin used to be a broker. His guy's nephew, son, sister's a market maker at UBC or whatever. Whatever the hell that you're going to try to tell you. I don't care. All of the things I'm going to show you real time this year is going to fly in the face of everything else out there. And I want you to figure out, if it's not what I'm telling you what it is, and proving it over and over again, then what on earth is it? Because it's not retail. It's nothing in those books. But you have to see it. You have to handle it. And once you see it and you handle it, you're like, oh no, this is something totally different. And that's what happens when people come into this content. It's infectious. It's sticky. You can't get it off your hands. You want more of it though. It's like cotton candy. This return to this order block, the market will want to do that. Once it does that, it accumulates buying opportunities. Let me say it better. It provides smart money to accumulate long positions when it returns to this. The algorithm is not waiting for long. The market will want to do that. Once it does that, it accumulates buying opportunities. Let me say it better. It provides smart money to accumulate long positions when it returns to this. The algorithm is not waiting for smart traders to buy, and their buying is not propelling price higher. It's going down there based on time. It goes down to it here, pulls away from it, and goes down to it one more time. It's spending time allowing individuals that are privy to what I'm teaching you, what I'm showing you. There are people that are waiting for this opportunity. That is what they're paid to do. They are bank traders. They are not JP Morgan traders. They're not Goldman Sachs traders. They're at the bank. Oh, but they won't. Not for this discussion. I don't care if you believe it. I'm not here to try to twist your arm in regards to
What's the net
But
P&L?
this run
I haven't
here,
been
this
trading.
high,
I've just
on
been
this run here,
reading the
on order
tape.
block, when it has a shift in market structure on that candle right there, when it moved up, did it take out that high? No. What did it leave there? Buy side. I was talking to you earlier, and you'll hear it in the recording, you'll see it in the recording. I mentioned that there's buy side here. Be mindful of that. Okay, and I went back to my conversation. The market drops back down into the order block. The algorithm offers the opportunity for traders that are looking for it to get in. Reprices higher, rejection block, retraces back down to the order block. Once more, what's it doing? It's allowing smart money to accumulate inside the order block. What else is it doing? For supply and demand, folks, fasten your seatbelts. We're cutting through some candles. Oh no, we're going back into that area of inefficiency. It was inefficient in what? Sell side. It went up. It offered it here. Okay, is this balanced? This range here, is this range here balanced at that point? No, it's only balanced when it comes to it and leads it now to balanced price range. This is an entirely different endeavor of running out liquidity that's formed here. It does not cancel this out. If you've gone through my core content, I teach you the PDRA matrix, and there is a 20, 40, and 60 day look back. And there's a 20 and 40, 60 day past forward. The algorithm refers to things in that scope. And I could obviously turn this into a whole all-nighter here and teach and teach and teach. And it's just going to give you more things, especially if you're new. This is the first time you watch me. It's going to seem like it's too complicated. And it would be viewed as complicated for anyone that hasn't really spent any time with me. But for the folks that have been here for a while, this is already starting to make a lot of sense to you, and your gears are turning like, oh my goodness, I see it, right. It's going to keep repeating too, every week, every day, and it won't stop. I'm not changing anything, okay? It will not stop working. It will not. Trust me, the markets will cease to exist before this stops working, period. If I believed by making it public it would change or stop it, you never would have heard of me. So it trades down into the old fair value gap. What is it offering? Sell side again, here, and the order block. So how many factors do you have here leading to the likelihood of these relative equal highs, much like they were over here? What's above here? The same thing we have here from a narrative. We have buy side. What did price do from here? Drop down to what? To that low. Why did it do that? It took out sell side. Why would it be advantageous for the algorithm to reprice all the way down there? You're trying to tell me that only short sellers came in here, nobody bought. And that's what drove price down exactly to the fair value gap that I outlined beforehand. So every trader out there knew the fair value gap. You all just discovered it this year. My mentorship students learned about it in 2016. I've been using it for 26 years. So you're wrestling with trying to find a rhyme and a reason as to why I can do this and why my students are able to do this, and you can find another similarity to something else and lean on retail logic as to why the market's booked. Oh, it's just auction theory. No, it ain't. Oh, no, it's not. It's not. Anybody that sits down and does the work of going through what I'm teaching, that's dismissed immediately. The volume of how many contracts are traded is irrelevant. When they want the market to go to a price level, it's going to that price level, regardless of how many buyers and sellers there are. Why would it be advantageous for this level to be taken out? Because it's allowing traders that would be looking for higher prices, keying off of that discount array, which is the fair value gap on the hourly chart, that blue shaded area down here, that I tweeted beforehand, before it even went there. Look at the turning point of that. Is that not beautiful? When I was a younger man, when I first started to learn how to trade, I never imagined that there would be this level of precision available, that anybody could see it before it happens. And you all get to walk with me every day, every week, and I'm showcasing it. No deleted tweets. It's all there. I'm bringing the receipts all year long. All you have to do is start paying more attention to it. And what does it mean to you? What is it communicating to you? Because there's lots of trades here based on what I just shown. There's many trades you can take. But this movement here was the catalyst that sent us up into the buy side liquidity that I talked about in this live stream. That's where it's going to go next. What does that mean? It's not going below that low. Your focus was placed up here. Did it not do it? It did. Is it a big deal? No. But to a new student, for a new viewer, a casual viewer, well, that was kind of lucky. We get lucky a lot around here. Like it's a recurring phenomenon around here. I don't personally believe in luck, but it is what it is. But then we run from the order block up to and through that buy side liquidity. Runs above it, comes back down, works inside this range here. What's this down close candle? What's this right here? It's the same thing this is. It's an order block. It has absolutely nothing to do with how many contracts are bought or sold. It has nothing to do how many orders are resting on the depth of market, the DOM, using ladders and stuff like that, market profile, point of control, all those things. I am not a believer in that. If you make money and you use that stuff and you attribute your profits to that, then well done. That's what you believe, that's what you subscribe to, and I'm not going to have any ability to defer your attention to anything else if that's what you subscribe to. And you shouldn't even pay me any mind. If you're making money, it's irrelevant what I say. No matter what it is you use, if you're making money, don't tinker with it. But don't say that that's what's making the market go higher and lower, because then we will argue. But this is an order block. Okay, it's a down close candle prior to the change in the state of delivery, which is occurring right at that opening price. Stay that out in time. As soon as that price is touched and crossed to the upside, that is equivalent to a market structure shift. At that moment, this entire range here becomes sensitive to future returns to it. And I'll explain that in a minute. Man, ICT's pulling out a clinic. The price action clinic today. So down close candle, displacement to the to the upside. Watch that opening price. Why is the opening price? Well, because there's no wick. Well, why did you use the opening price down here, ICT? Didn't think I'd get back to that, did you? Why did you do it on the wick? Because whenever there's a short little stubby wick like that, I just immediately go right to the opening price. That's just because I traded Forex, and Forex has a lot of spread issues, and that was where I adopted the rule set. There it is. But the hard and fast rule is if it's a really little small little wick, just go to the body open. Market trades down into it here. Look how much around the midpoint of that candle, which was mean threshold. Half the rule is immediately go right to the opening price. He's pulling out a clinic. The price action clinic today. So down close candle, displacement to the to the upside. Watch that opening price. Why is the opening price? Well, because there's no wick. Well, why did you use the opening price down here, ICT? Didn't think I'd get back to that, did you? Why did you do it on the wick? Because whenever there's a short little stubby wick like that, I just immediately go right to the opening price. That's just because I traded Forex, and Forex has a lot of spread issues, and that was where I adopted the rule set. There it is. But the hard and fast rule is if it's a really little small little wick, just go to the body open. Market trades down into it here. Look how much around the midpoint of that candle, which was mean threshold. Half of a gap or inefficiency is consequent encroachment. It's the midpoint. If we have a order block, that's not a gap. That's not a fair value gap. It's a specific range in one candle. You split that in half, that's mean threshold. Look where they're going right here with these candles. Boom, half, 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 half. And then breaks higher. What's occurring right on this candle? Let me zoom in here because I want you to really get this. When I'm watching my real-time trades pan out, and you see the recordings of it, and you see me annotating as it's going, and I'm drawing lines on it, and I'll say I want to see it run from here, and I want to do this. I'm doing all that with 1 minute candles. So I'm looking at price, internalizing, receiving what it is I'm seeing in price delivery. Then I'm articulating a way of communicating it to you. Then I have to go to my keyboard, then I have to type it out, and then sometimes I have to correct the typos, and then still maintain my focus on the chart. Now imagine all that going on with somebody that has attention deficit like I have. It's hard. It's very, very hard for me to do this, to communicate it on a 1 minute chart. There's no way to fake that. There's no way I could be managing another chart somewhere else. I have, well, right now I'm staring at 8 monitors in front of me, but I'm holding a laptop. This laptop is away from my trade desk, but I'm in the room with them. Those screens are not even on. And when I'm doing everything through the recording with Camtasia, I'm recording, and I only record with a laptop on a ISP that's only synced to this one. My trading computers are using a different ISP. I'm never going to record off of those. You're never going to see my TradeStation charts. You're never going to see those things. You're not. So don't ask for it. I'm not making you that close of a friend to me. Okay? It's not to be rude or anything, but you don't need to see those things. Everything I'm teaching is communicated through TradingView. And I'm using a laptop because if I do get hacked, which I've had multiple instances of since 2006, they're not getting anything here. There's no credit cards. There's nothing personal, nothing. It's just the ISP connected to YouTube and TradingView. That's it. That's it. So I had to say that, I'm sorry. But when we leave this consolidation inside this order block, okay, it drops down into here. Mean threshold is half of the order block, so half of this range. I'll show you that. This is what you want to do with your fair value gaps and what you think is an order block. So 40.27 even. Okay, 40.27 even. In my mind, I'm watching on a bullish order block. I'm watching the high to the midpoint. I want to see it show a willingness to support price, preferably hit it and quit it and run the other direction real quick. That's what I'm really looking for. But if it starts doing this, and as long as it's respecting that midpoint down here, I'm okay with it. I'm more specifically going to be watching if it starts to consolidate. I'm going to go in with like 6 contracts. I'm doing my typical go in, I buy 6 contracts, I'm going to parlay it up and build a bigger position. What would I do? In this instance, using the order block, I'm going in right there at that price. I'd be going long on the first return to it there. So I would go long 6 contracts there. As it's digging down, I'm going to watch. Does it want to go to the mean threshold? Mean threshold is half of an order block, or half of a breaker, or half of a mitigation block. And go back through my core content, and you'll see all that stuff. It's on the YouTube channel. Then I would buy 3 right here on this candle as it hits the mean threshold. So now would be long 9 contracts. If it runs like it does here, and then one more time pumps into it one more time, then I'll do my one last contract, and I'd be long net 10 contracts. 6, 3, 1. Hoping that I can get the little wick through, the midpoint, trusting that it isn't going to go to the other side. See, you're thinking, how do you know ICT? You didn't think I was going to know that, did you? How can you trust it, ICT? Experience, knowing that it's likely to do what I'm explaining here, and also being comfortable with being wrong. Because I can be wrong and be profitable. I can be right and be... not as profitable as I should have been. There's a gray area where experience dictates the outcome. And I don't make any sugar-coated claims that make you not understand it's going to take you work to study this. But over time, you'll see it, and time does its work. But when we see this range here, the midpoint of the order block, once it leaves it, okay, once it leaves that, what's this candle right here?
Propulsion. Give me that easy.
This is a propulsion block. It's an order block within this order block. So it's a nested level. I love this formation. I love it. Let me show you why I love it. What's the opening price? What's the opening price on that candle right there? You should see it right up here. 4029.25. Okay, 4,029 and a quarter. That price to its high, right in here, that is one of the most sensitive bullish order blocks. Responsive, quick, sudden, like you want to see a dynamic movement, it's going to really do it on this. Like, show me the order blocks that work. Well, here's that lesson. Here's that lesson, folks. You're probably listening to me driving your car, or you're working your forklift. Formation. I love it. Let me show you why I love it. What's the opening price? What's the opening price on the candle right there? You should see it right up here. 4029.25. Okay, 4,029 and a quarter. That price to its high, right in here, that is one of the most sensitive bullish order blocks. Responsive, quick, sudden, like you want to see a dynamic movement, it's going to really do it on this. Like, show me the order blocks that work. Well, here's that lesson. Here's that lesson. Folks, you're probably listening to me driving your car, or you're working your forklift at work, scooping out ice cream at Bob Evans, or maybe not Bob Evans. What's the ice cream place now? I got to figure this out now. I can't go past it now. Baskin Robbins, that's what I was thinking of. Wherever you're at, you're working. You wish you probably would have watched this with a notepad. But go back to just remember that we're talking about the propulsion block. This opening price to its high, that is the absolute most sensitive area in order block theory. What do you see? This opening price to its high, that is the absolute most sensitive. Area in order block theory. What do you see? What's the opening price of this candle? 4,029 and a quarter. It goes through it. It leaves it on this candle. Does it not? Yes. The next candle we open here. What's the low of that candle? You're looking at this price right here. What's the low? 4029.25. Wait a minute. Deja vu. Something different here. No, it's exactly the same. The opening price, 4029.25. Now I know. Pick your jaw up. Okay. Pick your jaw up. That again is exactly what I taught you in the core content lessons. Those videos were produced in 2016. It's logic that I coined in 1996. It's never been in any books. It's never been taught until I released it. You cannot improve upon perfect. You can't improve upon it. It doesn't fluctuate. It doesn't fall short of it. It goes right to the tick and does what? It delivers exactly the logic I teach you for a propulsion block. The run in price here, you have several things you can look at. You have the buy side relative equal highs here. Take this off. I'm having too much fun, man. You guys asked for these live streams, now you're going to be killed by them. Don't get on ICT. Don't get on I need to have a marriage. So we have buy side here. And also, what is the highest, look in here, look in this area here. What is the highest closing price? What's the highest closing price? Right there. I'm going to walk through the PD array matrix with you, okay? There. And what else do you have? What's the highest high? Right there. So this high, what have I taught you about that? Wicks are gaps. What? Wicks are gaps. Midpoint of that gap is consequent encroachment. It's 4,036 even. What is the closing price on that candle? 4,036 even. Yes, there's a small little wick. I don't care about that. I'm caring more specifically about the bodies, because the bodies are going to tell you the narrative. The wicks are where the damage is done. The bodies are what I'm looking for. That's telling me the storyline. What's the opening price of the next candle? 4,036 even. Can you improve upon that? No. What happens after that? Recedes and goes lower. Does it offer from this point here, buying into the propulsion block, from here to the first rejection block, right here, that's the first of your premium arrays. Does it offer 5 handles there? Yes. Why do you think I've been telling you 5 handles? 5 handles is all over the place intraday. It's all over the place. There's so many opportunities to get that. It's very forgiving for folks that miss a move. You can find it again if you're using a 1-minute chart. Oh, I see. I wish I would just be able to afford to pay my utility bills a month. Well, start mining this, and you might be able to do that. I can't promise it, but you might be able to do that. Let's go back to the propulsion.
Yo, what's good?
Right in here. What does it leave?
Got breakaway.
What is that? Let me do it this way so you can see it.
With the volume imbalance. Look at the volume
It's
imbalance.
very bad, isn't it? How do you know it's going to stay open? The propulsion block. This shouldn't stay open. It should stay. I'm sorry. It should stay open. It should not fill in. This would act as what? A breakaway gap. So if this is breaking away, I'm going to expect what? Price delivery to be more bullish candles, very little retracement, and maybe 1 or 2 down close candles. Everything else be what? Bullish delivery. Buy side being offered. How many down close candles do you have from the propulsion block to the consequent encroachment of the wick? You have 1 down close candle. Why is that important? You need to know the difference between signatures that are going to be favorable for you. If you start seeing a lot of consolidation and down close candles forming and booking in a price run that you're in, chances are you're probably going to get a retracement and come back on your stop loss, or it's not going to go in your favor anyway. So I'm looking at how does price continuously deliver. Is it giving me bullish candles? Is it staying bullish each time? With the exception of this candle here. Every candle was bullish. And I'm not worrying about all the little whipsaws back and forth, because I'm not going to ram my stop loss up there, theoretically, because I want to see it do what? I wouldn't even roll my stop up until this short-term high was taken out. Because above that is what? A very small pool of buy-side liquidity. Buy stops. Anyone that's short, they would trail it from here to here. And then we move back into... I wouldn't even roll my stop up until this short-term high was taken out. Because above that is what? A very small pool of buy-side liquidity. Buy stops. Anyone that's short, they would trail it from here to here. And then we move back into consolidation. And we're entering what time of day? noon. That's lunch. I teach that most of the time you're going to be squaring your position before noon. I'm not saying that I don't trade in lunch. I do. I have done it. But as a developing student, you don't want to be doing that because you don't know the characteristics that are part of that. All right, we're in the noon lunch hour, and at the time I've been going for 2 hours. More than 2 hours, like 2.5 hours. It doesn't feel like it. I mean, some of you probably think, man, this is a lifetime. I'm going to close this thing. I'm afraid I'm going to miss something. So it's getting on my nerves. It doesn't feel like a long time for me. It feels like I've been here for like 20 minutes. So if we were to look at the rest of the day, okay, we moved in a range that it looks as if we've already taken sell side here with this drop. This is a little too clean. I'm not trading the rest of the day, okay? But I would watch this area here. If it doesn't run for it, going into the 2 o'clock hour and it leaves this low intact, if this low stays intact, if it doesn't breach that low, I would look for the last hour trading to try to attack this. That's how I would look at it. Now that's just forecasting. That's not trading. That's not saying it's absolutely going to pan out. This is a little too clean. I'm not trading the rest of the day, okay? But I would watch this area here. If it doesn't run for it, going into the 2 o'clock hour and it leaves this low intact, if this low stays intact, if it doesn't breach that low, I would look for the last hour trading to try to attack this. That's how I would look at it. Now that's just forecasting. That's not trading. That's not saying it's absolutely going to pan out that way. That's how I would plan. Like I would go get something to eat and come back to my charts at 1:30 and see, does everything I just said exist on the chart? If this low stays intact and we haven't gone below it, and this stays like it is, nothing piercing it, then I would expect the final hour trading to reach for 40.38.
Did he actually get this? That would be crazy. We did pierce that before that, but still last hour trading.
And I would plan my afternoon like that. And if I come back and it has done that, then I would do nothing for the last part of the day. So that's how I plan my trades. That's how I plan my sessions. I think about the logic, and I just mapped out why I just said what I said. And if it's anything other than that, I'm not interested. It can do something. It could completely collapse and go down below 4,000 from where we are right now. That's not my trade. I'm not in that. I'm not participating in that. I'm not claiming to be in every single swing. I am claiming that you can find very specific surgical strikes with precision, and it doesn't need to have any indicator. Nothing that's going to be, in addition to. Anything that I apply to my chart is just lipstick to accentuate, dial in your attention to a very specific element of price. I don't have it on my chart. It's an adjustment for me to have these things while I'm watching price. I annotate them, and then I turn my attention to my other charts. Because if I look at things I draw on the chart, it's a distraction to me. I'm very obsessive, and it's very difficult. And you'll probably hear me vocalize that, in certain times when I'm doing the live sessions, because it will be something I wish I didn't have on the chart. But you're going to find it helpful to you because your frame of reference needs to be anchored on some limitation in price action. Not like everything that's been explained here doesn't even factor in all this over here. This is already done. This fractal is done. I've already outlined it, and you see when it's done. I've given you my expectation for the afternoon. This low, we ran out during the lunch hour. And it only took it 2 minutes to get into lunch hour to do it. So this drop down, I like that. I like the fact that we have relatively equal highs. I'm not trying to call a top in the marketplace, so I'm not going to arm wrestle that logic. What retail tries to do, they try to pick tops and try to pick bottoms. I don't do that. I look for where the obvious liquidity is, and the low here, they ripped through that in this low here. So we ran through that. This is not smooth anymore. It's jagged. Where's their smooth levels? It's here. And if it was to drop through this low, I don't do anything. I just take the rest of the day off. Now think about that for a second. Doesn't that sound like someone that has it put together? They're not just jumping around and reacting to price. They can plan their day. They can plan how they're going to engage the marketplace. They're not chasing something. They're not fearful of missing a move. I've outlined, if it does any of these things, then I'm not interested. Do you have that in your system right now? Chances are, if you're new, you don't. Those are things that experience teaches you. Consistently profitable traders, I'm going to say this and I'm closing, they have processes to get into a trade. That's without saying, obviously. They also have processes that keep them out of the marketplace for various reasons. It may be an economic. report that's due that's going to invite a lot of volatility, or it may be a expectation that the market does in fact do nothing, and it's not imperative for them to engage right now, and they'll wait for a later time for the market to get more animated, and then they'll participate then. They're not, and I'm not, and my students that have adopted this mindset, we're not worrying about missing a move. And if a move was to manifest itself and rip and tear off and do something phenomenal, and we aren't a part of it, we're not grieving over that. Because we know that we can find repeating phenomena in price action that are rooted in statistical probabilities that you can go back and see many times of that very thing occurring. But it's not the same thing as saying, like I've taught, and there's a joker out there on Twitter right now trying to make a name for himself because he's crunched some numbers. In my lectures, I teach that when it's in a bearish model, okay, it's in a sell model, the high of the week tends to form 70% of the time on Tuesday. If you take every week indiscriminately and look for, does it form the high on Tuesday between 2 o'clock and 4 o'clock in the morning, you're going to get data that doesn't support that. You don't even define what a sell model is. I do. So having that mindset, I'm not going out there every day thinking the high of the week is going to be on Tuesday or the low of the week is going to be on Tuesday between 2 o'clock and 4 o'clock in the morning. There has to be other factors that filter that. And that's what happens when people come into my content and they cherry pick things that they hear me say and they take it completely out of context. But then when you sit down with me and I'm outlining things real time before it happens, they get quiet. They want to talk about things that aren't true, and they're going to try to distract you. And you need to think about what it is that you're seeing, what you're witnessing, what you're seeing other people profit with real money. Is there more things here inviting you to dig deeper for free? Or is there warning signs saying, I better not touch this? This ICT content is a plague. We need to teach people to stay away from it. You're going to hear a whole lot more of that as the year goes on because you're not supposed to learn this. Right now it's just jokers and people that are jealous, but I'm telling you, watch and see how it just starts to manifest. There's going to be a lot more spotlight placed on the things that I'm teaching here. And there's going to be a whole new level of campaign to smear it. That's okay. You ain't changing anything. You ain't stopping anything because it's already out of the bag. It will repeat every week, every day, and it won't stop. I do hope you had fun with me today. I hope you had some learning. Hopefully you picked up some things and you've adopted some new approaches and techniques and thought processes. I just want to scan through real quick before I close. NASDAQ is ugly. And the Dow. Yeah, look at this. Look at this. You should be seeing the NASDAQ. That price action on the right-hand side, that right there is a day that says, don't touch me. Now, you might see that and think something else, but I'm saying that right there tells me, don't touch me. And because I say, don't touch the NASDAQ, what's closely correlated to NASDAQ? ES. So if it's a no touch on NASDAQ, then it's a no touch on what? ES. They have to confirm one another. If I don't see a sustained move in all three of the averages, and here's the Dow. If I don't see a justification for them to move in agreement, that gives me the market breadth to trust that we have a sustainable price move underway. If one of them acts like a sick sister, this one here's like a hobbling, bum leg. It's not doing all that much in terms of symmetry. It's just all over the place. Looks like a heart attack. That's your warning sign that you're probably trading with low probability conditions. So going back to ES, while I do believe that those highs could be taken out, because of what I've just shown you in NASDAQ, I'm probably going to be incorrect. So I've subscribed to something publicly, but I'm also communicating the reasons why I personally will not be going back in to take a trade because of what we're seeing in NASDAQ. Now, doesn't that disarm you? It gives you a reason to say, okay, I'm not going to be doing something, and I'm okay with not doing it. Not, I don't know what I'm doing, but I feel like I'm missing something. Big difference, isn't it? So that type of feeling, that comfort, comes from someone that's been doing it for a while. And traders that have been subscribing to me on my Twitter feed, they have been benefiting from that because they've seen a lot of, well, things that would otherwise be distracting, not really providing any clarity as to what they would expect, as a trader, what they would be doing as a trader, and how to think as a trader, and how to conduct themselves and think. And these are lessons you have to walk with someone doing it. You can't just read it in a book. It doesn't communicate well. You have to walk with that person doing it live, seeing what they would think about at this moment, at this juncture. Does the things that you were hoping to see in price action, does it still ring true now? And if it doesn't, why doesn't it? And if it doesn't, communicate why that's useful and how we can take that insight and move forward with it. So that way we won't hurt ourselves as students. That's my motivation. That's what I'm trying to do. Because I've already taught you how to trade. I'm not sure what just happened, but it's connected and reconnected, hopefully. I promise you, you will not regret having learned this. You'll do amazing things with this information in your personal life. Doesn't mean you're getting rich. It just means that you're going to do amazing things, and your direction of your life is going to change. You'll be more organized, the way you take on risk in every aspect of your life. And to me, that's a success. So that's it for this one. Hopefully you found it insightful. Hopefully you found it encouraging. And until next time, be safe.
See that? that right there, I don't know. I just like that's free. I would pay like $50 for that at least. So a lot of knowledge in there, and I'm actually gonna go over and then I'm gonna annotate this ES chart a little bit better, and then I'm gonna go over my notes, and then we're just gonna keep on going with the I'm just gonna keep on going with the 2023 mentorship. Honestly, I feel like 2023 mentorship is it's unbeaten. I don't know why that always goes off. Too smooth the highs at market open with SMT. There's a 1 minute fair value gap. 1 minute fair value gap. Is that contour encroachment of this wick on the 2 minute? Not really. Notice here we have that breaker, high, low, higher, high with an SMT. SMT confirms that bias. You get a fast repricing up to buy side. Jeez, bro. What's up with it? I need to find out where I have these notifications. I think I might have fixed it. All right. Oh, that. Oh my gosh! Look at that wick. Look at that wick. 75%. BPR. We leave a volume imbalance here. Notice how that gets traded to before the day is over. All right, I'm gonna fill out these notes. Let me turn on some jazz. Hello? Alright, that's chill, that's chill. I don't know how it is on stream, but it's chill for me. Man, I mess with this. I remember I never went over this. I appreciate it. Appreciate it. I will. I will. Hey, appreciate this up. Hey, appreciate this Aaron Ong. Being content with enough. My journal. I'm looking gonna do this in TradingView, this notes. Sorry, how did I just get a notification on Discord? Oh, I see. I kind of like that. SMT is just a confirmation tool that we already expect to form at reversal points. The market, because smart money drives the market, and it shows areas in which smart money is getting involved. The algorithm refers back to the oh. I forgot what I wrote a propulsion block. Hey, okay. There's that. There's all the notes finished. And now, we're just gonna keep on going in time. And I believe he's doing market reviews, so we'll probably watch those lectures, but for now. Yeah, January 25th, so we'll go over this action. Oh, I want to go on it. I want to go over it the next day. Okay, so we dropped down into a discount. Remember, we barely purged that fair value, 1 hour fair value gap. I think we might want to get a more meaningful run into that. Well, we might need to build up momentum to do that. Remember all the stops that were resting here? We had sell side. What type of daily level do we have? You have a daily balanced price range. So we're taking previous state or the Monday low, and we also are rebalancing into an inefficiency that we happen to stop at constant encroachment of, which also is oh, that's gorgeous. Beautiful delivery. Beautiful delivery. As price drops down into a deep discount into CE of daily imbalance, daily busy, which overlaps with a SIBI, creating it's a buy side of balance. It's just a bullish fair value gap. Be one of these. This is a busy. Wait, I never screenshotted that. pierced that low right at 10:30. Look at the body closing back up within that range. And we leave this as a breakaway. We trade into this. It overlaps with this fair value gap, balanced price range. And then we're drawing into this imbalance here, this imbalance here. Ooh, NQ has actually already taken this high. Tuesday we form SMT. So market originally opens here. We end up getting a Judas swing. We drop lower into a deep discount. 1 hour fair value gap. We end up changing state of delivery. Breakaway gap. Fair value gap. We don't form a 15-minute fair value gap on NQ, but we do on ES. And we just end up breaking away to buy side. Creating a large wick on this daily candle. This shows a lot of bullish momentum. So we have mitigation. Another level of mitigation. Too smooth of highs. As we can see, Low risk entry around 25%, 50%. We form a measuring gap. 75%. We have a silver bullet. That's beautiful. Reaccumulation, reaccumulation with the new day opening gaps. Wait, is this the 24th? It's the 25th. That's crazy. That's funny. Do we have SMT there at those? Ah, we did. And then we displaced higher off the low of that new week opening gap. Boom, straight to buy side. Buy side gets taken, and then we fall out of bed. Forming SMT as well. Look at the NQ. Wait. Yeah, that's definitely what I struggle with. Well said, T-Trades. Well said. I'm gonna be a little bit more active on Twitter. That was before the day began. What have you done? What model was it? Nice, bro. Nice. That's what I like to hear. Alright, we're gonna get into this review.
Good afternoon, folks. Hope everybody's doing well. Alright, so this is a quick little review, and this will probably be it for this week for me. I have a lot of personal things I have to take care of, and deal with my wife and our home. We have some things we have to still get unpacked and take care of that stuff, so my trading room still has a couple things and a gift that was sent to me I have to hang up on the wall. I promised the individual I'd have it done before I would show you my trading room, so I have that to take care of. Probably this weekend, I'll probably have it done by then. But here's the daily chart of the dollar index, and we were looking for lower prices, and this is the sell side liquidity pool I'm still looking for. It's been meandering around below this fair value gap, traded up into consequent encroachment, and then has had a reluctancy to want to go below this low. I suspect that tonight into tomorrow we'll probably get a large candle reaching down below that, maybe even digging into the 101 big figure. If this is in fact a sustained decline, this could eventually be where we reach for dollar. Okay, so that would allow for upside on euro and cable and other foreign currencies. All right, here's the euro dollar daily chart. Okay, and we've taken out the buy side, as I mentioned the last time we talked about euro dollar, and I mentioned that if it kept going, we would be reaching for the buy side liquidity. We're just in striking distance of that, and should we get animated to the upside, our city.
Hold up. Loki, you see this? Like, the suspect decline that we had yesterday? This decline on Thursday? We kind of could have expected further displacement because of DXY is now closed below these PD arrays. So we're like confirmed bearish here. I don't know why I never really thought of incorporating that into my analysis, but since DXY, I'm looking for these lows at least I am in that weekly imbalance. Like that, this is just a false drop, and we could have had a bullish bias even better. Understood the delivery here, the fact that DXY has had that decline like that, so therefore we could have just added that confluence to the trade plan, you know.
Here in the form of a fair value gap, right here in this down close candle, that would be the next draw on liquidity above.
Nice, bro. Nice.
Okay, so what would change this? If we trade below the mean threshold of this down close candle, so midpoint of that candle, draw that out in time. If it trades below that, then I'd probably more likely be reaching for this as a return for a equilibrium type short-term discount. It would be within this breaker, low, high, lower, low. We've never really come back to that except for a small little brief retest right here. Well, not a retest, but I call that a retrade. So it retrades to it and then leaves it. So if we do break below midpoint of this down close candle, then look for the breaker. Okay, but I'm specifically looking for buy side then this SIBI here. Let me also remind you, I'm not actually trading Forex. I'm just tossing this out here because I mentioned that I would be covering Forex for all of you that are still digging into those Forex pairs. All right, so we have the remaining balance of this sell side imbalance, buy side inefficiency with the buy side liquidity pool here, and here, and here. So it's really likely that we're going to punch through that. Look for 125, even big figure. Anything on the animated upside would be a buy side liquidity pool, resting around 126.67. What changes this? If we take out the low here. Okay, so I'm bullish on pound dollar unless we take out this low. All right, so NASDAQ, this is our daily chart here. Take your attention up to
Oh, he
this
came
higher.
back down to those
So
two down close candles too.
12,300.
That's nice.
Then the consequent encroachment of that wick, because wicks are gaps. Some of you are asking, what do I mean by a wick as a gap? The algorithm refers to a wick as a gap. And the gap will want to most likely be traded to its consequent encouragement, which is the midpoint of the gap. Not to be confused with a mean threshold, which is the middle some of you are asking, what do I mean by a wick as a gap? The algorithm refers to a wick as a gap. And the gap will want to most likely be traded to its consequent encouragement, which is the midpoint of the gap. Not to be confused with a mean threshold, which is the middle or 50% level of an order block. Okay, so my order block theory and gap theory are distinct. They're very similar in some ways, but they're very different in others. Okay, so as I mentioned, we'll go over more of it as we go through this year in 2023's mentorship. All right, and over here we have two down close candles, which is the bullish order block. If you look at the candle's high here to this candle's low, that's a buy side imbalance, sell side inefficiency. Fair value gap, but specifically categorized as a BISI, buy side imbalance, sell side inefficiency. The market trades down into it here and trades into the order block, the open to the high. So both of those levels here, be mindful of this blue shaded area is this imbalance from here to here on this single candle. And the order block are these two heavy blue lines, okay? So it looks like we traded down here, picked up a discount, pulled off the low, and we'll probably look to trade up into this level here, 12,149 even, tomorrow going into Friday. All right, so here we are on the hourly chart, and right away your eye should go right to this clean level here, relative equal lows, and here's that daily buy side imbalance, sell side inefficiency right.
Oh, dude, that's absolutely beautiful delivery. Beautiful.
Here, this blue shaded area. It's aimed at this range. That's what it's showing. The order block high in the open on the daily chart, that's what these levels are here. So you can see how we ran up, took out the short-term high, broke lower, we have a high, low, higher high, down closed candle is what?
Breaker.
Bearish breaker. Trades below it, comes back up, bumps it, sell off. Does. Sells all the way off to take out the sell side liquidity, and there's an imbalance here and an imbalance in here. And we're going to take a closer look at both of those. All right, here's the 15-minute time frame. You can see the sell side liquidity pool here. Too clean. Jagged edges are the result. Smooth edges like to be made what? Jagged. Okay. Fair value gap here. Mark trades down into that. Comes back up. Finds the support. Rallies through the short-term high. Trades up into the imbalance here. And what I'm
You're
watching
different.
tonight into
Appreciate
tomorrow
it. Appreciate
is, do we continuously press higher? It looks like you're trying to give like a 3 drives pattern, 1, 2, 3. I don't trust that. I really don't trust it. I feel like they're going to try to send it higher. I might be wrong, and I'm completely comfortable being wrong, but this feels like they want to send this thing higher.
Completely.
And this high, while it is a nice breaker, it actually has multiple breakers in it. We have the high, the low, the high, and this down closed candle. Project it forward. That's the reaction I showed you before we dropped down from the 60-minute chart to the 15-minute chart here. That was the reaction we saw dropping. But there is another breaker. High, low, higher high, just as well as you can use this here. High, lower, higher than this. The down closed candle, you project that forward. We traded into that. Okay, we went above a little bit here. Well, this candle's high right there. So I'm watching to see, do we disrespect this city? Okay, because this actually is a balanced price range. And it needs to get through that. Now, should we get through all of this range in here? And trade aggressively above that, then the levels I mentioned on the daily chart are within reason. Otherwise, we could chop around. I don't see a sell-off here yet. Like, I don't expect a big dramatic sell-off because we had pretty much that, overnight on the 24th, which I outlined real time, showing it in the charts where I see was within under 2 handles from the very high of the daily chart, making this rotation lower. When I was referring to ES, not the NASDAQ, by the way, but nonetheless, it's the same thing. All right, so here's the 15-minute time frame with the imbalance here. So we have sell side and the fair value gap. So it digs down into that, and it's also the low end of what? The sensitive price point of the bullish order block, which is the opening price, and the high.
I'm trying to make sure my stream title's right.
And then reacts. So let's take a closer look inside this area in here.
Yeah, it is.
All right, dropping down to the 2-minute chart. Why 2-minute chart? Well, to save time, and this is the chart that has all the details that you would have worked down through anyway. We have buy side here, smooth, relative equal highs, smooth, relative equal highs. Breaks, order block, trades back to it here, sells off, trades into our imbalance, digs in to the lower end.
This is all balanced. Like, look at how much time we spent within here. We then have a breaker, fair value gap,
which is the, what is that, the opening price on the down close candle on the daily chart, which is bullish order block. This is the high of the daily bullish order block. Okay, so that way, go back through this video a couple times. I promise I won't go too long with it, but this level is the opening price on the daily chart, down candle, at the beginning of the discussion for NASDAQ. We trade down into it, taking out sell side here, and then trades higher, trades back down into a fair value gap after sell side's been taken, and a higher time frame order block has been traded to. The market rallies, trades above short-term highs, so now we have a shift in market structure. Fair value gap here, trades down into consequent encroachment between the candle's low and the candle's high here. Midpoint is here, and we have a bullish breaker. So we have low, high, lower low, take the body of the candle, most uppermost candle, extend it forward. Okay, you're doing it with the up close candle, not the down close candle when you're using bullish breakers. Extend it through, you can see we're finding some support in here, consequent encroachment, and you want to see gaps like that in this stay open. It would promote the idea that you may be seeing a breakaway gap. Market rallies back up into last up close candle. This would be a breaker by any other definition, but because we are elongated from that high, in other words, it keeps stretching further. When we trade back to it and above it, it's mitigation. Okay, so what's being mitigated here? Any trader that's offside that was going long in here, they can mitigate that trade here. Order blocks and candles are not mitigating. Okay, I see a lot of people using the word a lot, excessively. Mitigation and mitigating is the action of the trader that is offside. Order blocks and candles are not mitigating anything. Price is allowing the trader to mitigate their offside position, mitigating potential drawdown, limiting it or removing it altogether. So that was the function of mitigation. Trades down until here. Also, we have a buy side imbalance, sell side inefficiency. This candle's high, this candle's low. We dip into that partially. It's supporting. Why didn't it all the way come down to this level here? Because of the mitigation block. Leave some of that open. Expect it to be institutional order flow entry here, which is a partial entry to a fair value gap before resuming higher. The market reaches up into the buy side liquidity here, creates a bullish order block, trades down until here, rallies, fair value gap, consolidates, accumulates more long positions, and then rallies away. What level is this accumulating longs at? At the high of the daily bullish order block wick. And down here is the daily order block opening price. So this is the high wick area of it. And then we have market rally up, order block retest here, and continues to move higher. Afternoon session on NASDAQ, dropping into still the 2-minute chart. New York lunch begins and ends. Here's that run from the order block, and then the fair value gap rally. Around the high of that daily bullish order block, wick high. Rallies, order block as I mentioned before we transitioned into the PM session slide here. Another institutional order flow entry drill right there. I don't have that noted, I apologize. Fair value gap with an order block, trades into it here. Rallies, order block cut through candles, folks. Bullish order block rallies, another order block, 1, 2, 3. Why do I only use this one candle here, and why do I use all of these here? Because all of these candles here are going against order flow. Order flow is bullish. So if there's a series of down close candles and we rally through it strongly like we do here, go back to that original high candle, extend it forward. We have an imbalance, yes. We have a potential order block here, but I'm not interested in that. Why? Because the candle's body on this one goes lower than that, at the high of the daily bullish order block wick. And down here is the daily order block opening price. So this is the high wick area of it. And then we have market rally up, order block retest here, and continues to move higher. Afternoon session on NASDAQ, dropping into still the 2-minute chart. New York lunch begins and ends. Here's that run from the order block, and then the fair value gap rally around the high of that daily bullish order block, wick high. Rallies, order block as I mentioned before we transitioned into the PM session slide here. Another institutional order flow entry drill right there. I don't have that noted, I apologize. Fair value gap with an order block, trades into it here. Rallies, order block cut through candles, folks. Bullish order block rallies, another order block, 1, 2, 3. Why do I only use this one candle here, and why do I use all of these here? Because all of these candles here are going against order flow. Order flow is bullish. So if there's a series of down close candles and we rally through it strongly like we do here, go back to that original high candle, extend it forward. We have an imbalance, yes. We have a potential order block here, but I'm not interested in that. Why? Because the candle's body on this one goes lower than that one. There's rules, there's levels to all this, folks.
Yeah, I appreciate it, Lorenzo.
The order block accumulates, rallies again, small little fair value gap.
Appreciate
here.
it.
This candle's high and this candle's low. send it through, accumulates longs here, 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 and then once more over here. Why? Because it needs to go higher. In that last hour's trading, the macro runs from 3 o'clock to 4 o'clock, trades down to the order block. Everyone thinks the high's in place, pumps it through, clears out buy side. Rolling on over into E-mini S&P. This is our daily chart.
Wow, that's nice
Obviously,
delivery
this is
too.
I just don't have it on the chart because I want you to see the distinctions between these levels. We have the consequent approachment of this wick, 41.17 3/4. Consequent approachment of this candle's wick, which is 4,072.75. Much like NASDAQ, we had accumulation from this original fair value gap here, bouncing, trading up to and stopping here. Most traders, like I mentioned, they would expect this to be a sell-off. We walked through this on live tweets and discussions and watching my commentary throughout the day. And then the market rallied through, attacking the buy side here. As I was mentioning, we would likely see the Twitter storm that I send out in terms of market commentary and things to pretty much keep your eye on and study, tape read via my tweets. The market does in fact deliver that. Then we had this move here. Okay, previous day we had this small little candle, which is what? An inside day. Inside day because its high is lower than the previous day, and its low is higher than the previous day. So we're going to get a large range day whenever we see this type of scenario. Now, I like the idea that we came all the way back down into this buy side imbalance, sell side inefficiency, this green candle here, and the buy side imbalance, sell side inefficiency fair value gap is framed with this candle's high, this candle's low. Split this candle's range between here and here. This is consequent encroachment. Look how nicely, it's beautiful, it's almost like poetry, how it just drops like this, hits the consequent encroachment, completely algorithmic, and then reprices higher. Now, intraday, this is going to look like it's going to hell. Oh, it's going to crash. Oh, it's going to, and so it feels like when you're watching these lower time frames, but you have to have a baseline on what the higher time frame daily chart is, because the algorithm is predominantly using reference points on this time frame here. So narrative is really closely linked to this time frame. So you need to know your key levels off of this chart. Carrying those. Ideas and levels over into the hourly chart. You can see here, here's that buy side imbalance, sell side efficiency, and the market rallied up on the pass through here, consolidated, relative equal lows, so you know it's going to be resting below that, right? Sell side liquidity.
Oh yeah, I had that level. What stops it from going lower? That imbalance or that new week opening gap. I don't know why I said imbalance. My eyes were on this. We left that unfilled. Breakaway gap. We have a low resistance liquidity signature, but we have taken the high on NQ though. But that's not an SMT because we've already delivered to where we were trying to go.
And we had a smaller one.
Because smart money's clearly offsetted their positions here to make price go up here. So that's no longer an SMT.
Inbounds, and it's purple, it's hard to see, I know. Then we have this one here, and then we have this one down here. It's better to leave this one open. Why? This is the part where you write down in your notebook. When you have a larger imbalance like this blue shaded one here from the daily chart, if I'm bullish, I want to see the majority of the reactions in the upper portion, which would be the premium level of the imbalance. But when you're looking for continuations, don't see this trading down to this level here in the upper portion, like I have here, the upper half of the fair value gap. That area here, a premium on a higher time frame level when bullish, when it trades back down into it, it creates what? An inversion. So premium becomes discount. That part is extremely confusing. making liquidity. Pass through here, consolidated, relative equal lows. So you know it's going to be resting below that, right? Sell side liquidity. And we had a small little inbounds. It's purple. It's hard to see it, I know. And we have this one here, and then we have this one down here. It's better to leave this one open. Why? This is the part where you write down in your notebook. When you have a larger imbalance like this blue shaded one here from the daily chart, if I'm bullish, I want to see the majority of the reactions in the upper portion, which would be the premium level of the imbalance. But when you're looking for continuations, don't see this trading down to this level here in the upper portion, like I have here, the upper half of the fair value gap. That area here, a premium on a higher time frame level when bullish, when it trades back down into it, it creates what? An inversion. So premium becomes discount. That part is extremely confusing, and I promise you, the upper half of the fair value gap, that area here, a premium on a higher time frame level when bullish, when it trades back down into it, it creates what? An inversion. So premium becomes discount. That part is extremely confusing. And I promise you we will revisit this throughout the course of 2023. But just know that it's better. You want to know the answers to why I know some of these imbalances are going to stay open, right? Well, I'm teaching it to you. And this is what I meant by I just can't do a 5-minute trainer video. I just can't write a paragraph or a tweet and explain it and you can run away and start making courses about it because you still don't know what I'm talking about. The whole point is there are some imbalances that are going to remain open. Some, I want them filled. The ones in the upper half of this fair value gap on the daily chart, above consequent encroachment, I want to see those filled. It's even stronger if they don't fill in. But the ones in the lower half, they are likely to stay open. They're better to stay open. If they come down and fill in, then it's not as bullish. And the algorithm may chop around and consolidate longer, and then I have to wait for more information. But if I see these types of scenarios here, it's almost like a loaded long. It's even stronger if they don't fill in. But the ones in the lower half, they are likely to stay open. They're better to stay open. If they come down and fill in, then it's not as bullish. And the algorithm may chop around and consolidate longer, and then I have to wait for more information. But if I see these types of
So if we do go to the lower imbalances, we'll probably likely chop, and then you might have to wait for more information. To establish a bias. To establish a proper narrative.
scenarios here, it's almost like a loaded deal, like a lead pipe cinch trade. It's just easy. Like it's a sledgehammer. Like it's pretty much next to a sure thing that you're going to get a type of reaction like this here. Okay, and that's why sometimes when you see me trade, I can go right in there when it's just driving straight down like a falling dagger, and I'll catch it right when it's going into the lowest low, and I'll buy it right there, which seems crazy, but it's these types of scenarios that I do that in. when I can see what the framework is and trust that these areas down here won't be traded too. So we have an imbalance in here. Keep your eye on that pink area there, and then we have
Yo, what's good, Anthony?
as consequent encroachment. That's the next objective at 4,043.25, and the rejection block we saw that traded to today 4038.75. And let's dig into the perspective of this entire range from here to here. Here's equilibrium. So we are in what? A discount. So even though we're in the upper portion of that daily fair value gap in the form of buy side imbalance, sell side inefficiency, that's that blue shaded box here. The upper portion of that is the ideal scenario for what? Lower intraday charts trading down into that, creating a discount relative to this low to this high. So you can start to see how this web gets very, very intricate as we drop from a higher time frame down to a lower time frame. And if you don't know your stuff, or more specifically, my stuff, you can get easily inundated and lost, which is why algorithmic theory must be understood. You just can't look at down close candles and think they're order blocks, and you can't look at just every individual candle that may resemble a fair value gap and assume that you're going to have a trade on that. There has to be narrative wrapped around it. And none of you that are running around trying to teach my course materials have any idea what you're doing. So stop, okay? Just stop. You're hurting other people. Okay, 15-minute time frame. You can see that we dropped down from the fair value gap over here. We went below the low here. Went below it, came back up. Look how it's really respecting that. One more time here, consequent encroachment, midpoint of the pink shaded area. And then it acts as what? Real resistance. As it acted support here, right? If we go through it, like we do here, it can come back up. And then what? We start to work down. This whole shaded area becomes what? A balanced price range.
Can you explain mitigate? I would recommend rewinding a little bit.
It's delivered both
He goes over it in the video when he goes over NASDAQ, but it's pretty much. So say, so say. We'll actually look at it real time here. So think about it like smart money. Smart money has to hedge. They have to hedge into their positions since their orders are so large. So as this is going up, smart money is essentially selling right here at this high, or the algorithm is giving smart money an opportunity to do that. And then as it goes lower, we then get this buy model underway. So this is where orders have been placed in the past, right here, because we've gotten displacement. So we know that their selling has occurred here in the past. So therefore, if we come back up into that area on the right side of the curve, this is the left side of the curve, and this is the right side of the curve, the buy side of the curve, and the sell side of the curve. If we come back down into that, it's going to give smart money an area to either add more positions or to take off old positions that they had. Because a PD array is an area which selling or buying occurred on the left side of the curve. So therefore, once we revisit that on the right side of the curve, buying or selling will occur again. And in this case, since we're bullish, we know that more orders are going to be able to get placed here, more buy orders. Maybe they were short. Maybe they were initially short here. Because yeah, like I was saying, they drove price lower. Then once price comes back up to that level, they're going to look to take off that trade. Since they were short here, they're going to look to mitigate it, take off that trade here, or potentially add more to that position right here, and that's what ends up driving price right there. Do you look at high resistance liquidity? Yes, I do. 100%. I actually have a thing. I mean, if you look at my videos, you probably don't have to, but I have this thing I like to internalize. It's called a high resistance signature. It pretty much, I'm just looking at where the market doesn't need to go at all, and therefore it'll probably go to the place to where it's probably likely going to go to where the low resistance liquidity is. So as we can see, like we've had a consolidation. We put in a stop hunt here. We're in a higher time frame PD array. We're also within a new week opening gap right here. This is a high resistance signature. Price has already done its work here, and we've taken these stops here. So we've done everything that price needs to do here. We're well below midnight open, and on top of that, we have these equal smooth highs right here. Where are we more likely to go. Lower? No, I don't think so. We're likely going to either consolidate or reprice to this original consolidation because we know that there are trailed sell stops that have been profitable throughout this move to lower. So therefore, if we see signatures that we'd like to see, sell side rated here, and then we respect this imbalance here, then we get a market structure shift here, we violate this high here, we come out into this imbalance with a breaker. Once we get that, then we know that we're likely going to expand to new highs here. How many points was this? Around 120. Can you share your way for bias consideration? Kind of just how I like to look where the market doesn't need to go. Where the market doesn't need to go. Did you bought off of this new day opening gap? Yeah, it was nice. Look how well we respected it. Honestly, it's kind of a hidden PDRA. We're not hidden, but I mean like it's definitely a PDRA for possible entry, cause like it kind of gets a little bit tricky when we have like a lot of new day opening gaps and new week opening gaps. But pretty much for my bias, I trade the AM session, so I'm looking for areas, like I said, in which we don't need to go to where the algorithm's already done its work, we've already stopped out traders. And we have an opposing viewpoint that I like. So as we can see here, we just had a big sell-off, a fraud sell-off because, like I was saying earlier, if we look at DXY is currently disrespecting bullish PDRAs here. And we actually have these equal lows that is the draw on liquidity. And we have the weekly imbalance, a weekly order block as well. To where the dollar, since the dollar is bearish, and we just sold off on NQ into a daily imbalance here. A daily imbalance right here. Daily BISI. With SMT with ES as well. We have SMT here. ES didn't take these lows. What's just more likely in terms of probabilities? It's more likely that since we manipulated here and we see displacement, it's more likely that we're going to return to buy side. I think there was like two possible entries here. There's a nice there's a market maker buy model here, and then there was a silver bullet set up here to where we're coming back down to a 5-minute fair value gap. Overlap that with an old high. Then you had a 1-minute fair value gap. Well, I created a Twitter, and I'm gonna start posting on Twitter. That's either gonna be like a big mistake, or I think it'll be chill. I guess we'll see. If it gets like toxic at all, if like I feel like I'm using it in wrong ways, then I'm just gonna delete it. I think Twitter is a good idea for me. Alright, let's get back to this video.
Up and then left it. Come back in. Consequent encroachment. That's the last line of defense. And goodbye. Next T plunge. Drops lower, creates a small little city here. Fair value gap. Consequent encroachment. Beautiful delivery down into our lower level hourly fair value gap. Digs into it perfectly here. Well, not perfectly. It went over by 1/4 of a point. So 1 tick. Then we consolidate here. Create a fair value gap, as I mentioned, live on the 1-minute chart. And then rallied up. And I was watching all this stuff on my phone. Sneaking.
Oh, yeah, I would 100% agree, Anthony. It's like there's a lot of toxicity on there, and then like if you're scrolling through Twitter, and then you see a bunch of people taking wins. Like in a sense, it's good and bad because you can just study those winners that they took and be like, hey, what could I possibly learn from this? But then yet again, if it's not within your own model, then why are you looking at someone else's trade? You're looking at someone else's stuff. The thing I do like to look at is like when people post like chart annotations, which is what I'm pretty much. That's all I'm gonna post. I'm just gonna be posting like chart, just case studies. That's all I do on YouTube too. I just post case studies and just my interpretations of price. I think it's also a good business move as well to get on Twitter. That's where a lot of people are at. How far are you from Maryland? I actually live in Maryland.
I was sneaking on my telephone, walking around, being with my wife today, so it was no harm, no foul, but I was in stealth mode, trying to give you commentary. I wasn't supposed to be on Twitter today, but I surreptitiously did it. Sneaky ICT. So notice also this SIBI, project that through. You can see we come back down into it in consequent encouragement once more. Bam! Like that? Bam! You're going to hear all kinds of wild stuff when I'm doing live streams. Some of the things you've never heard me say, and whenever there's animation on my part, and especially if my son does something.
Yeah, actually, I live in his basement.
Right, I'm going to be like cheerleading, so just get yourself ready for all that business. The rally's up, takes out buy side here, digs into the last up close, little change in the state of delivery here. Let's drop into the 5-minute chart. Okay, here's the 5-minute chart. Sell side liquidity here, digs below it, hits the hourly fair value gap, the one at consequent encroachment. Remember, we don't want to see the lower half of that daily buy side balance, sell side efficiency, which is that big blue shaded area here. We don't want to see it trade down below consequent encroachment. We're focusing on the upper portion of that. Because if it's going to do its turn in here and start presenting all these arrays that we can time off, we don't keep the 5-minute chart.
I totally missed that.
Okay, here's the 5-minute chart. Sell side liquidity here, digs below it, hits the hourly fair value gap, the one at consequent encroachment. Remember, we don't want to see the lower half of that daily buy side balance, sell side efficiency, which is that big blue shaded area here. We don't want to see it trade down below consequent encroachment. We're focusing on the upper portion of that. Because if it's going to do its turn in here and start presenting all these arrays that we can time off a long or a shift high.
Arrays are used.
Higher in price, then it's better for it to do that there than to dig into the lower portion of that buy side balance, sell side efficiency on the daily chart. Now, this is one of those videos where you have to watch it a few times, because what I'm saying isn't going to register until you watch the first portion of the video that I've said so far pertaining to ES, because it takes a couple times to see where we're at in the lower time frames, what these areas are, and you can quickly see why I'm not painting all this stuff on my charts when I'm watching it, because to me this is extremely busy, but I'm showing you the overlap of all of these convergences that the algorithm is going to refer to. It's not supply and demand, and it's not support and resistance. It's these ranges the market's going to key off of. Very specific prices. The high, the middle point, or the low. And there's logic into knowing which one you want to see hit and which ones you don't want to see hit. And I'm going to do that throughout this year, so that way, that's the only way you can learn it. That's the only way you can learn it. Because knowing what I know and what's been codified, I can't just simply say, this is the rules that's going to work every single time. There's going to be things that the algorithm's going to do based on what factors are in price action at that time, on that day of the week, at that time of day. So all those things coming together and being equal, you're going to have certain rules and processes that you're going to have to consider. I'm not going to teach you every possible scenario, because that would take years, many years. And frankly, I don't promise that to you anyway. That's pretty much what makes me who I am. And my family members are privy to that, but the general public, like all of you, I don't owe that to you. So I'm doing as much as I can, obviously, and much more than any of you really would have discovered. So I'm hoping that this is going to be enough this year. For some of you, it won't be, and that's okay. But I want you to take your attention in here. We have this candle here, and then this candle right there. See that? So the market reacts from the low end of the hourly fair value gap that joins and links with the consequent encroachment of that daily buy side and balance, sell side efficiency, the blue rectangle. It rallies up, creates a short-term high right there, and then this candle pierces it, creating, when this candle here closes, fair value gap right there. See that? So the market trades down into it here, once more opens, and then runs away. Order lock, trades down, retouches it, rallies, consolidates, rallies again into our old shaded area, dips back down. It's going to be resistance here. No. we have now turned the corner down here. I mentioned that if we went to 39.77 and 3/4, that's the end of the line. That means it's over. The bear sentiment is no longer valid. We would be considering what? The end of bearish sentiment is now bullish. Okay, so go watch and look at the tweets. I'm not going to show you any of the tweets. That's your job to go through the tweets. And in here, I give a very specific candle, talk about a fair value gap, and we'll look at that when we drop down in lower time frames, but it rallies away and comes back down into buy side value, sell side efficiency here with the order block, trades to a bear, rallies through, and presses into the afternoon 4038.75 level. On the 1 minute chart, you can see how we dropped from that 15-minute time frame fair value gap. We traded up into it here. This is a Judas swing after taking buy side liquidity. This right here, 75 level. On the 1 minute chart, you can see how we dropped from that 15-minute time frame fair value gap. We traded up into it here. This is a Judas swing after taking buy side liquidity. This right here had everybody thinking it's going to rip higher. I was watching several live streamers this morning. They got really animated here. They were actually wishing and cheerleading, hoping it goes higher, hoping it goes higher. And the more they did that, the more I felt confident that it was going to sell off. So I actually sold off a position here, built it larger here, and wrote it all the way down into this level here. And then in here, I went short, building up another position. And then I was calling all this stuff on the fly on a telephone. So I was looking at all the things I look for, doing all the measurements I look for, Fibonacci extensions, levels on higher time frames, working down, and I came to the idea that 39.62.5 would be likely. So I had a limit order to get out at 39.62.75, and it didn't give it to me. The market didn't actually go that low. The market did in fact rally here. Look at this high here. Right with the volume imbalances. See this high here? This candle's high is higher than that one, and then this candle's lower than that one. This is your swing high. The market rallies through. That's a shift in market structure. But ICT, it didn't close above that high. I didn't say it had to. Go back and watch the videos on the 2022 model. A shift in market structure does not ever require a close above a short-term high when it's shifting bullish. It does not require a close below the swing low when it's shifting bearish. Stop spreading misinformation and stop perpetuating ignorance. Okay, this is the reason why people complain to me, because they're learning from dollar menu mentorships, and they're not learning from someone that can do it. Number one, they didn't author it. They have no idea what it is. They have no idea when it won't work, when it's likely to be there, when it's not likely to be there. So that shift here is bullish. So this drop down here, it's a suspect decline. It's a Judas swing in many ways. Where's it going? Fair value gap. It trades in a consequent encroachment, midpoint. How nice is that? The market rallies, takes out a short-term high here, another fair value gap. Here's where I stated, look at that candle right there on the 1 minute chart. That candle is your fair value gap. And I said, you had homework today. I gave you a task of looking for find two 5-handle price runs before noon. Well, I know some of you were not able to get 2, so I gave you one today. Here is the candle. That range extended through. It touches it here, 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 and then I said, you want to take your attention to 39.82 buy side liquidity, which is this short-term high. Why that one? Because it's going to offer 5 handles, easy, and it delivers like gangbusters. I'm walking around, I'm looking at my phone, so I'm looking at all this price action here through the lens of what? My Galaxy Note 10. My cell phone can only show me so much, and my
Bro has a Galaxy Phone 10. That's great. Notice how we had a short-term low here, and then we took that. We souped that. We didn't go to this imbalance. There's no imbalance here. We go to this imbalance. It has a short-term low. Very delivered sell side here. We don't need to go to this imbalance. That's a breakaway.
50-year-old eyes. They're not as good as they used to be. So it is what it is. It ran off a lot more, and I thought I was going to be able to catch something in the afternoon, but it did the majority of the run. Right after me calling this live on Twitter, it just left. Elvis left the building right there. Boom. And stock indices went with him. So we consolidated in here, ripped through, took the buy side here, back into that in bounce on the hourly chart. An hourly break of continuity in price action during the New York lunch hour. You can see that here. We drop back down into the buy side about sell side efficiency, hits the order block here. Beautiful rally, accumulates at the low end of that old hourly imbalance, the pink shaded area, and fair value gap, rallies once more, and you're going to want to go through your charts and see what these levels are. Okay, this is the part where the lazy students, the casual readers, the Netflix ICT student, you're not going to get this. You might be.
We had the same soup today. Right there. Oh, I'm not gonna train my eyes to look at soups anymore. I don't. This level right here. Oh, is he saying he said it was the change of state delivery? It also is the current new day opening gap. A little suspicious. Why not turtle soup? It doesn't resonate with me, and I feel like I had no clue what I was talking about when I used to try to look for soups. I would say now if I try to look for turtle soup, I would be a little bit more comfortable, but I like especially until I think turtle soup's more advanced. I feel like turtle soup's more like 2 years into it. Then you could be looking for soups. But even then, I think buying sell stops and selling buy stops isn't the greatest thing to start with. You know.
Shaded area and fair value gap, rallies once more, and you're going to want to go through your charts and see what these levels are. Okay, this is the part where the lazy.
I wish it would let me use a 1 minute chart. What? Constant culture of this wick and this wick line up. Oh. Beautiful. So it works here with the fair value gap overlapped with it.
Students, the casual readers, the Netflix ICT student, you're not going to get this. You might be entertained or maybe bored to death by watching my videos, but I can tell you this: if you don't go into your charts and look for the things I'm annotating here on mine, if you're just simply watching mine, you are not learning. You're not doing the quote-unquote work.
That's at 12. Is that the same level here? No, it was at 12:58. It's around here. There's that 5 minute. You have a breakaway gap. 25%. What do we expect? Lower risk entry. 50. Notice how we use. So like dealing range theory is kind of. It's impeccable. It's impeccable. Let's look at this dealing range from this high all the way up here. What's good, Ian?
That's required. This is the part that none of my students that paid me for mentorship, they didn't do these things. They didn't then take that information into live data and watch price print. And if they had jobs, or if they went to school, or if they couldn't be awake during that time, they didn't make an investment to record price in a screen recorder and then study it that way. So there's no excuse.
So many levels,
Zero
yeah.
excuse for you not to be going into your chart, because if you don't do that, you're not going to get the blue ribbon results you're hoping for at the end. Market creates a decline in here, order block, trades into here, rips higher, fair value gap, digs into here with an order block, rallies again, buy side taken, here, false high, drops back down the last hour of trading between 3 o'clock and 4 o'clock, order block, extended through. Why this one? Because we're not supply and demand, we cut through candles. This is the most significant price point, this one here, last 2 down closed candles, through this price action, hits it here, last hour macro, comes in right when you're expecting it to, rallies up, takes the buy side out, bam, hits the 40.38 and 3/4 level. Go back to the beginning of the discussion for ES and see what that is on the daily chart. That's where you derive it from. And that, my friends and neighbors, is going to be it.
40.38.75. Then 40. 4009. Also is a new day opening gap. Wait, so since order block opens are sensitive, it's opening of that candle, there's going to be a volume imbalance within that, so that's going to be a new day opening gap. Every volume imbalance open is going to have a new day opening gap. It's this body close.
For today, I hope you had a good week with me. I'm closing shop early, so Thursday's trading and Friday's trading. I might do some personal trades, and then they show you like a short little vignette type thing. But as far as like YouTube videos, I gotta rest a little bit more, okay? Because we're coming up close to when I'm gonna be really delivering on a day-by-day basis. So I'm trying to enjoy the time, even though I'm trying to keep myself close to the marketplace and not get rusty by staying away from the market for a few weeks. This way it keeps me close, keeps my finger on the pulse of market sentiment and order flow. And then we'll see what we get. So if I do something tomorrow in trading, and I can record something, I will. If I can't, I'll try to do something on Friday. And otherwise, we will talk on, I guess, shop on Saturday on Twitter. Until then, be safe.
All right, let me add some.
Good evening, folks. Just a quick little video review of today's price action.
Quick little. It's like 30 minutes. $5-minute fair value yet. Look at this. With an order block. Fair value gap means new day opening gap. With smooth highs here. Oh. Oh, at 75%. With a terminus gap. Oh. I just deep dive into I would not try to look for enigma. I would not recommend. That's my opinion. I would not. I think that's a waste of time. Because think about it. If you're not already profitable and consistent, like why? Plus, like it. The only one that truly knows is ICT. I wouldn't recommend trying to go down rabbit holes. Like there was a minute when I was looking into digital time theory. I was looking at that PDF, and like I think that PDF is kind of cool because it like there's some good content in there, but like I was like, it's not beneficial at all. Quit moaning. I guess I do that a lot. It's whenever I see something that is just so it's just nice. It's just nice. It's just very nice to see. You got to. Like I would recommend. I might stick to the 2022 model. I don't know. I'm still trying to find the model that I deem is what I want to do. I was looking at the 2-minute here. I'm gonna annotate this. 12 to 1. ICT notes the wick. That's beautiful. That's beautiful. That's beautiful. Lunch hour retracement. I mean, I feel like even if you were to find Enigma, it would just make things more complicated. Last hour. I'm gonna turn on some jazz real quick again. I had it up over here. Did I delete it? Man, I deleted the live stream. Oh, was that quiet? Oh my, was that video quiet that whole time? Ah, that's cool. It's whatever. Cause I had it lowered so, cause I wanted the jazz to be lower. Damn, that's cool. This archive is definitely a gem. I wish I knew about ICT back then. I don't think I would, cause I turned 18 when I was in 2023 of April. That's when I kind of started trading, like on a live account. But I was trading demo maybe like 3 months prior. But I wasn't doing anything. I wasn't doing any work. I was just looking at random lines on my chart and saying, hey, it's gonna go here, and I would place demo trades. And I ended up running like a 10K account to like a 40K account by over risking, over leveraging, and by trading off of support and resistance. Wait, is this? No. Wait. I need to look at my stream. Oh, I'm chilling, Roy. How about you? How about you? Chilling, backtesting. You know, it's kind of just like a daily thing now. It's his Twitter archive. It's in the free resources on my Discord. I have it pinned. Bro's already at 178K. That's wild. In 4 trading days. It should be in the description of it. If not, it's in the description of one of my previous videos that you can probably look for. Dang, he's beefing with Curtis. This all happened pre-market. (2022) sell side market structure shift imbalance. Find one 5-point handle move before 10 a.m. All right, let's go to this next day. Drop below true day. No, notice where we dropped to below true day. Oh. And then we repriced to a random insignificant level. 8:30. What type of news do we have? GBP. We don't have any imbalance here besides this one right here. That's the closest imbalance that we have. I'm just gonna delete these. I don't like deleting my annotations. It's just like, like you put in work for those, and then just deleting them. I don't know. I get a little bit like. So we come up, take buy side. Do you have an imbalance? New day opening gap. That's the current new day opening gap. Should be. Oh. 8:30. Look at 8:30 news. Imbalance right here. New day opening gap. Then we create a market maker buy model. How do you backtest the previous year or historical year contract? So to be able to do that, you just type in the symbol that you want to look for, and then you're able to use it. I would recommend. I would highly recommend upgrading versions on TradingView. I mean, you might not be able to afford it, but I think it's 100% worth the amount of money. A 100%. Do you know anything? Yeah, root candles are pretty much gonna be candles of hidden liquidity. And it can also give you a session discount or premium. I don't know. I would recommend always doing your own research, but I found that it's like most things, not needed. That's just my personal opinion. Do you I have more recently. I haven't really back tested it. They're a little bit harder to back test in my opinion. I use new week opening gaps and new day opening gaps, which in a sense are kind of like um, opening range gaps. But yeah, I have, and I think that they are useful as well. But I think new day opening gaps are a little bit more useful. But if you're able to combine all of them with a narrative and bias, then you're able to get high probability. So this whole day we end up having market open here. We keep on taking buy side, and no displacement after. No displacement. This is the definition of a high resistance signature. We keep on taking highs. Keep on taking highs. Let's see. I mean, I'm not going to act like I know everything about them because I don't. I'll definitely be watching some lectures. But pretty much regular trading hours is just something to toggle for. And these gaps can be drawn liquidities or they can act as support. Like here, this was their opening range gap right here. This whole, so it'd be, since this was a bearish candle, it'd be from where it opened to all the way up here to where we closed the previous day at 4:15. Where we open at 9:30, and I honestly don't know why it's 4:15. I think because after news, and then we come back down into discount, draw constant encroachment of that. Then we end up holding that, and then we end up creating a buy model there. Kind of the same thing. We have an opening range gap here. We take buy side, market structure shift, and then we look to fill that, and then we take these lows. I'm trying to find, wait, where is that one example? Oh, it's here. Notice on this day how we perfectly respected this imbalance right here. I appreciate it. Appreciate it. My goal is to just continue to put in work, become better than I was the previous day, and hopefully be able to inspire other people, you know, or to become better than I was. That's pretty much the goal. Usually, most of the time, we have a new day opening gap, where I've seen, and then notice how we've left low resistance liquidity here. 1% better every day, not 5% better every day. Could you imagine if you got 5% better every day? But then that's likely gonna lead to burnout. Like the only thing I worry is that I'll stream for too long, you know. That's how I naturally am, though. I like grinding. I like doing long shifts. Delivery right to this. New day opening gap. We just consolidate with a new day opening gap. We have IOFED. Notice how we have a imbalance right here. Inversion level that lines up with it. Right here, new day opening gap. Gets respected. Then we come back up, just a retracement though, not a reversal, just a retracement. Back into here. We've already done the work on buy side, so we can trust that this high is protected. I just want to look at NQ at the time. We do have a little SMT here. So this low right here is engineered right above that in Asia. And ICG said look for a 5-handle. Look for a 5-handle run. Oh my gosh, that's only 5 handles. Ain't no, that's only 5. Oh my gosh. Another 5-handle run. Think about it. That's all you need. All you need is that. That is very small. But I will say, 5-handle runs, they'll kind of mess up your stop placement because then you'll be taking. But I think it's necessary. Here we have a 1050 macro reversal. SMT. Oh, this was nice. Dang, like this. These market conditions right here are lovely. Lovely. Your background colors, they're in my Discord. Discord's in the description, but I'll pull them up real quick, and then you can just pause the video, and then this one, I feel like it doesn't really matter what that one is. But yeah, those were my colors. Let me know if that worked. It should have. If not, you can just pause it. SMT kind of confirms that market structure shift. I would classify this as a CIS, change of state delivery. We actually don't have, we come down to this volume imbalance though. $10.50 macro reversal. Stop on it. Come up to buy side. I want to get this exact high. That's pretty close. I don't know, that's something I try to just like cherry pick some standard deviations sometimes. -2, -2.5. We'll keep it at that. Reaccumulation zone right here. Price. Here we have lunch hour. Oh, this is just gorgeous. Notice that this is a this gap happens at 75%. Measuring gap. Breakaway gap. Oh, beautiful. Ali Khan would be stoked to see that. Stoked. He'd be stoked. He'd be bloody stoked. Like, I feel like this needs to get framed somewhere. NQ. NQ is not as. NQ is not as lovely, but I'll mark this. Okay, let's go over Twitter. Let's see if I missed anything. Maybe. Why 720p? I don't know. I don't know how to change my stream quality. See that breaker? What's your strategy? I trade ICT concepts. I would agree. Alright, that's pretty much the day. Got a nice 15-minute for value gap here. Where's this 1 hour wick? I want to see what that is. What that looks like on the 15-minute. 1 hour wick usually is a 15-minute rebalancing. What does that look like on the 5-minute? 5-minute wick? What does that look like on the 2-minute? Alright. Let's go in and gonna watch the lecture.
I will not be trading tomorrow. I won't be doing much at all really with the markets. I'm having a 3-day weekend, as you know.
I'll turn it
Watched
up
the
too.
analysis video I did last night, and if you were part of the Twitter engagement that I do every day, pretty much on Twitter, I'll give you my commentary. I'll point to where the next draw on the liquidity is. It means where I think the market's going to go reaching to next. If there's a fair value gap or an order block, something that's noteworthy at the time, I will call out the very specific candle time, and that way you can annotate your charts live and watch price action real time with us. Last night, I gave you the analysis for the mini S&P. Before I go into it, if you take a look at what has been going on in Forex, okay, with dollar index, it's just sloppy, choppy, and euro dollar and pound dollar, while overall it's moving higher like I've given you earlier in the year and lower on the dollar index, I don't want to be trading those markets because look at the difference between that and what you're going to see here tonight with stock index futures. And I understand that some of you simply want me to talk about Forex because that's what you are trading right now. I'm not trading it. So when the markets loosen up a little bit, hopefully, and there's a little bit more movement and they're more fluid in their delivery and price, I promise you I will be more active in talking about it. But for the moment, my time and attention is focused on stock index futures because that's where the cleanest price action, the surest delivery and symmetry is to be found. Forex is not it right now. I'm not arguing the fact that Forex isn't gyrating a little bit. It's just it's not as clean as you're going to see here today. So I mentioned on last night's review that we would be looking for the consequent encroachment of this candle's wick right here. That price comes in at 4,072 3/4. The dashed line is going to be an old high formed here, and we'll drop down the lower time frame now. So I'm skipping over the hourly chart because I want to get right to the heart of the matter here. The 15-minute time frame is a bellwether chart for me. That means most of everything I'm going to be looking for can be found on this time frame relative to weekly and daily time frame. So if I understand where my draw on liquidity is from the higher time frame, daily, and or what my expansion is going to be for weekly, is it more likely to expand higher or more likely to expand lower? I can jump right to the 15-minute time frame and find everything I need to utilize for a trade idea. So if you look at the 15-minute time frame for even the S&P, and that's the only thing we're going to be looking at tonight. I'm not looking at NASDAQ. And the reason why is because I'm focusing primarily on ES. I want to show you this year how you can focus just on one market not have to flip-flop back and forth between NASDAQ and ES, because I get questions all the time from new students or new casual viewers. What is the catalyst that causes me to swing from being a trader in the NASDAQ or the E-mini S&P? And to remove all that concern, because right now there's bigger fish to fry, you need to figure out how to trade and read price. So if you're constantly inundated with the confusion, which is going to be the result of you not having experience, if you just stick to one market, it'll be perfectly fine for you to just not have to worry about one less thing. So just because you see me back and forth, maybe a student of mine or students moving from one asset class to the next, one market to the next, they're a little bit more seasoned than you probably are. And it's not a knock against your aptitude as a student or ability to be a profitable trader. It just means that you just don't have that experience yet, and over time you will. So with that said, I want to take a look at the morning session here. Here's the midnight time frame, and we'll note that opening price here. And you may not see it very clearly, but if you see that purple line here, 40.36 3/4, I'm annotating that as the midnight opening price right here for December 26, 2023. So if we're looking for longs, as I indicated last night, we would be. We're looking for higher prices on the stock indices. The ideal scenario is for the algorithm to reprice below that midnight price right here. So you see it do it here, 2023. So if we're looking for longs, as I indicated last night, we would be. We're looking for higher prices on the stock indices. The ideal scenario is for the algorithm to reprice below that midnight price right here. So you see it do it here after 8:30. So here's 8:30. That's our trigger time. So everything starts at that moment. So 8:30 and then 9:30, we drop down on the 15-minute time frame right before we get to 11:45. So 10:45, that candle, we're dropping down. We're attacking an old low here. We're below the opening price at midnight. So this is allowing smart money traders to get on board with longs to target this high and that 4,072 3/4 level that I gave you last night. So last night, hours before the market would even start trading in our New York local time, down here, our focus was up here at that price level. And I started the day tweeting on Twitter, 10:45, that candle, we're dropping down. We're attacking to here after 8:30. So here's 8:30. That's our trigger time. So everything starts at that moment. So 8:30 and then 9:30, we drop down on the 15-minute time frame right before we get to 11:45. So 10:45, that candle, we're dropping down. We're attacking an old low here. We're below the opening price at midnight. So this is allowing smart money traders to get on board with longs to target this high and that 4,072 3/4 level that I gave you last night. So last night, hours before the market would even start trading in our New York local time, down here, our focus was up here at that price level. And I started the day tweeting on Twitter with my time frames, keeping this level in view. As a reminder, remember, if you're watching my videos and you're not recording things with your notepad, key levels, things I'm looking for, catalysts that may support or negate a scenario in the marketplace. So it's rare that you're going to hear me say, if it's going to go up, it's going to go to this level here, but if I'm wrong, it's going to go down here and go that. Very rarely will I do that. And I'm admitting before I do something like that at all when I'm indecisive, when I have really no strong convictions one way or the other. I have strong convictions yesterday and last night and today during the market session, and we were looking for that 4,072 3/4 level for S&P. The levels that I gave for NASDAQ, notice that it did not deliver there. It delivered like gangbusters here on this market. So I'm not making a case that I picked the right one, so therefore I'm smart. I'm just saying, following one market, I don't care that NASDAQ didn't reach its objectives. I don't care that the euro dollar didn't go where I wanted it to go. I don't care that the dollar index didn't go where I wanted it to go. This is the market I'm trading. This is the market I'm dialed in on. This is the only thing I'm focusing on right now, and it's more than enough. So let's take a closer look. We have a rejection block here. After the market runs up at the 9 o'clock hour, we break down. One more time, it stabs up above the uppermost closing price here. That's a rejection block. It breaks down, and then it runs below the opening price at midnight over here. Now, this move here, you might look at that on a lower time frame and say, yeah, that's my model, that's my setup. There's nothing wrong with that. Others that are looking to trade on a longer term time frame, they can't trade ahead of news reports and take advantage of the small intraday fluctuations for scalping or day trading. They have to position themselves on a swing trade. Well, this is how you do it, folks. If we're bullish and we're looking for a move below the opening price to get an ideal power 3 entry, and that's a mouthful. And we're looking for a move below the opening price to get an ideal power 3 entry, and that's a mouthful. My concept, power 3, is where we're looking for the accumulation, manipulation, and distribution phase of the daily range, and or weekly range. But it also can be utilized inside of the sessions, like the morning session and the afternoon session. Each one of those fractals in time, a perspective, if you will.
This is some sauce.
We're looking for the accumulation, manipulation, and distribution phase of the daily range, and or weekly range. But it also can be utilized inside of the sessions, like the morning session and the afternoon session. Each one of those fractals in time, a perspective, if you will.
What's good, Tino?
And framing the price in the context of a specific range of time. Power 3 is when I'm bullish, I'm expecting the low to form below a key opening price, and the key opening price for the daily range is midnight New York local time. So we drive. But it also can be utilized inside of the sessions, like the morning session and the afternoon session. Each one of those fractals in time, a perspective, if you will, and framing the price in the context of a specific range of time. Power 3 is when I'm bullish, I'm expecting the low to form below a key opening price, and the key opening price for the daily range is midnight New York local time. So we drive down below that into a old low. So sell side below this low is collected, engaged. Why would that be necessary for the market to see that? It's going to drop down below there to absorb all that sell side liquidity and be counterparty to their smart money longs. So they're buying the sell stops here below the opening price at midnight. So that is where you could have a order if you are a swing trader or non-intraday trader, the way you would do that is you would just have your alerts set to tell you when the market dips below that opening price or gets close to it. And if you're bullish, you can put limit orders down there, and then whatever the high you're aiming for, there should be two of them. The high of the day that's formed, and then the target you're reaching for, as we outlined last night, the 4,072 3/4 level. You don't need to be babysitting it. Your positions will be very small, probably one contract, or maybe even a micro, and you just let it go. You don't worry about all these small little fluctuations I'm going to cover now, and what I went through and outlined beforehand live on Twitter. So the market drops down after creating a fair value gap here. It retraces back into it. Consequent encouragement. I called this live. I outlined it, framed it, and said as soon as it hit this level here, as we'll look at on the 1 minute chart, I said this is exactly when it should reject and look for it to go lower and reach for the 4038 level. And that was this sell side liquidity here. The market drops down, digs into the sell side, accumulates, drops back down into the order block here, rallies. We consolidate. This range here is an hourly imbalance. So this little shaded area, if you find your hourly chart, you'll see that there's a fair value gap there. Market rallies, small buy side imbalance, sell side inefficiency, comes down, overshoots that, rallies again, fair value gap, order block.
I think it might have to be done. I think I might have to remove some annotations. I was at 15-minute balance. I don't know why he said it hourly. He messed up. On the 5 minute, we have an IOFED. Well, no, not an IOFED at all.
Trades down to here, and just real choppy, but still continuously grinds higher, keeps grinding higher. Every time it created a higher high and started to break down, retail traders were expecting this thing to break down. And your focus was where I was telling you last night. Look for that 4,072 3/4 level. There's nothing to fight. You don't want to try to go short against all this because the algorithm is just going to keep on repricing higher, and it'll frustrate you. And you can blow your account getting revenge trading, trying to short something like this and not know what it is that you're looking for. And thankfully, you have somebody that's been here for a long time, and I've been around the block a few times, and I'm outlining and showing you and pointing where I believe, with 30 years experience, where the market's likely to go to next. Doesn't mean I'm perfect, doesn't mean I'm going to be exactly on the money and hitting the mark every week, every day throughout the rest of this year, but I think you'll find that it's pretty consistent, and certainly enough for you to try to do well on your own once you adopt this skill set. Dropping down to the 1 minute chart. All right, this shaded little trend line here, okay? That's denoting specific elements of time. So we're looking at a time window where the market starts trading approximately at 9:30 in the morning, and that shaded area right there, that fractal, that amount of price action, that is all you need to worry about if you're trading in the morning session. Just that. If you start looking at your chart like this, framing it out inside that parameter of time, 9:30 to noon, and start looking for inefficiencies, where liquidity pools are, where's there a shift in market structure that's bullish or bearish, something that would jump off the chart, and obviously what I'm going to cover here should be jumping off the chart already. The market trades higher multiple times, higher, and then breaks down. We have a imbalance here, but this has been shown on a higher time frame. But you can refine it. You can use this low and this high here, draw that out in time, and it would completely fill in perfectly like it is here. But from the higher time frame, this is what it would be like, seeing it this way. Then we have the market consolidating in here, breaks below this low here sharply, leaving a fair value gap. Market rallies up, and right on this candle here, I actually mentioned that this candle is what you should be focusing on Twitter. Everything is time and date stamped. I don't delete anything. And when there's a typo, it stays the way it is. The fair value gap here, I outlined and said that we would be looking for this low here for sell-side liquidity. And I mentioned I wanted to see it as it stabbed up into it right there on that very 1 minute candle. As it was a bold-faced run-up green candle, I tweeted and I said I would want to see the fair value gap be rejected right here
It
on
also
that candle.
matches up
And
with
then
this
on here,
distribution
I said
block.
just like that. another tweet, and you'll see those tweets in a moment. The market does what? It aggressively, quickly runs to the sell side liquidity here. And then I remind everybody that everyone should be square and not in the marketplace. They should not be in there holding on to it. Why? Well, you're learning now. Here's that opening price again, that light shaded purple level at 40.36 3/4. Where are we at? Low here, below that opening price in a time when I'm telling you last night it's bullish. So smart money's going to accumulate longs down here. You don't want to hold on to your shorts, expecting it to keep breaking lower. The market rallies, builds a fair value gap here, accumulates, and goes into the lunch hour consolidation. Let's go into a little bit of the markups and things I was calling live today. I shared this chart on Twitter later in the day, obviously. But if you watch my tweets and you are able to go through them, maybe not real time, do this because you want to be watching price. But later in the day or in the evening when we get home, when we have free time, go to the Twitter, pull up the individual tweets between the 8:30 and 11 o'clock time window. It may be a flurry of tweets, and I don't appreciate anybody complaining to me that sending too many tweets, because that's the whole point of being on Twitter with me in the morning session. So between 8:30 in the morning up to around 11 o'clock or so, you're going to get blitzed with tweets if your alerts are on. Okay, so if you don't want to be constantly bombarded with real-time alerts about where I'm seeing price and where it's likely to go to next, just don't turn your notifications on. But don't complain if you miss something that would have otherwise been prompted by a tweet. So it's not a signal service. I'm not telling you to buy or sell, but I'm absolutely taking your attention to a very specific segment of price action, very specific candle with a specific price level that I'm reaching for. And you can take a look at what we have here. I was saying note the 4,035 ES sell side. That's this level right here. Below their sell side on this candle right there. The next candle is here, and I'm saying note the 1038 1-minute candle fair value gap. That's this candle here, right there. I'd like to see it remain unfilled and reach under the 956 low. That's this low right here, the 956 low. And I sent that tweet right here. These are all individual 1-minute candles so that we can match up the time here and here. All right, and then the next tweet is right here as the market runs up into the fair value gap, that shaded area, right there on that 1-minute candle. See the date here? You can see these tweets still on Twitter. I would want to see it reject that fair value gap immediately, or it is no good. Now, I don't have the tweet here, but you'll find it in the same vicinity in terms of time. I mentioned that I don't want to see it trade to 4,051.25. That's this level right here. Why did I even make a mention of that? Because it's hypothetically where our stop loss would be, but you're not taking a trade. You're tape reading with me. Why there? Because this candle here is the high of the fair value gap. So your stop would be above that, and that's where it would be. Did it go there? No. Did it even fill in the fair value gap entirely? No. Why? Because that's exactly what I wanted to see it do. Leave it unfilled. It went in? Yes. Did it leave it partially unfilled? Yes. That's exactly what I tweeted at 10:43 in the morning. That's exactly what your chart shows for the E-mini S&P today. And the market tanks aggressively, runs into our objective, and this is me being my facetious self. It's just for entertainment value, folks. I'm not trying to be arrogant. I just want to make you feel engaged. It may not have that effect on some of you, and that's okay. I'm not going to impress all of you, right? So this candle here, I said you should be flat for those who are gambling. That is basically reminding you that you should not be taking trades, but I know some of you are just not going to listen, and you made money here, and you banked. And then we consolidated below the opening price of the opening at midnight, New York local time. That's this price right in here. I don't have that level on it now, but that's what we're seeing here. And it's below sell side, which is that low here. So what we're doing is we're looking at times when the market's likely to go one direction. How do I know what direction, Michael? I'm prompting you with a tweet like this. That is not a signal. That is me telling you where we are at the time when I send that tweet is going to determine what this tweet means. So the tweet was sent here. So if it's here, and I'm tweeting about a level here, that means I'm expecting price to go where? Below that low. Below that specific level. Sell side below the quoted price level. So it would be 40.34 3/4 or 40.32. That's what you're learning to trust in your own observance of price action and reading the tape with us as a community. If I quote a buy side liquidity, and it's above the marketplace at the time of my tweet, then I'm suggesting to you my focus is primarily looking higher. And then I'll usually send a tweet and I'll say, there's a specific candle, like I do here, 1038 candle, which is this candle right here that creates the fair value gap. This candle's high, that candle's low. if you've been with me, if you haven't been with me long, by doing this very thing right here and looking at the reviews and the ideas that I share on my Twitter, you go into your charts. This is the work. This is the part that everybody doesn't want to do because they're either lazy or they just want to be spoon-fed. I'm not going to spoon-feed you better than this. There's nobody out here doing this. There's nobody going to take your attention to a specific level with a specific process of knowing what to do with that information and still not be a signal service. This is how you read a tape. This is how you understand how to read price action. And then you'll learn to trust your own analysis once you get better at it. But right now, you're learning how to use my concepts. But you have to trust that they work, right? So there's no better way of doing it than me taking you into a live market condition, pointing to where the market is right now, where I believe it's going to go to next, and what level is a catalyst for a turn in that direction. Okay? It may not be a fair value gap like I've annotated here on this very candle. It may be a bullish order block. It may be a breaker. It may be something else that I've taught on this YouTube channel. But I'll make reference to what it is. And it's not imperative you understand exactly what that is at the time. Just understand that we're looking for the price to go above or below market price. And the key words are buy side liquidity. If I tell you to note that, that means I'm looking higher. If I say sell side, that means I'm looking for it to go lower. And then you're just looking at a level or a specific time candle. That's right here. See it? 09:56 low. That's this low right there. So I don't need to send you charts. In fact, I don't have time to do that. I'm already using a 1 minute chart. I'm doing the analysis and everything. And then I have to type out something. I don't have the time to address a chart. And I don't like having my charts have all this stuff on it. So I don't trade with things on my chart. But I annotate them and put these things on there so that way you can see conceptually what it is that my concepts are building on with the lectures and things that's on my videos. So at the very moment it hits this here, I said it needs to reject that and then sell off and attack the sell side liquidity. If it goes to this level here, which was also a separate tweet, 4051 and a quarter, or basically 4051.25, and that's what that is. And that would represent a hypothetical stop loss. So if it would have went up and hit that, then that would have been a bad trade transaction, and you would have seen me get it wrong today. And if there would have been a trade taken, you would suffer a loss, and or I would take a financial loss if it was a trade pressed. Okay, so you're seeing the logic of where the entry pattern would look like, where the stop loss would be, where's the threshold for pain to put you to I gotta get out. That means a stop loss would be utilized, and the stop loss should be utilized if you ever take a trade, whether in demo or if you ever decide to do this on your own and do it with live funds or trade with a funded account. You need to be using stop loss, because if you don't, you have risk of ruin that is absolutely possible. And with no experience and getting caught up in a loser cycle, which is typical for a new trader, you very easily blow your account. So I reaffirm everything here that that's exactly what we're looking for, and the screenshot it because this movement here from here is 5 candles alone. So that's enough to show you what 5 candles would look like, and you haven't even got down to this old low here or run out that low. And then it accelerates as we would expect to see. And then this tweet here obviously is saying that you got to be out of the marketplace. I already said that. So I think if you're looking for something to kind of like prove that there's a way to be able to time the market, look for setups, but also have the ability to grow independently, but part of the community here, you'll be able to see your own development each day, each week, every month that we go through this year. These things are going to be much more meaningful to you, and you're going to find it. You'll start seeing them without ICT pointing to them, and that's an exciting feeling. It feels empowering when it happens. All of my students have the same reaction. It feels amazing, and they love it when I'm calling out something and they have it already on their charts. You can see their excitement because they're tweeting and saying, "I got this already on my chart," and I'll say, "Oh, see, I already tweeted it. Look, it was over here. I did this and my so and so." And to me, it's awesome as a mentor because it means that it's transferable knowledge, which is exactly what I said it was. But it's not transferable knowledge to lazy individuals who are just simply watching my videos, because that's not it, folks. You have to do these things here, study it. And you have no excuse this year because I'm actually taking you into a chart live. All right, so in the afternoon, we had our typical afternoon 1 hour session before the close of regular hours at 4:15. But at 4 o'clock, we're looking for a particular run into that level. What level would that be? Well, I mentioned last night that I liked the 4,072 3/4 level. I reminded everybody this morning that we were looking up. That was where my charts were taking your mindset there. And in the last hour of trading between 1500 to 1600, and that equates to, in local New York time, 3 p.m. to 4 p.m. What I looked for was this low here to be tagged, which is what we saw here. I went in with 10 contracts filled at 63 1/4, which was the low here. So I got the low, and then I waited for this fair value gap. Once we traded into that with a down close candle, I went in with 10 more, rallied up. I missed the opportunity to go long 5 more here because I was going to do a 25 watt, and I wasn't able to do it. So I missed it here, rallied. When it hit this order block right there, that was also a time when I could have entered another 5 contracts. I didn't take it there either, and I just watched it run up. And I realized that I might as well just show it to you.
It's a 5-minute
and record it on my phone. Don't trade on your phone, folks. I'm only showing you when and how I can, because if I'm out and about with my wife, or if I'm doing some things and I but also see something on my chart, or if I set an alert that has my attention drawn to a certain level, I know what I'm looking for, and I'll teach you how to do alerts and set your charts up so that way you don't necessarily need ICT after this year, because that's the part of this whole endeavor this year, to make you independent. You won't need me. You won't need to do anything with anybody else. It's going to be 100% you and you'll be able to trust what you're looking for. It doesn't mean you're going to be perfect. Doesn't mean you're going to be a high strike rate with accuracy. It just means that you're going to know what you're looking for, and you're going to continuously do that and get better. But the market trades to that 40, 72 and 3/4 level here. I start peeling off the 20 contracts. I got off at 5 with 40, 72 and 3/4 on this one, 40 and 72 and 3/4 on that one. So 10 contracts of the 20 came off exactly at that level. And then at 40, 73 even, I peeled off 5, and then I got stopped out on the balance. If you look at the recording I shared on Twitter, it's a small little video. I actually had my limit order to get out at 40.76, and the reason why I picked that level is if you look at this low and you take your Fibonacci and extend it to this here, the projection on that level takes you up to 40.76 and a quarter. And I'll let you have that for homework, that way you can see that. But I want to get out early. I'll sacrifice the actual best exits because my weakest point as a trader, okay, my weakest link is my exits. And it's not because I can't see profitable exits. I demand, which is unrealistic, and I shouldn't be saying this to you because some of you are going to think that that's what you should be doing too. But the thing that plagues me as a trader, it's not entries. I have lots of entry techniques. I want to have the best exit. And the only way I satisfy that desire that makes up me as a human being, I believe perfection is going to be reached, subconsciously. I know, reality-wise, I'm not going to obtain perfection, but my subconscious is constantly trying to manifest that in my exits. So over the years, I've learned where I think the market's going to go as a best case scenario. Then I'm going to try to get 80, 85% of that price run. And I also will partial out in the vicinity of where I think that 85 to 90, maybe even 100% run will be. And that's exactly what you see me doing in my exits all the time. You see multiple scaling out because that is what I wrestle with as a trader. And I don't believe I'm ever really going to conquer it. And to be frank with you, I really don't need to. Because what I do is, in the opinion of other people watching and other even seasoned traders, the opinion is that I have very good precision and my placements and grouping for my exit and entries are phenomenal, which is wonderful. And I can appreciate their observations. And that's wonderful as a trader and as a man that strokes my ego. But as a technician, the man, Michael, my obsessive compulsive disorder says that it's not good enough. So therefore, I have to continuously strive to be better at that. So to help compensate for that internal wrestling match, I developed a methodology of just simply accepting partials in an area that is very close to where I think the best case exit would be. And sometimes I get very, very close to the high. Sometimes I'm maybe 10 handles, 15 handles away from the high. I'm trading and exiting that trade in the direction of my profitable direction. In other words, I'm getting out while the market's moving away from my entry. That's how I'm viewing it. So I'm not sure if that is helpful to any of you. Maybe your weaknesses are entries. Mine aren't. In the beginning it was. I had to desensitize myself, which is about the process of going in, is pressing a button and not worrying about the outcome. And you probably see me do that with my son. I'm trying to work with him with a $50,000 hypothetical account. So my trading view account will be basically working with him. So it's not a matter of me showing you precision because I'm going to be doing things with him, and you'll probably hear me talking about it, and he'll be probably next to me in the live session where I'm saying this is what I'm doing here and watch what I'm doing here. So that way you're benefiting from a lesson that I'm actually giving to my son, but it's to help him desensitize himself to entries because he's fearful that he's not going to be as precise as he feels he should be, which is unrealistic. In the beginning, you're not. Okay, so I hold on to that level of expectation of myself on my exits, but you have to be able to get into the trades. Exiting is easy. You can come out with a static, get 5 handles, and once you get out. That's why I'm teaching you 5 handles. I'm not saying 5 handles is all you're going to ever become good at, but it's a target that's realistic and easy to aim for. There's lots of opportunities for 5 handles in price fluctuations intraday, but over time you're going to graduate maybe 30 and upward. 20 tick trades are numerous through the course of an entire trading week, a job. You have the ability, employment income, which will be priced better than you've ever learned before in a live account and in profit. Your personality, you to go into your demo account and draw down to, if you don't. So hopefully tomorrow, and I will touch base. Other than that, enjoy your weekend.
All right, sorry, Michael. I've already listened to that before. It's gonna same things. All right. Power 3. I do want to write down some notes because I thought that this was pretty saucy. Power 3 can be used fractal. Well, I kind of understand that. It's also nice to get notes, 8:30 opening price is the trigger for the AM session and can also be used as a filter of power of 3 for accumulation, manipulation, and distribution of a fractal of time. Daily, weekly, session, and candle power 3 all exists within the scope of time-based charts. We expect prominent lows to form. Manipulation below midnight open price for the daily candle. For that fractal of time. That's all I want to go over. Just that. Okay.
Alright, so I think the recording is.
I kind of remember this. This looks like that's pre-market. All right. I say all right way too much whenever I start switching up. all the really just like that all the drawings, all the annotations are gone. Oh my gosh. Blank chart. Okay, so we gap lower. This is Friday. What is the week done? I'm not gonna open the daily chart because that's gonna spoil it. So the week, Monday, Tuesday, Wednesday, we've had a reversal. Therefore, continuation could be most likely anticipated on a day like today. So I'm expecting to see continuation of this. Maybe another drop below true day open. So I want to see some form of movement upwards. Core PCE. Huh. Same thing, different day. Same thing, different day. What's that level there? That's not the level. That's not even a level, I don't think. Constant curvature of this wick is what we were looking for. Body closed at 25%. You get initial surge higher, come back down. Smart money accumulates more longs at 950 or at 1050, and then we end up having a buy model. Let's look at NQ. We've had prominent Wednesday manipulation, so therefore we're expecting to see continuation Thursday and Friday. I'm curious to see how this new day opening gap reaccumulates longs. Oh, gorgeous. Yeah, I do be moaning over my charts. Since Wednesday, there was prominent manipulation. We can expect that Friday will likely continue within this current IOF. Wednesday weekly reversal profile. Do we have any sort of divert? Oh, that's a yes. Any sort of I don't think we have a divergence at all. Oh. We don't have an imbalance to really rebalance. Yeah, let's just look at ES. Then let's note this. That looks clean. New week opening gap, 5-minute fair value gap. And we're taking this low here, this short-term low. Right on stops. Look at that. Candle range theory, CRT. Balance. I don't know. I never like really looked into CRT. I don't even know what it really is. But I assume it's something like that. Yeah, we're just gonna go over ES. ES. Because ES is nice. We initially search higher. We get. Wait, do we have a SMT? Not so much. Probably with Dow, I would assume. What day is this? Friday the 27th? It's cool. We'll just trust it. Do we take any form of buy side here? $9.50 macro reversal. And $10.50 macro reversal. We don't have SMT there. Is there a 5-minute imbalance at all? No imbalance ever gets traded to. 3-minute? Nope. Nasdaq. There's... Hey, inefficiency on. There's got to be some better jazz. Fly me to the moon and let me play amongst the stars. Alright, let's pull up that Twitter. I'm backtesting ICT, so I'm been backtesting the 2022 model. If you know what that is. That's mainly what I've been looking for. But overall, I pretty much just go in and I just look at my charts. That's how I backtest. Like I don't go in and I don't backtest. Well, currently, that's not what I'm focused on. I'm currently just studying. I would say more studying than backtesting, but I label it as backtesting. This could be right here. I can't get 1 minute chart data on this. Is that 1 minute for? Oh, that's beautiful. I've traded for about a year.
3,000 a week, 2,000 there, 2,000 and 2,003, and we made 400 left side of these. Then it came below equilibrium, so I was interested because it came in line.
Nice day there. 240. Ooh, we have some sort of PM here. There's got to be SMT. No SMT there. We end up repricing back below this. This is just manipulation. Okay, let's look at this Monday. So Sunday we create a gap lower. We just had expansion. We just came from a Wednesday weekly reversal. We're dropping below true day. Are we dropping into a PD array at all? I don't want to check daily because it'll spoil it already. Maybe if there's a daily level here, we could reverse. We're below true day. Oh, now we're probably going to go here. Yep, exactly, bread and butter. Notice how we drop right above true day into a new week opening gap, taking all these clean highs that we have made, and here's a down close candle there on the daily chart. And then I would mark out this imbalance low as well. That's the imbalance low. Drop into a 15-minute. Oh! As you can see, we completely fill in that imbalance on the daily chart. Completely fill that. That's what this initial surge is. New day opening gap. Market structure shift. We have a propulsion block confirmed right at market open. Oh, where's market open expand from? New day opening gap. Then where do we go? We reprice to buy side here. Is there an hourly imbalance? I doubt it. Will we reprice to buy side there? Oh, right to that new week opening gap. Beautifully. And now right above true day open. That's just lovely. And then what do? We end up breaking down right to, oh my gosh. Oh my gosh. This is just gorgeous delivery. We had no news this day though. I still can't get the 1 minute chart. Look at the bodies. Look at the bodies. Respect that. Look how much weaker Nasdaq is. Nasdaq fails to. Oh, smart money's all over this. Where's my tab for data collection? Oh, look. Nah, this is crazy. This is crazy. New week opening gap. Look at that. Look at the bodies. Look at the bodies. Well, if this is consequent encroachment of this wick, I don't know what to say. I don't know what to say. Amazing delivery. Look at that. Look at that. Bro, this little fly, it's been in my house for like, it's not a fly, it's like a little gnat. It's been in my house for a while now. Even balance there, do we have SMT here? That reversal happens with the 950 macro. And we have a 1050 macro short-term repricing. I'm just gonna note the macros within this annotation. That's enough for that day. Did I already go over the tweets for this? I did not.
Monday morning. It's presently about almost 10 minutes after 8 o'clock Eastern Time in the States. Your trading view chart should always be set to New York time. That way you can follow along and everything I'm referring to. Here's the closing price on Friday. And I want to take a notation on that. Draw a little line out from it. And note that we also have a gap lower here on Sunday's trading. We started trading there at the open, traded down initially, and then came all the way back up and closed in that gap from the close of Friday and the opening on Sunday. So that is our new week opening gap. You want to have that noted on your chart like that. Okay, and with this, I want to pull out from this perspective. Right now your chart should be default on best electronic trading hours. You want to click on that and go to regular trading hours. Okay, click on that, you'll see that all those other candles disappear. So here's that same area here and here on 15 respectively on the lower, hourly up here. So if I maximize the 15-minute time frame chart, you can see there's where we were and then where we delivered. Okay, that's why I'm reading specifically for the 9:30 opening range to see what we do. But whenever we have a gap like this, it's more likely that it wants to try to draw in and revisit, because fair value on the daily chart, not fair value gap, but fair value is past Friday's close. So for the 9:30 opening range to see what we do. But whenever we have a gap like this, it's more likely that it wants to try to draw in and revisit, because fair value on the daily chart, not fair value gap, but fair value is last Friday's close. So we got down here, like for instance, say hypothetically we're trading at 40.50 at 9:30. That means there's a large gap between 84 and 50, difference between Friday's closing price and where you open up when you're trading in regular trading session hours. So it's more likely that the market will want to gravitate towards that direction. It doesn't necessarily need to come all the way back up to that gap, but it sets the tone for a soft bias. Okay, when I say soft bias, that means I have nothing to lean on except for that's the minimum expectation right now.
daily high on January 24th. Oh, that one that overlaps with the... That's a level of fair value. What's your model? I currently am trying to discover that. That's why I've been backtesting, but leaning maybe towards the 2022 model. Can you give me advice? You can go for it. Oh, look how well that got respected. This opening range gap was a draw. I trade indexes. I trade NASDAQ.
Start soon enough. We have a volume balance, bullish breaker. We're inside of 5 minute fair value.
It's in my Discord. It's my Discord. It's I don't know. Someone sent it. It's in free. If you go to free resources, it's his Twitter archive, and it's also more than that. It's also something else.
So I'm gonna
It has like all his other videos.
I'll go on a contract. This right here, I'll explain to you. I'll get the right now. Focus on that. Just click on it down. Like the trade up into 47 and a quarter, and then 49 and a quarter. So I'm watching the low and that fair value. Just touch that bottom orange low. Just touch it again. That's all I'm asking you to do, and I'll do the rest.
It's 9:20. 9:20. He's executing.
orange level. There you go, thank you. And we will put a stop loss below the volume imbalance, which we've already traded to, right here. I'm trying to be live in the recording as I hit that and go long there, but it's okay. Now we have this breaker, which is low, high, lower, low. Split that range in half. What do I mean by that? Here, here. 53.25 is permissible. So I can take my stop loss. If we take this high out, the short-term high has to be broken, then I can raise my stop to the bottom of the breaker here, which will still be below mean threshold, which is 53.25. See that red level right here? That's half of that. So even though it can come into this range, I don't want to see it go below that level right there, okay? So right, that's permissible. There's nothing wrong with that. In fact, I'll add to it there just to prove that it's okay. Now I want to see price repel from that breaker and aggressively go through this high and leave the 5-minute fair value gap, which I'll show you in a second here. Bear with me. So these two orange levels here, they are anchored on this right here. So that candle's low, that candle's high. So we drop back down to a 1-minute chart. So my core position is 40.54 even. It's got to trade at 40.59, and I like to have a quarter point more to cover fees and commissions. So it will be 40.59.25. That's what I'm looking for. So it'll be 5 handles, 1 morning session using the opening range and gap protocol that we have a lower gap opening for 9:30. So we'll see what we get in regards to that panning out or not panning out. Basing around the order block, this is 1, 2, 3, 4 candles down. Market should not go below this low. We went to a volume imbalance, which is here. Relative to this low, that high, we went to equilibrium to discount. We should expand up. I want to see large candles expand up into 40.57.25, reaching up into that 3 o'clock in the morning fair value gap I told you on Twitter to annotate, which is up here. That shaded area. I sent that on Twitter. All right, see how we had this little gap here? Price will want to come back down and fill that in. That is a real liquidity void right there. Right there. That's a liquidity void. And I will buy more if it trades into it. I'm not so interested in seeing it now. I can, but I want to see it now, specifically aim for that 59.25 level and ultimately reach up into 61.50. I'm going to try to leave 2-1 for that price, 41.61.5. Remember the level here, that's that 5-minute fair value gap. We're above it now. So they tend to act as what? If the narrative is correct and it's bullish and we're above a fair value gap, they'll act as you would expect. Classic support and resistance that hardly ever works. This is what you're going to be looking for support. So notice we have several factors here. We have this high and this low from the 5-minute fair value gap. So midpoint of that, take it off for a second. So you can do what? For another buying opportunity. So watch that level there. And if you can hit it, we can do another long pyramid. Hit this and fill in that little liquidity void right there, which will be basically the upper portion of this order block here. So mean threshold would and should be respected there. But there wouldn't be anything wrong essentially with touching the lower end of that fair value gap on the 5-minute chart as well. So here we go. Come on, just a little spike down in that little gap there. Boom, there you go. Thank you very much. Thank you very, very much. Now you can go higher. Stop, still down here. Want to see large ranges run right up into 40.59.25. And then I can do my moves like Jagger. Remember I mentioned how we could test the bottom of that fair value gap on the 5-minute chart. We got that here with the reaction. Now I'm doing all this over one chart. It's because I have a lot of monitors doesn't mean I'm monitoring multiple positions and doing it both directions. It takes a whole lot of energy and focus to just do this. And while I think I'm above average, that will be above my pay grade. I can't focus on that many things moving. So we're going to be doing, let's see, we got 14 contracts. Let's take 5 off. If we can hit the 40.59.25 level, so that will give us 5 handles for the morning with using the 5-minute fair value gap I used as a draw on Liquidity Public on the Twitter feed. Just about 30 seconds or so from the opening.
Market's about to open.
Main threshold. Remember that 54 level down here? It's all part of stop management. 15 seconds opening. Everybody wants to sell short. Excuse me. And they're going to get their faces ripped off here. And Lunchtime. Rip it up there.
No, that's wild.
Lunchtime. Rip it up there. Everybody's up here. Come to daddy. Come to daddy. Oh, this is so fun. Remember I said we can go down to what? Main threshold here. And it's exactly where we went to. Beautiful. Beautiful. Yes, 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 yes. And I think I just went negative 1. Yeah, I did 1 contract over. That's okay. And there's the business.
Oh, I didn't even see that. There's an inversion. I didn't even see that either. Oh my gosh. Oh yeah, that's a nice entry right there.
Trying to do a recording, but for whatever reason, Camtasia was acting up. It was giving me errors on the 2 recordings I did, so I wasted 20 minutes of my time trying to record something. So I don't have the time to do a Twitter Space tonight, so I'm tired, and I'm gonna go over this here, so that way it'll be hopefully enough. All right, so real quick, I want to get this out of the way. I mentioned on Friday that there would be several other levels on the upside that I was interested in. Should we have continued up? And let me take you real quick over here. I promise I won't try to be too long tonight. I know I usually say that kind of stuff and it becomes like a field trip. But we had this old high that was 4090.75, and then we had the next level on the upside was the constant encouragement of the candle. This is the daily chart, December 13th. So that's this level here. So between that, this level here, this high, and that consequent encouragement, if you put a Fibonacci on to measure that level here and here, it's 4104.25. That's this level I had over there. And then from that point, we have this level halfway, and then the constant encouragement level up there. So what happens after that is we have the low, the midpoint, the high. So from high, we have this next level here. That's 25%, 50%, 75%, and terminus. So that's what these other levels are for. Okay. And obviously, if it went over here, it's not important anyway because you'll probably see more of this stuff throughout this year. But I know some of you are looking for that to be explained. You can see that being explained here. All right, and on the 15-minute time frame. This morning, if you haven't looked at my tweets for today, January 30th, 2023, around 8:15, 8:25 in that vicinity, New York local time, January 30th, 2023, I posted a pre-market analysis video where I outlined this very thing here. Okay, the new week opening gap. I'm going to spare you the 2 minutes or so that I did that. Oh, nice guys, see that? I'm going to drag you through 45 minutes of other stuff, right? No, but go through the tweets this morning, and you'll see that all the things I'm outlining here were before the fact. So the market was trading down here around 40.52 vicinity in the area. And I mentioned that if you look at the market with just electronic trading hours only, you miss the gaps like this up in here. So it's important for you to know where they are, and the way you see them is you use regular trading hours and electronic trading hours. That's how you find them, okay? And I'll walk you through a procedure like I did this morning when it's important to use. Sometimes it's not important to use them, okay? And you'll see those procedures right. Rather, and processes that I go through. Doesn't mean I'm going to be right all the time, but I think everyone that's been paying attention this year, I got your attention, don't I? So all I'm asking is just come every day, show up with a notepad, and you'll learn more things. But we have the gap, which we traded up into later in the morning, and this level here is the order block from the daily chart. So let me go back and show you what that is. If you look at this candle's high right here, the date is the 25th. So if you drop a horizontal ray on that candle's high, the high being 4040.50, that is the order block. Okay, so it's also the low, the fair value gap between this candle's low on the 27th, Friday, and last Wednesday's high. That one single candle on Thursday, that's your fair value gap. So we'll drop down into 15-minute time frame again. So you can see how we had that reaction off of the order block on the daily chart. It only went down 1/4 of a point below it. What's below that candle? I'm sorry, I misspoke. It's a half a point. The low was 4040, and the level was 4040.50. So half a point variance. Then reaction sent it higher, trading up into that level here. Now right in here is where I was tweeting and talking about how the pre-market is likely to see us return back to that new week opening gap. So watch that small little video. It's on my Twitter feed. It'll show you how to map this very specific range out and what its use is meant to help you throughout the trading day. So we're going to drop down into a 5-minute chart. Map this reaction off of the 7th Friday and down 1/4 of a point, 0.40, half a point out of the pre-market. It'll show you how to map this very. So we're going to drop down into a 5-minute chart. And this is the fair value gap I mentioned this morning. I said that's important. We'll use that as an upside draw. I had these levels here annotated in the chart. They were just made darker so that we can see it because once I posted it on Twitter, it's a little faint. But you'll clearly see that they're there. That's a 5-minute fair value gap. And if we're bullish, we're expecting price to get up to here. Once it gets above it, we like to look for these levels here to act as what support. Okay, and right away you can see a whole lot of business going on here, and I'll zoom into the lower time frame in a second. But the premise was I wanted to see a go, and I outlined all that this morning. I walked you through the logic as to why I think it's that way, and we didn't have any real economic news to really base a whole lot of this on, except for this is what I refer to as a soft bias. A soft bias is where only technicals are used. There's no injection of volatility. There's no calendar event, no big 8:30 news driver. So you kind of like have to wait until we get closer to that 9:30 equities opening, New York time. Okay, so I'll drop into the 1-minute chart and get this over for you. I know it's probably taking too long for some of you younger folks. Get to the point, ICT. The point is, you're in the right place. All right, so this low here, right here and here. Notice those are relative equal lows. Well, why didn't it go below that? It doesn't need to. Why did you have this fair value gap noted here? Because it took out this short-term high. So this short-term high becomes a shift in market structure that's bullish. Well, why should I expect that? Because I outlined it this morning that we were likely to go back to that new week opening gap. The stuff that's up here. Okay? So that's the draw on liquidity. That's the part I'm going to be teaching you this year live. So that way you can see it, understand it, know what it's like to do it on your own, and you'll have plenty of experience doing it, and you'll be able to determine where the market's going to go to next. Because if you get that figured out, that's 80% of the battle right away. So then you can go in and look at all these little intricate things inside of price action. So we have a low that was taken out here. We don't need this low taken out. Why? Because it shifts above this low. This high. Market structure is now bullish. Does it leave a fair value gap? Yes. It trades down to halfway, which is consequent encroachment of the gap. Some of you are new. It's going to go right over your head, these terms. I promise you, I'm talking about all these things continuously and explaining what they are. 3 consecutive down closed candles is a bullish order block, which is also midpoint of that gap. Gap is defined by this candle's low and this candle's high. The one single candle in the middle, that's the fair value gap. Market rallies, creates a small little volume imbalance in here. I like that. Here is this down closed candle, which is a propulsion block. Okay, propulsion block is a down closed candle that approaches or goes into a previous order block that's lower, which is what we have here. I like to see nothing more than half of that candle be traded to, and we see that occurring here. Look at the bodies. Yes, we get a wick, but look at the bodies expecting return back to this midpoint short. But look at the precision there. That is perfect. That's algorithmic. When you look at how I look at price this year, you're never going to look at a candlestick chart ever again the same way. You're not even going to reach for a bull flag. You're not going to look for a head and shoulders pattern. You're never going to reach for a diagonal trend line. Those things are going to be cast aside, and you're going to focus in on the open, high, low, and close. That's all the algorithm is working with, and it's using time. Okay, so the time of day here, we're approaching the equities opening. We have relative equal highs here. What's above that? Buy side liquidity, and more specifically, those orange levels are a 5-minute fair value gap. We're bullish. We want to see it trade through that. So it'll act as a speed bump, but it's not a barrier or a brick wall. So you can see it's happening here. It stops it, consolidates, rallies up above it, and comes right back down into what? This candle right here is a breaker. We have a low, high, lower low. So sell side below these lows here has been taken out. It's been absorbed, and then we went higher. Find the breaker, which is the up close candle, inside the swing high between the low and the lower low. All of this is taught on my channel. Find the midpoint of that. That is mean threshold. It trades down into it here, and I'm accumulating long positions here within this volume imbalance as well. This is what you watch me do in the morning recording, where I was accumulating my long positions here, talking about how I can go down to consequent encroachment, midpoint here, that's permissible, and then we would see it rally up into this shaded area here. There's my executions, and then later in the day I did the move into the target actually called in pre-market analysis. So we'll take this off for a second so you can see what I'm referring to going forward. So the market does impact vault higher. Look at the bodies respecting the fair value gap I mentioned ahead of time this morning. Comes back down in. This move here is a buy side and sell side inefficiency. That is not a liquidity void. It's called that. It's not. This right here is a liquidity void. Let me take that off for a second. See, there's a gap between this candle's high and closing price being the same thing, and this candle's low and it's opening, same thing. There's no price touching or overlapping between these two price points.
It's not even a wick.
That is a liquidity void. A volume imbalance is my range between where one candle's body and another candle's body doesn't touch, but there are wicks that overlap in between.
Okay. a liquidity void is no trading at all.
So there's the difference between volume imbalance and real liquidity void. They're mine. You're not going to find them in books until I mention them, obviously. Buy side imbalance, sell side inefficiency here. So it's inefficient in what? Sell side. So you're going to be waiting for it to come back down. How far can it come back down? Midpoint, which is consequent encroachment. So buy side imbalance, sell side inefficiency, consequent encroachment. Already, you guys out there that want crossovers and moving averages are already thinking this is too complex. It's not complex. It's just you don't know the language yet.
The grind's real.
Looking for areas where the market's going to pull back into an inefficiency or run stops and go up to a level to fill in an inefficiency or run stops. That's it. And the only way you have to worry about anything is first determining what's the bias. That's where you determine, is it likely to go higher or is it likely to go lower? And then you just look for two different parameters, one or the other. They both don't exist. And then you simply read the tape. You watch it go forward. The market rallies up. You are already thinking this is too complex. It's not complex. It's just you don't know the language yet. All we're doing is looking for areas where the market's going to pull back into an inefficiency or run stops and go up to a level to fill in an inefficiency or run stops. That's it. And the only way you have to worry about anything is first determining what's the bias. That's where you determine, is it likely to go higher or is it likely to go lower? And then you just look for two different parameters, one or the other. They both don't exist. And then you simply read the tape. You watch it go forward. The market rallies up. Buy side balance, sell side inefficiency again, much like this one here. Trades down to the last candle here, which is the bullish order block there. Perfect. What's the opening price on that candle? 405.8.50. What's the low on this candle right here? 405.8.50. Perfect. You can't improve upon it. I know it's wonderful. Rallies again. Buy side balance, sell side inefficiency. What's this candle here? Bullish order block. What's the high of that candle right there? 4061.75. Now here's where it gets a little tricky. We have a gap here, that shaded area. It can return back to consequent encroachment, midpoint, or all the way down to the bottom. Look where the bodies stop. The damage is done by the wicks, but the narrative is told to you by the bodies. What's the high of that candle here? 4061.75. What's the close of that candle? 4061.75. Perfect. That's algorithmic. The market rallies. Gosh, this up. It's a little weird looking. Rallies all the way up into here. And what's it trading into that right there? Well, let's scrub back and do some further investigation. I know. ICT, if you just do this trick I know on TradingView, you'll be able to go back and do this and do that. I know. I'm an old dinosaur. I like to do things stubborn way. Alright, so between this candle and this candle here, which doesn't look all that obvious right now, let me go back up to 5 minutes just to communicate what I want to show you here. Alright, right in here, if you look at how we went back up into Friday's close, which is this here, 84 even. See that closing price? 408,400. And then we opened on Sunday right down here. So that's what I'm giving extra value here. I'm saving some of you the time to go look at that Twitter. This is the opening gap on Sunday. We went up to it, filled it in, came back down. Now we are what? We have redelivered to this range, the range between Friday's close and Sunday's opening. We delivered what? Buy side and then sell side. Is that a balanced price range yet? No. It's got to leave it. It rallies back up to where? Consequent encroachment, midpoint. Then it leaves it. Now when it leaves it, it does so here. What does it leave in its wake? That fair value gap right there. It's the only one of its kind. So that level is important. I said this morning in pre-market analysis that it can return back to this fair value.
What?
The weekly gap opening, and it does not need to come back to Friday's close up here. Why? Why did I say that? Because of what is outlined here. It opened here on Sunday, traded back up to Friday's close, delivered what? Buy side, then sell side. Then halfway, it fails to go higher, and then leaves the range. The only thing that's inefficient at this point now is that small little fair value gap right there. Now, scrub on over here, and look how perfect that is. But where did you get out at ICT? I didn't get a perfect exit. This is what I have a struggle with my exits. That's my weak point of my trading. So you can see the high was 40.78 even, and I only got out at 40.76 and a quarter. And I wasn't even able to time it where I can get out in between the gap. So, I mean, it's still better than 5 handles again. So, 2 times, 5 handles, 5 handles, 10 handles, between 2 points, to a level I was calling for, to a bias based on everything technical that I've outlined, and everything was just beautiful today. Beautiful. And later in the day, a little bit of a messy move, but I want to pull this out and I'll close it and take the executions off. I apologize. I'm usually much more organized, and I just want to get through it. I'm kind of tired. So we had this low here prior to this run up. So what's going to be below that low? Sell side liquidity. Okay, why? Because we had that used off of what? The daily order block. Remember, this is the low of the daily fair value gap. And I know I'm saying these things and it's zipping by the new viewers here. Go back and listen to the video again. It won't be that long. And listen to what I'm outlining on that daily chart, what this level is. Okay? First time it hits it, it rallies away and goes to the level that I outlined this morning. Perfectly. Now, at this moment, right here, other retail traders would think it's probably going to keep going higher. I'm not interested in seeing it going higher. The market starts to break down, and we get below that fair value gap on the 5-minute chart. Now, it's going to act as resistance. We wick through it a little bit into an order block. Does it break lower again? Yes, it does. Does the body start respecting that fair value gap in here? It does. So the next time it returns, if it can return to it, what can we reasonably expect? The low and then the half point consequent encroachment. Look at the body of the candle. It's half of this range. You're trying to tell me, okay? You're trying to tell me that retail traders all came together. The planets aligned and everything, kumbaya, they match up exactly where I'm telling you the algorithm's going to have turning points. Get out of here. No way. Absolutely not. There's much more deeper things going on in price action besides your bull flags and your head and shoulders patterns and Elliott wave and harmonic patterns. I'm sorry, but there's a real technical science to this. As much as the Goldman boys don't like to admit it, this is really what's going on. It's all algorithmic. It's absolutely controlled. 100%. Price breaks lower. What's it creating here? Fair value gap. Rallies. Right into it here. What time of day? 1:15. It's a little too early for my liking. 1:20, 1:25, 1:30. That's usually when I'm expecting the afternoon move. Here is 2 o'clock. That's a more favorable time of day. And we have a balanced price range where we have one rally up and then one rally to the downside. It's this small little area in here. It's a fair value gap on both sides. So it's going to have a hard time going through that. And that's what you're seeing here. Where's the sell side? Below these relative equal lows. And so here is 2 o'clock. That's a more favorable time of day. And we have a balanced price range where we have one rally up and then one rally to the downside. It's this small little area in here. It's a fair value gap on both sides. So it's going to have a hard time going through that. And that's what you're seeing here. Where's the sell side? Below these relative equal lows and below that low there. And I was in another YouTuber who I like and I'm supporting. So don't take this out of context, Patrick. But Patrick Weiland, he has a live stream. He calls his own moves. He's doing it out there every single day. And he's another YouTuber I like. And you're welcome to go check his channel out. Please don't go there and talk about me because that's not what this is about. You know, he's putting his time and energy into trying to show you how to do this stuff his way, and that's cool. But I posted that 40.45 was where I was looking for the afternoon, and you know the fair value gap show here. If it's below it, it's going to be acting as well as resistance. So when it hits the 40.58 level, starts to break down, we're going to be looking for 40.45, and 40.45 was nailed here, ran up into a fair value gap, broke down, relative equal lows, balanced price range in here. Trust me, you'll hear more about this stuff all year long. It'll make more sense to you seeing it live, called, explained. That way you can see it. If I can't do it live, okay, it's going to be of no use to you. That's the whole reason why I come out here this year, so that way you can see it. I can walk you through it, give you a better understanding. That way you can see there's no cherry picking. Okay, I mean I walked the whole day out this morning, you know, before the market even started trading. So balance price range here, and then it's going to attack that low right there. Why should it be attacking that low? Because this is where the majority of the move this morning started, and traders on a fund level are going to have their orders down here. What kind of orders? Sell stops. They're not in the habit of running up and trailing their stop loss because they're trying to catch more sizable moves. Well, what fund manager is going to be holding it? You'd be surprised how a lot of them don't know what the hell they're doing. Just because they're running a fund doesn't mean they're profitable. Just because they have a fund doesn't mean they know what to do. So, but they have a lot of money behind them. And that's where the market's going to go, where the money is. Where are the orders? Not the harmonic crab patterns, okay? Not these Elliott wave counts. You don't need to count anything. Just count your profits. That's all you got to worry about. Show up every single day. Show up every single day with an impact. And I promise you, I will deposit more understanding in you than you'll get from any resistance. So when it hits the 40.58 level, starts to break down, we're going to be looking for 40.45. And 40.45 was nailed here, ran up into a fair value gap, broke down, relative equal lows. Balanced price range in here. Trust me, you'll hear more about this stuff all year long. It'll make more sense to you seeing it live, called, explained. That way you can see it. If I can't do it live, okay, it's going to be of no use to you. That's the whole reason why I come out here this year, so that way you can see it. I can walk you through it, give you a better understanding. That way you can see there's no cherry picking, okay? I mean, I walked the whole day out this morning, you know, before the market even started trading. So balanced price range here, and then it's going to attack that low right there. Why should it be attacking that low? Because this is where the majority of the move this morning started, and traders on a fund level are going to have their orders down here. What kind of orders? Sell stops. They're not in the habit of running up and trailing their stop loss because they're trying to catch more sizable moves. Well, what fund manager is going to be holding it? You'd be surprised how a lot of them don't know what the hell they're doing. Just because they're running a fund doesn't mean they're profitable. Just because they have a fund doesn't mean they know what to do. So, but they have a lot of money behind them. And that's where the market's going to go, where the money is. Where are the orders? Not the harmonic crab patterns, okay? Not these Elliott wave counts. You don't need to count anything. Just count your profits. That's all you got to worry about. Show up every single day. Show up every single day with an impact. And I promise you, I will deposit more understanding in you than you'll get from any other books out there that talks about technical analysis. And I promise I'm going to do it in such a way where it will be fun. It'll be engaging. You'll have drills, homework that you'll want to do, not like it was when you were in school. And you'll feel better about what you've learned at the end of the week. There'll be so much more understanding that you don't even really understand what you're going to see. but I know, and I can't wait to share it with you. So hopefully you found something in this insightful. Hopefully I didn't run through it too quick. I know I'm usually long-winded and go into a lot more detail, but I'm tired, so I gotta get some rest. Otherwise, I won't be able to assault you on Twitter tomorrow. Until next time. All right, so
Alright, I'm gonna pull up Twitter here. Oh, my audio was low for that. Oh, my audio was low for that whole section. I didn't realize it. Look at this high resistance into a fair value gap. We're not really displacing. And once we do displace, we're gonna respond to this. I'm gonna be active on Twitter here. I never saw that. I never saw that. Wait, is that the same thing? That's not the same chart. It's on ES. Price breaks through that. This also is an immediate rebalance. Any reason why you prefer trading indexes? I've honestly never really tried just trading stocks. I think indices, well, they pretty much is like I'm trading stocks. It's more predictable. I at least I think. Hello? Oh, here we go. Alright, now it's when Twitter. It's gonna log off Twitter. I would honestly. That's just my opinion. Is it weird to like your own stuff? Let's get into the charts again. January 31st. It was a PM session example. Woo! 8.5 hours going strong. I look, you want like a little brain break from ICT, honestly. Let's see if there's any other thing, any other lecture that would be cool. Ah, beautiful.
Alright, what's going on, guys? Market review today, July 12th, 2024. So, I shared this fair value gap this weekend in the Discord. Okay, my bias is still bullish for the week as long as we don't close past any threshold on this order block. So, if you take these 3 consecutive down close candles here, that is one order block. It's a little cleaner on a 2-day chart here. See that? So, daily chart here, just take the high. If you put that on your own charts and draw it all the way through, you'll see that we just traded down to the bullish order block and also into the high of this fair value gap here that I shared in the Discord. And you see me, I have that labeled daily BISI high. Okay, buy side imbalance, sell side inefficiency, BISI. So let's drop down to a lower time frame, 15-minute chart. Get a little bit more detail on what took place today. So right away, okay, we have, and my apologies, I should actually have the midnight opening price here. All right, so we had high impact news, I believe PPI at 8:30, and notice what we do here. Nasdaq leaves relative equal lows here, right above the high of that daily fair value gap. Okay, so there's sell side underneath these lows. 8:30 high impact news driver. Okay, we drop down. What do? We do 3 things when we drop down, okay, with this move here at 8:30. What do you think those 3 things are? 1, we're sweeping the sell side, okay, smart money is buying those sell stops. 2, we're trading down inside of the daily fair value gap, okay, that's a higher time frame PD array. And 3, we're trading down below the midnight opening price. Okay, so that's 3 converging factors as to why it's possible to see higher prices. Okay, if you also go to your daily chart for dollar index, you'll see that dollar was bearish, looking really heavy. So that's another reason, okay, another factor as to expect higher prices in the Nasdaq. Now, look on the liquidity curve here. What is a reasonable draw on liquidity, okay, for the AM session?
No lie, I don't know. Okay, let's look at the charts. I want to take I want to take a little break from the 2023 stuff. I just want to go into a random date. We got like 3 hours left of this shift. The good old backtesting shift. Oh, this is all nice. This is all nice, PA. Or actually, let's just go for the next day. So we just ran up to new week opening gap here, right in that 5-minute imbalance, formed SMT, then we sold off to a random level. Notice how the high and low day occur within these, or the high of the true day. This is all Asia session. I don't really care too much about. So we have a new day opening gap. Okay, so we're coming into sell side here. We have this imbalance right here that was left as a breakaway gap in balanced price range. $2:45 a.m. Yep. As you can see, that's right where we put the low. Let's see. What's constant recursion with that? We've taken sell side within a 1 hour imbalance. 1 hour balance price range. Higher prices are likely here. We change state delivery here. Here's the breaker, 1 hour breaker. We open within that. Within a breaker and a fair value gap at open. Looks like this could be a Tuesday low week. Put it equal low as that body. Is there a 4 hour imbalance? We sweep this body though. And now, if I were to be, I would expect to see this high get met soon. Oh my gosh. That's beautiful. That's beautiful. Smart money's actively buying this. Consumer confidence is the news. See lower lows here. Actually, I'm just gonna go over NASDAQ. Right at a weekly order block. There's that breaker level. So this very small imbalance. 1150 macro. This is 2022. Oh, we barely don't. Let's check some of them boys' tweets.
Good morning, folks. It is Tuesday, the last day of January. Already, the month has gone like that. I tweeted this morning the consequent encroachment of the daily chart here up in the left-hand corner. Let's maximize that chart. So if you look at the candle right here, this is January 25th of 2023. and I've measured the close to low. Consequent encroachment is 3997.75. That's this level right here. Okay, so the blue dotted line, that's what I have annotated on the lower time frame charts as we progress down. And then this level here is the order block, bearish order block. So we've come up and bumped into this, bumped up into that daily bearish order block. The order of retracement that we've seen here is all hinging on what I'm looking at. Is this as a point of interest, something that we could potentially trade to today? It could avoid it entirely. Before the market trades in the opening in New York session, I'm looking for reasons to justify why the market should draw to a specific point of liquidity or inefficiency. If we trade down consequent encroachment of this gap here up into a premium array on the daily chart, even though this is a hourly chart, this level is the 26th of January's low. We're going to go down to a 15, so you can see that level down here. So while this is a point of interest for me this morning, if we trade above the bearish order block relative to the 26th low, I'm absolutely neutral on the morning, and I would have to wait for more information. And it allows you not to push, not to rush, not to force a trade just because we have a level that we're interested in or that I make mention of. We have to wait for time of day, and time of day is crucial, and everything changes technically if levels are not respected going into those starting time points, more specifically 8:30 in the morning and 9:30 respectively for the stock index futures. So sit on your hands, there's nothing to do.
Time of day is crucial. They're waiting for the news driver. Sloppy, sloppy, sloppy. News driver. Expansion. Retracement, expansion. Consolidation, expansion. Retracement, expansion. Reversal, retracement, expansion, retracement, expansion, reversal, retracement, expansion. I think that's how it goes. I don't know. I feel like those are the type of market cycles you can make as complicated as you can. 5-minute volume imbalance. Right here.
I tried to get this recorded, but I couldn't make it to the office fast enough to start the recording. Open the trade up on my phone using the order block here. Actually trading on the premise that it's a market maker buy model. And
Yo, what's good, brother?
New week opening gap, which is what I mentioned this morning on Twitter. So that might be viewed as a breaker, that shaded area here. It's not a breaker. It's just a speed bump. It's going to go through that. Most traders that would be trading quote unquote my ripoff edition of smart money concepts, they would see that as a sell. It's not. So it's going to be drawn to this buy side liquidity here. And there's an order block right there. I will add after notating this draw on liquidity. So my mind is thinking it's going to draw off that level there. We're digging out into that down close candle. Going to highlight it and then add. I can trade down to the midpoint of that, which is mean threshold right there. That's good. That's not a problem. Unless it's a compulsive disorder, it won't let me leave that trend line the way it is. Alright, so let's run over here, add 5 more contracts. And it's going to want to vault quickly to take out the high of the day that's noted here, where the buy side liquidity is. I'm going to lighten this up, it's a little too dark. Alright, so I see expansion, a lot of speed. Good stuff, break even. So I already know I'm on side now. One side means I'm right. Well, let me rephrase that. I'm most likely right. And it should be aggressively trading to the buy side and up into that new week opening gap, that shaded, like orange level. So I'm following along on Twitter. It isn't going to make much sense to you why it should be doing this, but I comment on this morning. Okay, most recent down close candle. Watch that high, that candle to its open. That'll be a very sensitive price point. I'm not going to add any more to the position now. I tried to upload this in a very short version, like a 2-minute stinger videos, to Twitter, and wouldn't let me do it, not even without having any music attached to it like I usually do. But I'm sure some of you are going to like this better. So you can see how we reacted off that order block, as I mentioned moments ago. Now we just ripped into the buy side liquidity, which is wonderful. Everything's going to plan. So I want to see it drop into 4076.75. That's the low end of the new week opening gap. What that is it's the gap opening on Sunday's trading. So wherever we opened up from Friday's close, the difference between the opening price, the very first tick on Sunday evening, that's the new week opening gap. Okay, I want to see it expand up into that shaded area. I'll draw it down so you can see it. Now we've tapped into buy side liquidity, so it could pull back a little bit. There's a small fair value gap just formed if this candle closes. Okay, so the fair value gap right to the left of us now, 2 candles back. What I'm measuring here is consequent encroachment. I'm going to take 80% of the position off, which will be 20 contracts. All my attention is here, not elsewhere. Okay, and if it gets to 80% off there, my thought process is it'll try to go to the top end of the opening on the new week, that gap, the high end of that shaded orange area. But for right now, my mind is focused on it getting to the bottom where it says draw on liquidity. If you look at the high, it was formed approximately at 320. That short-term high was broken to the upside, and I bought inside the first down close candle as it was going down. I'm buying into that. I'm taking it as an order block. It later touched it again. I didn't add anything there though. I'll show you the executions momentarily. Within striking distance of
The
that
2022
open gap.
model.
Again, understanding narrative prevents you from falling victim to pretending you understand what my PD arrays are, because otherwise, in the hands of a neophyte or a fraud, it just tries to sell my stuff with the labels and such. In hindsight, cherry picking things that I don't do. Here we are, hitting the new week opening gap. So if you pull back into that fair value gap, just below the buy side liquidity pool, I would want to see it support that. If it drops down into that, and I want to see an immediate rejection of that and go higher. There we are. So I would want to see it snap higher. But not knowing what the narrative is and how to really use the concepts I've authored, one would look at this shaded pink area and assume that was probably a bearish breaker. No. And I'll go long in that. You have to know what you're doing, folks. Otherwise, you hurt yourself. And if you're trying to pretend to be a guru with my things, you're actually harming people through ignorance. I know it sounds like I'm trying to prevent other people from making a name for themselves, but none of you are there yet. So now, since we hit the bottom of that new opening week gap, my focus is here, which is consequent encroachment, which is the midpoint of a gap. Any inefficiency, the midpoint of that is consequent encroachment. It's always abbreviated as capital C, period, capital E, period, in my charts and annotations. There we go. So we're looking for off that fair value gap. And that should be a lot of momentum and spring out of there. Big caffeinated candle right there. Yes, indeed. Thank you very much. I'm just waiting to peel off 20 contracts as soon as we touch that consequent encroachment level. It's really fun to be on these type of trades. And there we are. So I'll roll the stop up, lock in 2,000. Okay. And now I have the lines portion of the move already put down. So what I'm watching is, do we find some support without leaving that lower quarter of the consequent encroachment to the low of that shaded area? I want to see it reaccumulate and start to expand higher.
Depends.
And I'll stop is admittedly very close, but I don't care. But at this point, tomorrow's FOMC, it can do anything it wants to do here. It can get reckless, it can just keep on
1
going.
minute, but 5 minute, 3 minutes.
So it makes no sense for me to let it come all the way back down into that blue shaded fair value gap and lower. So that's why I want to stop there. If it takes me out, I'm happy. I'm fine. And now my focus is I want to get to the top of that new week opening gap, which is the shaded area. So I'll start peeling off singles. This has already been done, so I'm going to change the annotation to 80% has been taken off here. And I'll drop my contract selection down to 1 contract, and I'll start peeling them off as we gain the upper half of that new week opening gap. So what I'm doing is I'm watching. See this relative equal highs that's formed right now on the right chart, that 1 minute chart. I'm going to wait and see. As soon as it prints another candle just above that, I'm going to take one off. This is called running down equity. Every time you're in a trade and you have the ability to take partials, and it's a move that's been delivering for a little while now. This is a little bit of a long-winded run here. So I don't want to spend too much time holding on the bulk of my remainders. So I got 5 contracts. I'm going to start peeling them off. As soon as that candle starts to print right above the relative equal highs I have noted now, as soon as it prints just above it, 1 tick, immediately one contract's going to come off. Here's one of those real bull flags. I'm looking away from the monitor right now. I'm realizing I missed the opportunity to do it, so I have to wait. I looked at it and I was like, oh, what the cusp. But I'm confident it's going to run up to the top end of that new week opening gap. So you sit here and you just wait. Now I'm going to watch and see when it makes a higher high, then it's already printed there on that candle. As soon as it does, then I'll peel off one. I'll sell one at market of the 5 I have on remaining. There you go. And I'm going to be watching halfway between where it is now and the top of that shaded area. Approximately, my eye is looking for it to reach up into that. When it does, I'll take another one off. I just peel one off there. So 3 contracts remaining, and just a little bit more. I'm looking for it to pop up though. Now, as a new trader, this is going to be nerve-wracking for you because you're afraid it's going to peel off there, and then at the top of the range, and now I'll want to roll the stop on that final balance. And if it takes me out, I'm okay with it. It's a beautiful price run, absolutely gorgeous. And there's a stop. So I'll show you the executions. You can see they're not on a market full price run. Absolutely gorgeous.
Any tips on how to stay focused for a long time? It depends. First, like what's causing your distraction? You know, I feel like that's the main cause, or that's the main thing you should worry about. If you can't stay focused, what's causing you to lose focus? Is it your phone? Is it the fact that it's probably most of the time your phone and you trying to do different things. So I mean, I don't really use my phone that much. I kind of just put it to the side unless like my parents text me or something like that. It's like, since I'm live for a long time, sometimes like my parents will text me, so then I'll text them back. That's when I use my phone. But I would say find what's causing your distraction and then just try to eliminate it. If you find yourself scrolling through your phone, then just put your phone, just throw it somewhere else. Last hour. Hey, appreciate the sub, Tim. Appreciate the sub. All right, so we just finished January 2023. There's a lot of good price action within that month. Oh shit. Now it's February. It's his. If you go on my Discord, it's in the description. It's in free resources, and then it's I kind of want to look at this. It's not this. I lucky need to delete this. Bro. It's in pinned. It's that right there. It's his archive of like all his stuff, and it has all of his tweets. Should I watch I haven't watched the Market Maker series.
It's really not that high of an interest rate. It's only 0.25%. But in relationship and contrast, price to be experiencing in terms of bullish or bearish. It's going to reverse. That's not the inability for price to make a significant price run lower this series. If you haven't watched, obviously, part 1, 2, and 3 of this series, then
maybe some other time. Okay, is today FOMC? I want price to drop lower here. I think that's 12.15. Where could we possibly manipulate into? Well, we have this new day opening gap. I kind of do like these highs. I would like to see this high. But overall, look for this new day opening gap, and then those possible highs. Let's see what the big boss says.
Well, I swear that you, God.
The burning desire, yeah, I would say having some type of motivation outside just yourself. 100%. That's why I do it. Do that right there. So I think his reasons for this is we just cleared a big pool of buy side liquidity here. All these stops was in here, and then we had all these lows there. I still don't get 1 minute chart. Break a structure. New week opening gap high.
Well, I swear that you, God, we've been down this road before.
What type of music is this, ICT?
And
He shorted at the low of the new week opening gap. I kind of want to watch this real quick. Just for a second. But first, I want to see FOMC delivery. So look for this new day opening gap and then these highs. See where price delivers. That's pretty cool. 230 gets another stage higher. We don't really have an imbalance though. Oh, I guess we did draw into this imbalance right here. So permit it to go all the way as much as previous for fair value gap. And let's look at NQ. Oh, that's the wrong thing. Oh my gosh. Like you can't just like not. You can't say that's not precise right there. You can't say that's not precise there. Sell side once more. Right there to a new day opening gap, and then we just have large fast expansion. Like no, not even a single pip of retracement. One hour. That's a 1 hour imbalance on ES. What's NQ? It's just the volume. Oh, it's a 4 hour imbalance. Okay, so if you get these PD arrays to line up with the new day opening gap, especially during a high news release, that's really what you're looking for. So you see that 4 hour imbalance, that high overlaps perfectly. That's where we drop down right into. That's that's beautiful. That's beautiful. And it looks like we have this new day opening gap that you can't see on this chart. And you can't see this one. That we respect perfectly. Oh. Still backtesting? Yep. Yes, sir. I want to watch this for a second.
Morning, so not much happening until 2 p.m. I agree.
Is this what it's like to watch me live?
Not doing it.
Kind of looks depressed. I ain't gonna lie.
So market having trouble here at the 70s right now, but can it push? You got that liquidity sitting there, 71, 73s up there.
I've never seen.
See if they're gonna eat through that 70,
Like,
71
actually,
liquidity sitting there, 73 after that. Kind of thinking they want to push this back up a little bit. Market makers trying to get to a point where they can kind of be nice and flat going into the FOMC meeting here. Point. When actions. Down. Sit down, boy. Sit down. Sit down, boy. You don't come up in someone else's live stream and challenge them, right? You just don't do that because you already know what you're gonna get. Making $600 on that one contract. That's still not a bad day. What's funny is there was a point in my life, guys. There was a point in my fucking life. Think about this. There was a point in my trading career where I would have, if I made $600 in one trade, I would have been so happy. I would have been jumping for joy. That idea of trying to squeeze.
Alright, sorry, I can't. That's just a waste of time. February FOMC.
Okay, I'm not sure if y'all can hear me or see me, but bear with me 1 second. All right, it should be showing me. I apologize. I had a delay that I couldn't overcome.
Say it was your wife.
I want to show you worrying about providing something to keep you guys held at bay. So I'm looking at the 40.91 and a quarter level. It's too smooth. Now, do we run through that, reject it, and trade back lower? I don't know. Like, I really don't know. So because I don't know that, I want to wait and see how we deliver at 2 o'clock. That first move usually is like not the real move, and then at 2:30, the real move comes in. So it's kind of like a tsunami type effect. So we're more or less just observing. Anything noteworthy, I'll bring to your attention. But right now, I'm watching that 40.91.25. I think that's a little too suspect, too smooth. A lot of action hounds out there, like to trade this and gamble. Not me. All right, just a couple more seconds, and you'll see all kinds of volatility come in. And here we go. All right, so sell side's been attacked first. Now, what I'm looking at here, and I find a little bit interesting, is how we're starting to show off right now with this high wasn't taken out. And this high actually is the consequent encroachment of the new week opening gap. So we didn't go above it. We left relative equal highs here. So here and 40.91 and a quarter buy side, I'm watching how they engage that. Nothing in here is tradable. All we're doing is observing where liquidity is and how the market wants to reach for it and what it does once it does so. So let's see if it wants to swipe above 40.82 and 40.92. Don't push any buttons, folks. I'm not enticing you to do anything. If I felt good about it and strongly about it, I'd be telling you, don't touch it. Now, can you trade it after like 2:45 New York local time? I believe you can, but I don't think anyone should be doing anything with it right now. And that's a general rule. I'm not just doing it just for today. I teach my students don't touch it at all. In fact, but
that was constantly crucial of that new week opening gap. I didn't see that.
Entirely misleading if I said I didn't ever trade it after 2:45, and there's examples of me having done so. But I don't know what it's going to do beforehand, and because of that, that's a gamble. It's not even 50-50 in my opinion. I'm more likely to be wrong. That's how I treat it. So it's a matter of just let the market do what it's going to do, and after the 2:30 portion, because it's a two-stage event for FOMC. This move here, and then the real move at 2:30, and you'll most likely see that in about 27 minutes. I'm going to hang with you guys until about 3 o'clock, and then I'm going to get off here. All right, so far we've tried to go lower once more, back inside the range prior to 2 o'clock. We've taken out sell side here. I'm watching this level, and again, the larger pool of liquidity up here. What's the benefit of doing this, ICT, if you're not going to trade it? Well, you have to understand what the market's showing you. What you're observing is how the market seeks liquidity. And right now, there isn't anything in terms of inefficiency except for this portion of price action up here. This is buy side. Show me when to buy and sell. And it's a whole lot more things you have to understand before you do that. So we've had a bit of, like that, 20, 25 handles or so from the high here, and really no follow through yet. Why anybody wants to trade right now is beyond me. It's just a gamble. These levels are actually a smaller PDA rate. It's not important anymore. So I'm just going to use the levels, or lines rather, annotate these levels are actually a smaller PDA rate. It's not important.
What is that at 955? A smaller PD rate?
Anymore. So
Oh, it's NQ. Yeah. We've cracked it. A smaller PD array, that's not that important anymore. You already drew up into it. Yeah. That's what he's looking for. This was what he's looking for.
I'm just going to use the levels. Why anybody wants to trade right now is beyond me. It's just a gamble.
What level is that? 4085?
These levels are actually a smaller PDA rate. It's not important anymore. So I'm just going to use the levels, or lines rather, annotate efficiency. So what I'm observing in all this is we have buy side resting above this high and this high. So these are relatively equal highs. So that's too smooth in my opinion, much like the highs at 41.91 and a quarter. Apart from that, there is no inefficiencies except for this small little area here, which is what I just annotated with these two lines. So above this level here, if it reaches for buy side, I'm not saying we are. I'm just saying I'm observing it just like you. I'm studying it because I want to try to get some insight leading up to the 230, and then at 230, between 230 and 245, I might be able to see something that would be a case study. I don't want to call it a trade because it's going to entice you all. Okay, I'm getting my order trade, put in for a live trade. Don't do that. But I'm trying to build a case for what would be in play at 230. These relative equal highs, which is above that is buy side liquidity. But how far above that can we go? Well, I think if it goes above that, it's likely to go to 40.92 and thereabouts, just to clear up the initial high. We have buy side here, which if it's going to go here, it's going to bump the 40.92 level. But above these highs here, how far can it go? Well, you can go to consequent encroachment, which is the midpoint of this low to that high. Right there's consequent encroachment I just mentioned. So that buy side is now purged. So I'll keep the level there just for annotation purposes. But it went right up into the midpoint where I just outlined right there. So I don't think that is enough to justify, especially for an event like FOMC. So we're going to see, does it have a lot of energy to reach through the high end of this fair value gap? And this fair value gap is a SIBI, sell side imbalance, buy side inefficiency. I know it's a mouthful. It means simply that this candle was a delivery on the downside, so it's offering sell side. So it's sell side imbalance, buy side inefficiency. It's inefficient in its ability to offer anything except for downside. So the way it's repriced to, which is about to happen here, it'll go up and touch the top of that level here. And, well, there you go. Now that's repriced. That's not rebalanced. That's not rebalanced at all. It needs to leave this range, try to go to it here and go lower, or go above it, come back down, and then rally. So the only thing it's done now is just repriced back to this. It's not balanced. Okay, as much as it may seem like it is. Buy side inefficiency. It's inefficient in its ability to offer anything except for downside. So the way it's repriced to, which is about to happen here, it'll go up and touch the top of that level here. Yeah, well, there you go. Now that's repriced. That's not rebalanced. That's not rebalanced at all. It needs to leave this range, try to go to it here and go lower, or go above it, come back down, and then rally. So the only thing it's done now is just repriced back to this. It's not balanced. Okay, as much as it may seem like it is, it's not. So I'm looking at this high here now, where retail traders have bet the farm on this going lower, and hey, they may be right today, but my mindset is always attack them. So buy side's above here. Traded below old lows. These lows, we traded through it here. This low was traded to it here. This low was traded through here and rejected, leaving this high and that high, which is what I had here lined up for buy side. We reached into that. I mentioned that we would go into this SIBI. This candle's low, this candle's high. So midpoint of that's consequent encouragement. You saw it deliver there and then deliver to the high end of it now. Now watch what we see here. We've completely went above, and now we're leaving this range. Now it becomes noteworthy because if we have a willingness to trade away from it and come back onto it one more time, and it shows a willingness to not go back inside these two blue lines, that would be, in my opinion, but it's too early because 230 is the real move. That would be something I'd be interested in seeing if it could trade lower. I'm not suggesting that here. I'm just thinking out loud without the charts. And this is what we're going to be doing mostly 2 times a week this year. I'm going to read the price. I'll tell you what I think is going to happen, why it should happen, why it shouldn't do certain things. But do not take what I'm saying today as an invitation for you to be pushing the button either today or in the future FOMC. If I was confident that I was going to be able to go in here and just navigate without having any harm to me, I would simply just be doing it. I wouldn't be here talking about it over the chart with you. I'd be in here pushing the button, recording it, and doing the whole business like I usually see you do. I still favor the buy side here. I think that's where we're going to rip into that. Now, what I want to see is exactly how we trade after this high and 40.92 is traded to. Do we explode through it and trade into the 41s? 4100 rather? I don't know. But I just know right now I'm observing this area right here. It looks just too clean. And it's this high here that had this high. And then we had all these attempts to go lower. Notice that? This low was pierced here. This low was pierced here. And then this low was pierced here at the 2 o'clock driver when it first, the first part of FOMC. Came back up to our full liquidity we were looking for. Consequent encouragement. Full repricing to the inefficiency here, and we've yet to go above this high. To me, any kind of staggering and I guess stalling shouldn't be trusted. I wouldn't trust any of it, and that's really the characteristic of this day. Why I tell my students not to trade it, because obviously if you're learning from me, chances are you're probably unseasoned as a trader, and you're not really versed in terms of what it is you should be doing, and you're more inclined to want to push the button to get in here and to see what happens. This is a day where you don't want to push the button to see what happens, because you'll find that it's extremely painful, and it can move real quick against you, and your stop loss might not be all that much help to you. So that's the reason why I tell my students not to trade it. I get wise guys all the time say, oh, look at this trade I made. And ICT says, don't trade on that day, but here I am doing it. Okay, well, why don't you do it live? There are always those kinds of guys. And that to me is irresponsible for a mentor, for anyone to come out and encourage new traders, new students. They have not proven themselves to be disciplined to engage in an environment like this. It's equivalent to trading like on non-farm payroll. In about 15 more minutes, the real move will begin. And it should be starkly different than what we've seen so far since 2 o'clock. Usually the second part that happens at 2:30, that's the one that brings the real motion. Remember what I showed? It's in my head. Candles low. We traded down FOMC day. I would use that as a institutional order flow entry drill and expect it to rally up and attack a buy side liquidity. When I'm doing live tape reading with you, I'll say, okay, well, you're meeting, like when I'm buying checks, and then I'll go down to 3. On this, we'll start seeing, but it's going to specific price elements in price action that repeat over and over again and offer like a reason to anticipate price doing something. Watch the top of this candle here. In here, and in the middle of that is mean threshold. Half of that is consequent inefficiency in price action. Trying my best to get back to the house. I was doing something with our RV and preventing me to get back here in time. I wanted to be here 1:45 and give you. The market is what it is right now. I'm still favoring, even though we had this movement here and this retracement down, I'm still favoring this area. 4,100, I don't know. Please don't tweet to me. Observe this chart here. And now we're above them. How many highs have been taken? We've had this high taken here. We've had this high cleared with this one as well. This high has been cleared on this one. So we only had what? One high. This one impulsive price move right here has done all the work of clearing out this, this, and this. But what did it leave? This. And the high at 40.91 and a quarter. A reason for trading land. There could just because of it, because I'm telling you, every time we have FOMC, I'm thinking that 40 priming. Okay, and priming is where you more or less coax a certain mindset into being adopted. Okay, it's inducing the idea that this is trustworthy for the purposes of lending resistance. So when a trader with less experience looks at a market like this and they think, wow, the market really bounced down from those levels. So therefore what? I can go short and hopefully make a big move going lower during the FOMC. And I can feel safe that my stock could be placed above that 40.91 and a quarter level or 40.89 and 3/4. And then when 2 o'clock comes, they're vanquished. That's what my mindset is right now. That's what I'm seeing. That's what I think. That's what I'm co-signing right now. If I'm wrong, it's irrelevant to me. I don't care. But if I'm right or wrong, it's engaging for you as a student to look at this. And when you get it wrong, should you get it wrong, go in and study what it actually did. And don't think to yourself, oh, I got that wrong. If I would have done this with money, I would have made this much or lost this much. That's the worst thing you can do with this type of day. Just like FOMC. It's like a carnival ride. You have no idea what the market's going to do. I have no idea what the market's going to do on this day, which is the number one reason why I want you to believe me when I tell you the best thing you can do is simply wait until 2:45, 2:45, or the last hour of trading. Then the normal routine kicks in, and that's fine. But I don't want to be a mentor that feels like I got to constantly encourage you to get into the marketplace. I'm trying to be the mentor that tells you you do want to cherry pick when you get in again, when you don't want to get in it, because there's a greater degree of risk in a market event day like this than that of any other regular day. Even a high impact news driver, apart from CPI, you can still trade them, and that's fine. But this type of day can rip your face off, and it could be tricky. It could many times give you the impression you got it figured out. Like for instance, I've already co-signed, and I believe that they're going to run at 40.91 and a quarter level. That's what I'm subscribing to in front of all of you. I don't know how many people are watching me right now, but even if there isn't that many, later on you'll see the video because it'll be on my YouTube channel, and I'll either be correct or I'll be not correct. And either way, I don't care. But I want you to understand that one of the best things that could happen right now is for me to be wrong. And then I'll be able to beat my chest and say, that's why I tell you, don't do anything like that. Because if the coach is himself not able to do it this day, why should you reasonably expect that you're going to be able to come through it without having any harm done to you? So I'm trying to be that kind of mentor. I'm not trying to be the guy that constantly gives you crack to give you a new high. Watch the midpoint of this wick right here, which also lines up with this right here. See if there's any sensitivity there. About, what is it? This might be thinking. Take it up to around 4 today. The market has been really lackluster. A lot of volatility. Controlled price. If I had the strings on the marionette puppet that is price, how would I manipulate them, and what would I do to do the most damage? Well, I would obviously look at what has happened here. We've already taken out the sell stops. So there's traders that are caught short right now. They tried to sell short on the breakout. Anyone that's long had trailed stop losses. They're neutralized. But now who's safe so far? Anyone short. They saw this move here thinking it's great. So how you wreck them? You run it up here deep, clears them all out, keep people caught on side, not on side, but off side buying it, and then rake them across the coals all the way back down here. And then everybody thinks nobody makes money trading. That's the idea I have in my mind. Might never even come close to doing that, but that's the type of thing I like to do. And sometimes it happens like that, and then sometimes it doesn't. But that's the fun studying it and see how they do it. Because these particular days, I don't have any insight on what game plan they're going to use, which is the reason why I won't push the button. 3 seconds, and then the fireworks. Watch midpoint of this wick. Movement here now. below it by a little bit and then rip it higher, or do we aggressively go into our and if it goes above these highs here and goes to like 4,100, they could stand to make a lot of money, right? So if they go down there and knock them out into this imbalance that's highlighted, then rip it all the way back across all this, that would be the maximum damage and still do what I've outlined mentioned moments ago. Maximum carnage, that's what I'm looking at all the time when it's FOMC. Who could be harmed the most? And who's recently profitable? And how could it be taken out of the game? This small gap here, you want to see it go through that aggressively. I think if we get above that one, no, so if we get above it and come back down and act as support with it, then it should be violent to take out 40.92. I see it as they're allowing shorts to feel safe. Remember, there's stops above 40.92 and 40.90, which will be one tick above this one here, and then 3/4 of a tick. Three-quarters of a point rather above this one. So this basically call it 40.92, because if it's going to go to 40.89.75, it's going to rip to 40.92. You see how it just behaved right there? We traded through the gap, this here, open, traded down to the low of it, and now look what it's doing, expanding up. It's interesting, isn't it? It's almost like its own leash. Not on this day, though. Now, here's that old fair value gap. See how it's being sensitive to it there? Rewind the video later on when you can watch it. Not on this day, though. Now, here's that old fair value gap. See how it's being sensitive to it there? Rewind the video later on when you can watch it. Now, that's unfinished business, okay? Right here. This high and the 40.92 level. It's unfinished business. This came all the way back up here. It's going to rip through them. And there you go there. And then there's the 92. Come on, punch it up there. Come on. I feel kind of bad because I really wanted to be wrong today. Now some of you are going to think, oh, I want to trade FOMC. All right, so now look what this is here. We have the low, the high, the lower low. This is a breaker. It can accumulate more longs in this range here. What range specifically? Here to here. Expand that out here. So that's a breaker. There's your 92. Cherry picked. Using delayed data that everybody's seeing all around the world at the same time. Now, does it rip up to 4108? Or first of all, 4100?
I mean, look at the bodies here. I feel like a lot of the time I don't pay attention to the bodies, but if we see the bodies,
we have a whole year, folks.
New day opening gap.
A whole year, Mr. Wizard. So right now, you want to screenshot this because it went to 4100. That's a nice run down off of fair value gap I outlined right here, real time. As it hit it, you watched it. I mentioned that we would see this area here act as support, open, trade down to low, expanded through. I wanted to see at least one down close candle in here, but you know it didn't offer it, so it's in a hurry to get somewhere. So I think 4108 and 4112 is doable. But right now, if you were asking me if this was any other day and I was in it trading it, I'd have just about everything off the position and a stop loss that would be extremely tight, which would be anywhere between 40.89 even to 40.88. And if it went down there, I'd be content and not want to go back in for any other thing. Looking for it to rip to 4108, 4112. And if it were to do that, I would close my charts and feel like I've done enough, vanquished enough, adversaries in retail on the altar of speculation. Pretty fun, isn't it?
Yeah, it was FOMC.
No bull flags, no trend lines, nothing supply and demand, and no buying and selling pressure. All price action. Almost got 4108. Come on. I got to at least fail somewhere there, right? 4108 does not get to that. For the folks on Twitter, holler back at me if you watch this live. Trying to get a feel for that delay here. Here we go. That you're not getting because you don't watch price action yourself. So watching it, having someone hopefully communicate it in a way where you can understand it, follow along without pushing the button. Okay. If you followed this and you're long, get out of the trade. Okay. Just get out of the trade and be content. Don't tell me about it. Don't show me what you made. I don't want to know about it. Okay. Put 4115 and 4125 as horizontal lines on your chart, and I think that would be pretty much the extent of it today. It may not even go that far, but that's I see that as a potential still. But you saw my target 4112, 4108, and the narrative off the fair value gap. I cherry picked for you, and there you go. So that's going to be it for me. Hopefully you guys have had a worthwhile engagement with me, and hopefully nobody was too terribly confused. But the more you spend time with me this year when we do it live, you know, you'll see things repeat. You'll see the ebb and flow about what the market's likely to do next, where it shouldn't go, why should it go somewhere. And I didn't do a whole lot of jawboning, I don't think.
Okay. He doesn't have a stream until February 7th, so therefore we're gonna backtest. We're just gonna backtest the rest of these days, and yeah, I'm just gonna continue to backtest the 2023 mentorship, and then I'm just gonna watch all the 2023 mentorship videos. I've already gone over it once, but I honestly think that like the second or third time you go over something like a lecture like that, like you just soak in a lot more, and it kind of sucks because you essentially gotta watch, or you don't have to, but watching things twice over can seem redundant, but I think it's worth it because now you have all the knowledge that I have right now. Not like it's anything crazy, but it's definitely better than where I was. Alright, so here we go. We have had a big expansion. All this is balanced on the 15-minute, so I don't know. I think we'll probably just consolidate big range days and then into small ranges. Yeah, it's in free resources. And then you open it up, and then you just go to Twitter, and then you go to every month that he's posted. You have 2022 and then 2023. Yeah, shout out this guy, whoever posted that, Noctua. Honestly, don't even know who that is. All right, let's see what price does. We don't have any red we didn't have any red folders. It looks like there's earnings of some sort. I mean, volatility really came in at 4, and we form an SMT here. Day after FOMC. Not really looking to engage. We're just well above true day. Smart money is accumulating. If we got through a high, we then use this fair value gap. Honestly, I really don't think that there's anything here. Negative 3.5 kind of works there. This day is not ideal. Wow, that's 40 points. So we got a 5-minute order block. Nice 2022 model. We go ERL to IRL to ERL, back down to IRL to ERL. Market structure shift. Nothing to really note here. That's cool to see though, like this this old high. Look at that. Have you been back to this? Yes, sir. Pretty much every day, except for Sundays. Sundays definitely not. Sundays are kind of my chill day. And then last Friday, I wasn't feeling locked in. I didn't sleep that well Friday, so I decided just to let end stream a little bit short, you know. But yeah, mainly usually 12 hours or like 11 hours. What's up today was Friday.
Hold up to me, 'cause I'm a little unsteady. A little unsteady. Hold up to me, 'cause I'm a little unsteady. A little unsteady.
My bad. My bad. I didn't realize the volume was on. Not yet. Not yet. Store money accumulated longs with SMT. Wait, did I have that marked? Yeah. Bro, what? Different strokes for different folks? What's your strategy? 2022 model is what I've been backtesting recently. Hey, appreciate it, Luca. Appreciate it. Are you profitable? Not yet. Not yet. Giving it time. All right, it's Friday. NFP. Notice how we ran up. We ran up fast to buy side. We're taking both buy side on ES and NQ now. We're in a deep premium. Friday, Tuesday low of week, Thursday high of week. Let's see what this does. It's NFP. Appreciate that, Luca. See if we manipulate here. NFP distributes price lower. Oh, beautifully. I mean, look, like NFP and news releases like that, like they still deliver to logical levels. Is this your 12th day trading? No, I've been trading for around like a year, or a year and like 3 months. But I've been taking it serious for around 4 months, 5 months. I'm giving it a whole nother year. I'm willing to sacrifice a whole nother year of this. Well, not even that. I'm willing to sacrifice a whole nother 3 years, because I didn't go to college. I'm not going to college. I do scalp. We've had large ranges this week. Where most likely is protected high. So we have SMT here. Most likely. Yeah, I've just been backtesting. I mean, I'm giving it time. Me personally, I don't like prop firms because I think that they try to rush. Well, that's their business model. They want to rush traders into thinking that they need to make money now, so they can make money. That's how it works. You're gonna get a degree in trading? I don't. Is that a thing? A30 News distributes from that, and then we take this low, but I don't think we take this low on NQ. What was that? That's Thursday's low. That's Wednesday. Yeah, then we form SMT here. Wow. News delivers from the high of the new day opening gap. Notice that? We create a candle with no wick. Just keep grinding, bro. 90%. Appreciate it. That's kind of my approach to trading, and pretty much, yeah, to trading is like, I am not trying to take it quick. I'd rather have it slow, because like, I think if you take things slower, you're more likely going to keep it. But if I were to get what I want fast, I'm likely going to blow up. I'm likely not going to deserve it or appreciate it. Like, think about if it took you 3 years to get somewhere, you're more likely going to appreciate that. It's going to feel a lot better in the end than if you just get it fast. Love from India, appreciate it. It's TradingView. That's where I do most of my back testing. Yeah, but you still have to pay that monthly fee. You're still having to pay that monthly fee, and then you're pretty much just paying You're paying interest on money that you don't use. But yeah, I would say, if that works for you, for sure. I just say, I know that I'm not personally ready to be in a funded account, so I personally am not. Well, I don't trade support and resistance. I mean, SMC is ICT. So yeah, I trade both. Like, look at that breaker with institutional order flow entry drill. SMT at the lows. We have a devil's mark. Price drops below true day open, midnight open. And then we get internal raid here. Sell side liquidity raid, 1 hour fair value gap, consequent encroachment, beautiful. Oh, I could drop down on the 1 minute now. Oh, that's nice. I wasn't able to before because I didn't have enough data in TradingView. I appreciate it. I mean, I don't care. I honestly don't care what other people trade. I don't know why people get so caught up in that. Like, just focus on yourself, because, like, whatever you trade, I don't make money with. So I quite frankly don't even care what you trade. That's not being a dickhead. That's minding my own business, you know? We have another little small SMT here. Is that like a 5 minute imbalance? It's got to be a 15. No, we don't. How much average time does it take? I think it's all dependent upon the person. Even then, I wouldn't put time limits on your journey. Like, I have 0 time limits on my journey at all. And the reason for that is because I'm not going to pressure myself into trying to learn something. Because if there's a constant, like, end goal that you have, what happens if you don't get it in time, in your deadline? You might rush it, and you might just always be worrying about where you're going, when you can just be worrying about the journey that you're having. Like, I really enjoy the journey that I'm on, and I enjoy getting to wake up every day and do this. I know not everyone gets to be able to do this. From this doing range high to low. Notice where we get the institutional overflow entry drill. Right at 50%. Here we have from breakaway to the measuring gap. Oh, that's some pretty nice projections there. Nice. Hey, I appreciate it. That's kind of why I do this. That's kind of why I do this. I kind of want to inspire other people and like also push and encourage other people, you know, because I feel like there's a little bit of toxicity in trading sometimes, especially on social media. But I think if we all just work and grind, we all can get there. But we all gotta work and grind. And I'm trying to set that example. What does backtesting mean? My version of backtesting. My version of backtesting is going through all price moves and just annotating what I see. Like you can rewind and see exactly what I do, but that's how I backtest because I don't think that like saying that, oh, I could have entered here, I could have entered there and there, or like, sorry, I said that wrong. I don't think that like going in there like while it's playing and just trying to take entries is the best way to learn. That's how I approach it. So like I'm just going back over price and I'm seeing what happened and what occurred. And then I have a journal. I also have, and then I record. Like you see me copying the charts, I put all that into my journal. I'll show an example after this. Hey, appreciate the sub. Yeah, I lost like $12,000. Not just gambling, pretty much. Doing things that I shouldn't have been doing. And I've learned from that and decided to take time. Hop on a 25K eval. I'm good, bro. I'm good. Like that's still 50 points. I think that's all I really want to backtest, or I really want to log. Look at the wicks around 50%. We leave a breakaway gap. Fair value gap in, fair value gap out. We're likely gonna head to this low. Overall, very nice delivery here in that 1 hour PD array. We have a SMT at these highs. We're likely gonna hold that high. We're coming up to a 5-minute imbalance. We're reclaiming that. This is just manipulation. I'm not even looking at the wicks. Look at the bodies. Falling just short of that. Go right there. Change state delivery. And then we have an order block here. 5-minute order block right there. Gets beautifully repriced too. And end up selling off. I'm not really looking for that, but we end up repricing to these lows here. Some nice equal lows there. And kind of just consolidating through close, slowly chipping our way lower. I don't really care to engage in any of this. Before you learn 2023, the more advanced stuff, at least be profitable with 2022. Just suggesting. Yeah, I would agree. I mean, they all tie together. Yeah, every day. Except Sundays, I'm not gonna be live for that long. That's just me personally. Yeah, you can be profitable with whatever strategy suits you, you know? Whatever makes sense to you. I would recommend finding something that works for you, but I would say just buying based off a feel of what price is doing. I think you're most likely gonna go on tilt, you know?
I'm not afraid of the war you've come to wage against my sins. I'm not okay, but I can try my best to just pretend. So will you wait me out, or will you drown?
Oh, my bad, bro. My bad, my bad. Right during that 11:50 macro too. Balanced price range? Oh, beautiful. ICT is a guy who created a way to view price action. I'm trying to move my face cam, but it won't let me. It's a way to view price action. One 11:31 fair value gap, and then what else? 10:12. Almost constant encroachment. 10-12 candle is what he said. That's institutional order flow entry drill. Right at that bottom of that current new day opening gap. We then draw into that. I've been learning, bro, this little fly has been like pissing me off for like 3 days. I've been learning ICT concepts for around 6 months, but like seriously 4 months. I would say I would say I have a decent understanding of the market. Decent view, a better view on price. I mean, it's constantly getting better. I've put in a lot of work. Like, I'm not just going through the motions, you know. So I think
You've come to wage against my sense.
if you trade, you cannot do
But I can try my best to just pretend. So will you wait me out? Or will you drown me out? So will you wait me out? Or will you drown me out? I can wait for you at the bottom. I can stay away if you want me to. I can wait for you.
My bad. I don't know. Here, I'll lower it. For real, bro. He's just like in here. Just be in here. All right, let's go to this. I think it's February 7th. This is his first live stream, I think. He's been wanting to. Bro's been in here for 3 days. Oh, my indicator. This indicator is I think one of the better indicators. Alright, we're below true day here. We have this new week opening gap that we just had that we've now dropped below. We have this high that nests right within that. I would want to see us maybe draw up into that. And then we have this imbalance here paired with this high here. Can now be used as real support with a fair value gap. Yeah, I would like to see us display. I would like to see. Do we have SMT here? Yeah, we're dropping into a discount. Oh yeah, NQ within a new day opening gap. I don't want to see us continue to. We came back down, swept this low, and then we went higher. Kind of like some seek and destroy condition there. Are you profitable with paper? I haven't even been trading paper. I've just been reading the tape. Ooh, then this kind of creates some consolidation conditions here. So when we consolidate, deep premium to deep discount to equilibrium to deep premium back into equilibrium. Notice how that high gets targeted. The last time I took a trade was like 3 months ago. It's been a minute. Look at constant encroachment of this. We barely purchased low here. AMD right here. Price rallies above true day. Shorts accumulated. How long have I been trading for? About a year. But I've been taking it. I haven't been taking it serious for, I mean like serious for all that time. That's why I put a lot of work in, because you know, you only really start when you start taking it seriously. But if you're not taking it serious, then have you really started? Accumulation, manipulation. A good price delivery right here. Hey, I appreciate it. We have SMT at the highs. SMT above true day after sweeping liquidity. That's the real sauce. And we're displacing away from a new week opening gap. Inversion. There's no gap there. So if you were to trade this, there is no really fair value gap entry. It's an inverse fair value gap that we use. Oh, 1050 macro is where it occurs. Or 950 macro. Nice trade right there. Then right here would be the we have a 5-minute balanced price range. I want to see what this standard deviation is. Probably 0.5. Yeah, half a standard deviation. Here's a 2022 model. After sweeping sell side, we're below true day open. Smart money's going to accumulate longs here. Send price to buy side. We then get a balanced price range above new day opening gap. We're heading to a new week opening gap. We have buy side. When is this occurring? We have another 2022 model. I mean, this is like a very early 2022. And there's a lot of opportunity this day. A lot of opportunity. There's like 3 possible trades here. And like decent trades. We're kind of in consolidation markets. No, I'm not profitable yet, but honestly, I would say I'm profitable. I mean, I tell myself I'm profitable. I tell myself that I'm profitable because if you tell yourself you're not profitable, well then, when you even if you are, I mean, I guess it's different. I don't know. I like to brainwash myself. That's just me. Might be a little bit weird. $11.50 macro. That's 40 points right there. We deliver straight to an imbalance here. You come back up to this imbalance, so we come back down to the low new day opening gap. Like look at this level here. Look at this level here. New day opening gap gets respected. New week opening gap. New day opening gap. Consolidation. We cannot reverse from a consolidation. We put in a low here, and then where do we refer back to close? New day opening gap. New week opening gap. Like constant culture right there. Where's the PM session? 130. 130 opening. We manipulate above. Price manipulates. Above 130 into 130 opening price into new week opening gap. Taking buy side here. Where's buy side? What's ES looking like? Appreciate it. There's a lot of fluctuations there. Wait, was Fed chairman was speaking? Oh no, he speaks tomorrow. He spoke the last 2 days in a row. I'm talking about in this time. Alright, I'm gonna watch a lecture. I kind of want to watch that live stream for the 7th, but I'm gonna end stream in about an hour, and it's three hours long. You got a plan yet? I do not. What's looking like right now is 2022 model though. I'm not gonna lie. Above, below true day. So we have left these highs. We've come up into Oh, I do like that. I would look for this. Notice how, remember this low has built up sell side interest. We barely purged that low. So let's see if this low gets taken. Okay, we want to run that. Oh my gosh. That's all from Powell. That's all from Powell speaking. Wow. That's crazy. That is wild. He spoke in the PM session. We go above it, and then notice how we drop below true day open, and then we expand, and we take the sell side liquidity. That's pretty crazy. So I guess just don't trade before Powell. Well, I mean, you still can trade, just be nimble. Here we don't have any interest of going lower. We don't take sell side though. We have to have an SMT. All right, for now I'm definitely gonna watch a lecture. Definitely gonna watch a lecture. I removed where I was at in the 2023. Dang, we're already on February 7th. Never thought we'd get there. Yeah, it definitely is. I mean, think about it. You think something where you can make a limited amount of money is going to be simple? I don't think so. It can be. Did you see Iman trade? Yeah, everyone always talks about that. But I'm gonna be straight up. Do you think some random dude on YouTube that's like, how old is Iman trading? Like, he's no older than 20. He's probably 20 or 22 max. Do you think he knows better than someone that's been trading within the markets for 30 years? I mean, regardless. Oh yeah, that's why ES and NQ tops. Oh my god.
It has to do what? Deliver it on the upside. So it trades up into it, offers that buy side that was inefficient over
My
here,
volume wasn't on.
and then we have the market displace lower. So we took out a short-term swing low here. I like the idea of that. We traded down into a buy side imbalance, sell side efficiency here. So this is a fair value gap too, this singular candle. And we could dig down a little bit further, just like we mentioned on the dollar. It has a little bit more upside to fill in its gap. It doesn't mean much in terms of opportunity. It just means that's where my focus is. Just because we're sitting in front of the charts and we have time to be in front of the charts and the markets are trading doesn't mean, oh, I got time. The charts are printing candlesticks, so therefore let's take a trade. That's gambling. So there has to be something for me to lean on logically to frame a condition that would be hopefully high probability. I only want to encourage you to focus on those types of opportunities. There's a plethora of opportunities to be in front of the charts and the markets are trading doesn't mean, oh, I got time. The charts are printing candlesticks, so therefore let's take a trade. That's gambling. So there has to be something for me to lean on logically to frame a condition that would be hopefully high probability. I only want to encourage you to focus on those types of opportunities. There's a plethora of opportunities intraday that are not really good risk, well, framed with real good risk reward models. Not that I'm a big fan of risk to reward because I think it's a fallacy. You don't know if your trade's going to pan out that much, and you don't know if your stop loss is going to get hit. So no one knows that. So you might look to trade with a specific risk model, 5 to 1, 10 to 1, 3 to 1, but going into this industry thinking that you're always going to get what you're setting your trade up for is a fallacy. You have no control once you enter the marketplace. So I'm going to be teaching you, hopefully, to ferret out these opportunities where price action can deliver with the highest degree of probability, reaching from one level to the next. Notice I didn't say I'm going to put you in winning trades. That's a stark contrast to what I'm trying to do here. I'm trying to teach you how to read price. If you're here to try to keep score or something like that, that's not what this is. I have other live streams that I'll do things. I'll showcase stuff. Here it's lectures, teaching, getting down to the brass tacks of what you're supposed to be doing before you even press a demo account using the things I'm teaching on my channel. Okay, so that way, hopefully I've communicated that clearly. It's not meant for you to follow along and press a live trade. Don't try to trade your funded account with the things I'm going to say today and any future live stream. Okay, it's very important that you understand that. Today also marks the day where I'm not replying or hearting or liking any post on Twitter. It is now just a medium for me to alert you if there's something that's got my attention, and I'm not live streaming. I'm going to bring something to your attention there. I don't care to know what your responses are. I don't care if you like it. I don't care if you don't like it. Don't communicate to me through it because I'm not reading any of it. My attention is dialed in the markets for now. Between now and the second Friday of November, it's all work, no play. Cable real quick. We'll just take a quick look at this one. This one was unable to make a higher high. Before I transition to cable, look at the higher highs being posted here up into its fair value gap for euro over here. And then look at cable. Weak, really weak. So we had this imbalance here. I wanted to see it run above the buy side. It failed to do so. It looks likely that we'll get down into the sell side here. If we accelerate through this, be mindful that we have this area over here, which since cable's already posted weakness comparatively to the euro. If one were to consider if we see acceleration on the upside for dollar, again, that's risk off. Higher dollar is lower prices for foreign currencies and likely lower for stock indices, equities, and index futures. So if we take out this low, it could, if dollar accelerates to the upside, we could see cable draw down into this imbalance here. All right, so that's about it for Forex. Let's go on over to ES. Give me a second here. Mimicking what I have static in front of me. When you watch the little stinger video I put up on my Twitter this morning, you've probably already seen it. It's my trading real estate. I have 8 monitors in front of me, and one of the screens itself has a 1 minute, 2 minute, 3 minute, 4 minute for NASDAQ and the ES. Since I'm using those two markets primarily if I'm trading index futures, I don't trade the Dow, even though you will see the Dow flash, when it's necessary to be mentioning it. I don't trade the Dow. I'm just trying to discourage you from trading. If you've been successful with it, if you like that medium, by all means, stick to it. Don't let me or anyone else take you out of what you're trying to do or wanting to do. Okay, all I'm trying to do is inspire you to read price from a classical point of view without indicators, completely naked. Nothing in here, like this little red line down here. That's not an indicator. All that is the NASDAQ. It's the price on. Let me get this here. It's a line chart, and the way you get that, how you get that, just take it off and I'll let you see how we do it. Got a couple minutes still till 8:30. You go up to your little plus symbol here on TradingView. You click on that. Be mindful that you're looking at a chart that you're not going to load back up. In other words, I'm plotting S&P. So ES is the chart, so I want to compare it to NASDAQ. So you would do the same thing here. You would type out the front month code for
Stop looking
the
at your
index.
phone, my bad.
Want that. And change the H to working lower. NASDAQ. What's the S&P? Like to look at, we'll watch and see. But that's how you add those in the averages. You might be looking at these levels over here, asking what they are. On Sunday's opening, as soon as the market opens, the only thing I do anymore, I used to trade Sundays, but I don't trade them anymore. The only thing I'm interested in doing on Sunday is seeing where we open. So here's the opening price on Sunday, and you want to do that. I'm not sure you guys can still hear me or not. It sounded like this headset just powered down. It's a brand new one, so I don't know. You annotate that, and then you have the closing price on Friday. So that range is your new week opening gap. Just want to make sure I can hear myself. If I can hear myself, you should be fine. Hold on 1 second. Here goes to purchase. So this new week opening gap, it has been taught by me multiple times throughout the years that this is like a real strong price magnet the market's going to want to gravitate back to it if we're not trending. Okay, and this is the part where if you're watching and you don't have a notepad or your journaling is not being utilized here, you're wasting your time watching this, because these are things that repeat. If the market's going to be consolidating or not in a trending environment, the opening gap on Sunday, if you extend it through all the way through Friday, you're going to see many times the price will gravitate back to it. Sometimes it'll go into halfway, sometimes it'll go completely through it. It'll act as real support and resistance. The way you expect classic support and resistance to work, like you see in the books, these two price levels and the middle of it. What is the middle? You just take your fib, apply it on the opening price on Sunday, and you apply it to the closing price on Friday. That range is extremely sensitive, especially with the low, the high, and the midpoint. So the midpoint level would be 41.40 and a quarter. And you can draw some distinctions the way you would want to do it. I'm just showing it, like, this is one way of doing it, so that we can differentiate what it is. You can make them very bold. And I keep mine like a black color, which is indirectly, something standing out in my chart, whereas usually I'll have like a blue line or a red line for like liquidity pool. This way it's drawing a heavy distinction between what a level might be on a lower time frame. I know that big, heavy, thick black line is rooted on something higher time frame, and or in this case it's the new week opening gap. You can see how we've already traded up to it here. It bumped it here, failed to go here, went lower, worked it here, just fell short of there, tried several times here, and failed right here. So we haven't really probed anything above meaningfully the consequent encroachment, which again, consequent encroachment is half of a gap or any inefficiency, such as this level is here. We haven't worked really anything up into this area here. So there's a little bit of price action that has not closed in or offered buy side here. So even if we do go lower, take out this low, which is in my mind likely this morning, we could go down here, reject, and make an attempt up here if we get that weakness in the dollar. So if the dollar does trade lower, that would offer an opportunity for the market to want to trade back up into this new week opening gap, which is these specific price levels. Now, think about what it is stated there. I'm not teaching supply and demand. I don't believe in supply and demand, unless we're talking about commodities, which are really directly linked to a real supply and demand factor, because it's a real market. Not to say that you can't make money in this market. It's not a real market, not in the same sense that a bushel of wheat or gold, that's something real, okay? The value of a stock index is not the same as something that you can eat. This could theoretically go to zero. Highly unlikely, but it theoretically could go to zero. Gold's not going to zero. Wheat's not going to zero. Cattle, beef prices, pork, crude oil, it's not going to zero. So there's real supply and demand factors with those markets. But when we look at markets like this, which in many ways I view them as synthetic, they don't have the same measure of supply and demand, but it is manipulated and engineered. So the interest is always constantly manipulated. So what I do in my teach my students to do is look for areas in markets where the manipulation is obvious or it's expected, and then we look for setups that repeat using phenomenon based on markets trading to liquidity, buy side liquidity, which is above a high or relative equal highs. That can be an entry to a new trade, or it could be a closing target for an existing trade. Don't think that it's that that's the only approach for your trade. It's target only. No, I can use it as an entry too, as you'll learn this year as well. I want to focus primarily on what I taught last year, that model, the 2022 model, but I can't promise that I won't stray off topic when it doesn't materialize. So because I'm in front of you live, I want to get you thinking about things beyond that model. So that way, for those individuals, not that all of you should be, but for those individuals that are already outgrowing that model because you've now used it, you're making money with your funded account, maybe live funds, and you're learning, you want to do something more and broaden your horizons in terms of price action. I'll show and do more of that stuff this year. But also, it's just beneficial for you to, just simply because I might not trade a specific price swing doesn't mean that I can't see it or you may not steer away from it. It may be the very pattern that you're going to focus in on. So I'm trying to be the mentor that allows you to bring your own. I'm going to maximize this now. So all of this is going to disappear. And it's not important that it stays up. I just want to make sure I showed you how to compare. All right, so now think about what has happened here. We have a 5-minute chart. Now we have liquidity down here. Let me get this out of the way. Sorry. So at this low and just below it, I teach my students, we aim for that. I don't look at that as it's going to go down here and bounce. I don't ever look at it like that. I look at price like, who went long here? I don't know. You don't know. We don't care. Somebody went long. The market went higher. So below that low, classical technical analysis is going to do what? preach that you have to put your stop loss right at that low or just below, right? So what kind of stop's going to be there? A sell stop, which is why I teach that that is sell side liquidity. Price rallies up, it breaks down. What just happened right here? Right below this low, it shifts. Market where? Bullish or bearish? Bearish. So what we do is we look inside this price leg here, and we look for any inefficiency. So once this leg here has been broken on that candle, that one right there, that's where you enter with the expectation of finding the setup that I taught in the 2022 model. This is exactly what you would expect to see. Now, why is that? Because you're seeing, number one, buy side taken. See these relative equal highs over here? Above this area, anywhere in your price, anywhere in your chart, I don't care what market you trade, it doesn't matter. This is like a constant thing that repeats over and over and over again. Watch this volume imbalance in here, by the way, because it could see that and drop down and below there. But buy side liquidity here, above old highs, when the market's dropping, like it does here. If anyone went short there, where would they place their stop? Theoretically, to protect themselves. The books teach us what? Put your stop loss at the high or just above it. So the market drops down, rallies from here, and all of this area here, that's absorbing and engaging all the buy side liquidity or buy stops that will be resting above these relative equal highs. So that's what's occurring here. So when I teach my students and how I internalize price, when I see that, I'm expecting price to do what? Show a willingness to want to go lower. Because it went up here for real orders. I don't need level 2. You don't need level 2. You don't need depth of market. All the buy side liquidity or buy stops that will be resting above these relative equal highs. So that's what's occurring here. So when I teach my students and how I internalize price, when I see that, I'm expecting price to do what? Show a willingness to want to go lower. Because it went up here for real orders. I don't need level 2. You don't need level 2. You don't need depth of market to see that. It's plain. Wherever there are smooth edges, like these relative equal highs like this, the market, it's uncanny how it will go up there and make those smooth edges jagged. So it's all nice and smooth here, like a perfect ceiling, right? And then all of a sudden you see this smash running up, spend some time up here, and then breaks lower. This moment right here, when it takes out these lows on that candle, that is the market model that I gave you for 2022. It doesn't mean you get in. It means now you look at this price leg here. Go back through this price leg because this is the displacement price leg. This low has been taken out right there. So inside this entire run lower, you want to look at where there is an inefficiency or fair value gap. That fair value gap is your entry point. You just don't chase it just because it went down below here. Many times I see a lot of YouTubers, they're breakout traders. They might make money, but I promise if you spend a little bit of time, I'm going to teach you this year, you will enter shorts when the market's going up. And it seems scary. It seems like I don't want to do that. That's terrifying. How do you know? Well, number one, you know because you practice it. You do it over and over and over again. And by doing it over and over and over again, it desensitizes you to, because in the beginning, you want to be correct. That's really, you didn't get into this business to be right, because if you want to be right, you would play board games and play chess, okay? Those types of things. I was right about these moves and these outcomes, and that was the reward for it. In the markets, you want to be profitable and control and manage risk. You don't want to do anything but that. That's the number one factor for why you're doing something. But in the beginning, that lure into the marketplace while you're doing it changes and morphs into, I want to be right, I don't want to be wrong. Because ego, pride, just, I guess, the inability to embrace uncertainty creates fear. And somehow we as humans encapsulate that one transaction, that one idea that in many ways is insignificant. One trade is insignificant. But in the beginning, you make that singular trade or a singular trade paramount. Like it's the only thing that defines you as a profitable trader. And that is unfortunately something that is normal. It happens to everyone. I went through it. Everyone else that's still trading, profitably, no matter how long they've been doing it, they can sit there and they're nodding their head right now listening to me. Like, yeah, that happens. Everybody goes through that. The problem is you want it to be black and white, perfect. You know when it only works, and you know when it doesn't work. So therefore, you're thinking that there's a way for me and you and everyone else out there to never take the losing trade, and that doesn't exist. That does not exist. So you have to look at the probabilities of something repeating that we can look back in time and say, okay, it usually does this, it usually does that, and therefore I've seen 100 sample sizes of this particular thing happening under these at the take the losing trade, and that doesn't exist. That does not exist. So you have to look at the probabilities of something repeating that we can look back in time and say, okay,
I swear they just get better every time I watch them.
it usually does this. It usually to never take the losing trade, and that doesn't exist. That does not exist. So you have to look at the probabilities of something repeating that we can look back in time and say, okay, it usually does this, it usually does that, and therefore I've seen 100 sample sizes of this particular thing happening under these circumstances, the things that lead up to it. And what does that mean? Well, as I mentioned, we had relative equal highs. The market runs up in here. We don't do anything. We're waiting. Then the market drops. It does so here. Do we do anything with it? No. The market rallies again. What does it do? It runs above the rejection block in here. It's in my YouTube channel. And then there's a displacement lower. So this willingness to break sharply below a swing low after taking buy side. This is how you frame high probability. High probability for a short means some measure of buy side has been taken. We see that here. Then you wait for what? Displacement. That means in plain terms, you want to see the market drop sharply lower and take out a specific low. Here's a short-term low. It trades through it here. Once we have that, then we can go back through all this price leg here and look for inefficiencies. That means a specific fair value gap. Now, once you have that price leg identified, you want to go through all your time frames. 5, 4, 3, 2, 1. Right now I'm showing you on a 5-minute chart. So we have this price leg from high to low. High to low. This is the low that was shown as a break in market structure, not break, I shouldn't say it that way, a shift in market structure. So anything at this level or higher, we want to look at that as a potential what? Fair value gap. Now, this is the part that being mentored versus just watching one of my videos or listening to someone else try to take a series of lectures or a video of mine that may be an hour or so long, and they try to condense it to a 5-minute trainer. Learn ICT stuff in 5 minutes. You're never going to learn what I'm about to show you in those 5-minute trainer versions. Okay, I understand everybody wants to get clicks on their videos and such, but if you want to learn, there's a way of doing it correctly, and there's a way of just looking at Cliff Notes. It didn't work for you in school when you studied the Cliff Notes and you didn't get a high score. You have to read the book, right? Okay, so here's what it is. Inside this run from the midpoint of this leg higher and lower. Okay, that's the price leg that we're looking at. Why this price leg? Because it took out this short-term low on that candle. It's a shift in market structure, bearish, lower prices are expected. We do not look at any rally up as a sustainable run. Why? Because stops have already been taken above this high here. Then there's a shift in market structure below that low. That means that any rally after establishing the midpoint here, once it goes above that, in my mind, I'm thinking we're only going up to go down. So algorithmically, the market will print and produce a premium market. A premium market is where you want to sell your long positions and as partials or enter your short positions. When the market's rallying, that's where you want to short. You don't want to sell in down candles. That's
How you been here for 12 hours? I couldn't tell you.
chasing price. When you see me doing my partials, when I'm pyramiding into a position, I'm selling short in the up candle. And then I'm adding more as the candles are going up into that move. I'm not fearful of that. When I first started, I was absolutely afraid of that. I was scared. I was afraid what I was buying was a rocket. And I didn't want to get stung. I didn't want to get hurt. More specifically, I didn't want to be wrong. I didn't care about the money. I didn't want to be wrong. I wanted to be right. And being right is not essential to profitability. It sounds like it's an impossibility because you can be right and lose money. You can be wrong and make money. So you have to do many times what seems like is the most proper way of doing it, most intuitive thing is most of the time not the correct thing to do in trading. When the market's been going down, everybody thinks, well, it's going down, so let me get short. They chase it. And I was a victim of that when I first started. So that's the reason why I teach the PD array matrix. So that way you can frame a price leg, as we're doing here, the high to that low. Why am I specifically aiming for this price leg? Why am I only looking at this one? And why am I looking at this one? Because this one here didn't do any kind of a short-term price run where it created a swing low, like this one does here. It rallies up, and then it overlaps that entire run. And that's the reason why I teach the PD array matrix. So that way you can frame a price leg, as we're doing here, the high to that low. Why am I specifically aiming for this price leg? Why am I only looking at this one? And why am I looking at this one? Because this one here didn't do any kind of a short-term price run where it created a swing low, like this one does here. It rallies up, and then it overlaps that entire run and breaks it there on that candle. Once that occurs, as soon as that happens, I'm waiting for price to make a turn and start going back up. Well, what happens here? ICT didn't go above the equilibrium price went here? No, because this level isn't the equilibrium until this low. So if we were looking at this here, Did that trade meaningfully above the 50% level? No. And even if it poked its head above that, did it trade to a fair value gap that would be inside that price leg from here to here? No. So look closer. You have this price run down. We're waiting for price to go back above equilibrium, which is the 50% level on your fib. There's no mystery to it, okay? This is the only benefit of having a Fibonacci in my mind. That and how I use it for targeting. And I'll show you that stuff. And you've probably already seen many times me doing it in my live executions and managing the position, trailing the stop, looking for targets to be hit and such. But this run above equilibrium within this price leg here, that sets the stage. Okay, now we are in a premium market, meaning this range is premium. It's, in other words, overbought. I don't need an indicator. You don't need an indicator to derive that. From this point here to here, this is discount. As soon as we leave, and again, this is, again, not in the folks that try to teach my stuff. They don't know what they're doing. And I'm asking you, please, stop trying to teach my stuff because you don't know what you're doing. You're not covering this discount. Okay? In the red shaded area, above this level here, that's a premium. Above it or at that level, they're your ideal shorts. As soon as you cross the midpoint of the discount level here, once we get through that, did the eyeball. That's pretty good, wasn't it? Once you get through that there, the highest form of profitable shorts, the highest probability short entries, they have now been exhausted. The only thing you want to be focusing on now is taking partials and trailing your stop. Yes, that's a diamond. You just simply can't just take every single trade and enter. When do I stop taking partials or pyramiding? Something like this. Now, I'll build pyramiding entries all in this until we get through here, and then I stop taking pyramid entries. Go back and look at my examples, and you'll see that's the truth. So when I wanted to learn how to pyramid and build my positions large, I learned it incorrectly from Ken Roberts' rag of a book, the world's most powerful money manual, of course. It's a long title for something that was useless, like toilet paper. But I guess toilet paper is useful, but use toilet paper, let's put it that way. The idea of looking for the best entry points, the highest probability, and how the market will respect those levels more so than others. See, once we leave the midpoint of that discount range of this price run here to here, and we're in the lower portion of it, we're entering that expansion phase. That expansion phase is likely to not offer very many, if at all, new high probability pyramid entries to add to a position. So there's a threshold at which I will no longer add to new existing positions. But while I'm in that premium area, within that price leg, within the market structure that I'm looking for, as I just outlined here, and again, you're going to want to watch this portion of the video several times, it gives you the highest degree of probability for delivery from your entry to your targets. And you don't want to chase the move and build in more position once it breaks through the threshold as is outlined here. Because to do so, number one, you're going to be worrying about trying to put on another position versus taking off some as it moves in your favor. It's crucial in the beginning for you to do those types of things. Now, for someone that's seasoned, they've been around for a long time, you know what you're doing, you know how to profit, you know how to look at targets, your targets are not unrealistic, and you can go to full terminus. That means your full target, where you aimed for when you first got on the trade. In the beginning, and this is who I'm talking to right now, when I'm doing these live streams and I'm talking to the students that are here listening, I'm not talking, while I'm in that premium area within very many, if at all, new high probability pyramid entries to add to a position. So there's a threshold at which I will no longer add to new existing positions. But while I'm in that premium area, within that price leg, within the market structure that I'm looking for, as I just outlined here, and again, you're going to want to watch this portion of the video several times, it gives you the highest degree of probability for delivery from your entry to your targets. And you don't want to chase the move and build in more position once it breaks through the threshold as is outlined here. Because to do so, number one, you're going to be worrying about trying to put on another position versus taking off some as it moves in your favor. It's crucial in the beginning for you to do those types of things. Now, for someone that's seasoned, they've been around for a long time, you know what you're doing, you know how to profit, you know how to look at targets, your targets are not unrealistic, and you can go to full terminus. That means your full target, where you aimed for when you first got on the trade. In the beginning, and this is who I'm talking to right now, when I'm doing these live streams and I'm talking to the students that are here listening, I'm not talking to the guy that's been doing it for 5 years and he's funded and he's got profitability. You can glean what you want to glean from what I'm teaching. But it's the folks that are brand new. They have no idea where to go. They have no idea what to do with this information, how to use it, how to frame the logic. What rules do you follow? What do I do? What do I don't do? That's what I'm trying to accomplish with these lectures and obviously with the live streams. So once the market starts to draw back up into this premium area, we have to go through our time frames and look for fair value gap. So right away we have this low to high. Let's go back in with the fib. So we have to go into a fair value gap at or above equilibrium. So from this point on up, we can look for what? A fair value gap. Is this a fair value gap? Yes. What if you sold short there? Would it be profitable? Yes. Where would your stop need to be? Here, it needs to be at the high. That's a lot. That's a lot of range. But I don't want to have a stop loss like that. Okay, but you're gonna have to be more selective with your entries then. Now look closer. Inside this price leg here. This is why I'm not supply and demand also. What is this?
Volume notes.
What's that? What's the separation between this candle's close and this candle's opening? Volume imbalance. The volume imbalance has no body between two close and or opening prices. So it can be a volume imbalance between a higher close and a lower opening, or it could be a difference between a close with a higher opening. That's the difference between the two potential volume imbalances. The wicks overlap. See how it has a small little wick right here? Let me see if I can. How can I do that here? I know there's probably a shortcut to do this, and you guys are saying, if you would just do this, ICT. There's a small little wick here and a small little wick right here. Whenever I'm looking at price, I'm looking for those types of things because that's a signature. That's a little glitch in the matrix. Think of it like that. So if you take that, I know there's probably a shortcut to do this, and you guys are saying, if you would just do this, ICT. There's a small little wick here and a small little wick right here. Whenever I'm looking at price, I'm looking for those types of things because that's a signature. That's a little glitch in the matrix. Think of it like that. So if you take that and draw it through, because we cut through candles, Sam. We're not supply and demand around here. If you cut through all this drop as it's retracing back up, what's it reaching for? It is reaching for an imbalance in here. Yes, there's one here with this candle. There's one here between this candle's low and this candle's high. And then we have one here to here, specifically with that candle. Which one is better? Yes, you can enter here and have a stop loss up here. But look closer. In this delivery higher, when it ran higher, what is this last up close candle anyway?
Bearish order block.
It's a bearish order block. Why is it a bearish order block? Because it has a fair value gap. Opening price on this candle is what? You're going to look right here. Opening price on this candle is 4130.00. Okay. What's the high on this candle here? You're looking right here. The high of that candle is 4130.00. You cannot improve on perfection. That's algorithmic. What's the high on the next candle here? 4130.00. Again, not one tick off, not one tick over, not one tick short. So if you had a series of fair value gaps, which one do you look to trade to or use your entry at? Look for the bearish order block. Look for a volume imbalance or a fair value gap on the other side of the drop. You extend it through. Again, we cut through candles. You can't. I'm not trying to be so dogmatic in the live streams, and I'm trying to control myself because I will literally go into a Twitter rant and just not be as productive as I'm trying to be. There's certain things you have to look for, and I can't teach you every possible scenario that's available in the future because it's better to see it live, explaining it live. Then you're looking at this saying, well, it's not live. It already happened. I understand that, but I'm showing you the logic that one would use to get to the delivery on this setup, which is exactly out of the 2022 model that was shown to you last year. So with that volume imbalance and the fact that it's above equilibrium on that price leg right here. So the first one you could go short there and your risk would be to that high. Trading at this one with the volume imbalance and the fair value gap, and now watch. What's the half of this up close candle? Remember what that was? What's the half of an order block? It's not consequent encouragement. Consequent encouragement is any inefficiency. A fair value gap, buy side imbalance, sell side inefficiency. Those are consequent encouragement midpoints. A candle, a range, a specific candle that's been delivered in price, the midpoint of that is mean threshold. Low to high is 4131.5. So if you were taking this fair value gap, joining it with the volume imbalance, and it's a bearish order block, price should not do what? It should not trade above the midpoint of that up close candle. So your stop could be at 4132. 4132. So that means you have a 2-handle or 2-point stop loss entering within this volume imbalance, within this fair value gap. And some of you are new, you had no idea that this stuff is repeating like this. And I walked you through an example, something like this in the stock indices last week. I said, I wanted to use a fair value gap for a resistance level. And it stopped dead in its tracks just like this did here. And I executed on it and I showed it to you. So it's not cherry picking. It's not looking at hindsight only. You have to study hindsight. Every trader that's making money right now that's profitable, they learned by studying hindsight. You have to understand what the concept looks like. You have to identify it. And that way, by seeing it, like when you go out and you learn how to hunt and track your prey, you spend a lot of time looking at tracks. Oh, this is a bear, this is a elk, this is a deer. And that's the only way you can identify what it looks like because you have to see it in the history where it's been shown before. But once you understand the basics of the pattern, the setups, the primary framework, then it must be studied on real-time data. And it doesn't mean studying by pushing a demo account or studying with a live account. You do not learn anything correctly by doing that. There's a step in between that everybody skips over because they're in a hurry to be profitable. Versus, I want to take my time and be systematic. I want to know that I'm doing what I'm supposed to be doing and avoiding the things and not being influenced emotionally and psychologically because of the money. Because as soon as you put a trade on, you're worrying about the P&L of that trade. You're not worrying about the price action. Your mind shifts from managing the risk and managing the trade versus now I hope I don't lose. Is this thing going to turn around and go after my stop? And it may not even be close to your stop, but most of the time it will because you're in a hurry to do what? Jam your stop loss up. And that's not what a profitable trader does. Profitable traders aren't in a hurry to race their stop loss to break even. They're not concerned about that. Why? Because they've been here before. They know that even if this trade fails, it's not going to end their career. It doesn't undo the efficacy of their model or their approach to trading. It just means that that was one human transaction that they made. Close to your stop. But most of the time it will because you're in a hurry to do what? Jam your stop loss up. And that's not what a profitable trader does. Profitable traders aren't in a hurry to race their stop loss to break even. They're not concerned about that. Why? Because they've been here before. They know that even if this trade fails, it's not going to end their career. It doesn't undo the efficacy of their model or their approach to trading. It just means that that was one human transaction that they made. They placed risk behind it and it was wrong and it didn't deliver a favorable outcome. But you can still learn from that. And it doesn't unsettle you as a profitable trader that you don't say, I'm going to change what I'm doing. I'm going to change my approach to trading because I had a losing trade. Now, in the beginning, that's exactly what you're going to want to do. As soon as you try to learn from me or learn from someone else and you suffer a losing trade, the first thing you're thinking is, okay, this doesn't work. Let me do something else. And I did that. I did that for years. And I had a winning model, but I kept tinkering around with it until I realized I was holding myself back. So that's how we go through the process of looking for the right fair value gap. Now, if there's no volume imbalance or if there's no fair value gap here on the other side of the displacement leg, then I'll use the first fair value gap above the equilibrium. And I did that. I did that for years. And I had a winning model, but I kept tinkering around with it until I realized I was holding myself back. So that's how we go through the process of looking for the right fair value gap. Now, if there's no volume imbalance or if there's no fair value gap here on the other side of the displacement leg, then I'll use the first fair value gap above the equilibrium. And then there it is. Now, another version of this would be using this. And I usually do this if I'm going to be building a large position. Like if I know I'm going to be building a large pyramid position, I'll use this run up where it takes, right before it drops down, it takes a shift in market structure. So this is the displacement leg. Okay, this leg here, you split that in half. You would use any fair value gap, fair value gap at this level, and here's your sell side code we just talked about there. Let me finish this thought here, and then I'm going to talk about this volume imbalance I mentioned. This leg here to here, if we had no volume imbalance, if that wasn't there, I would take this low to that high, the equilibrium there, drag that through. This would be the fair value gap at that moment. So then I would be doing this. Again, this is assuming that there's no volume imbalance. My entry would be here and framed on this fair value gap there. Show me how to pick the right fair value gap. I just did. Did you write it down? Did you record it in your blog? Equilibrium there. Drag that through. This would be the fair value gap at that moment. So then I would be doing this. Again, this is assuming that there's no volume imbalance. My entry would be here and framed on this fair value gap there. Show me how to pick the right fair value gap. I just did. Did you write it down? Did you record it in your blog? Did you journal it? No. You're watching it like Netflix and you're going to never learn. So there's the logic. Okay, and there's the sell side. Now let me take your attention right back down into here because I told you to watch this volume imbalance. You know, one of those cherry picking events. If you go over here, the separation between the candle's close and the candle's opening, you want to get real used to doing that in your charts. When you see that, your eye's going to jump to it. Do you see it here? See that right there? That's a volume imbalance. That's a glitch in the matrix. Okay, they're coded. They're there for a reason. Right there. See it? Just like it was here. And there's one here. And there's one right there. So when I look at price, my eyes jump to fair value gaps, swing highs, swing lows, volume imbalances. That's just where my eye goes, okay? Here, think about what I was talking about before we drop down into the sell side. I said, watch this when it was trading up until here. So watch this volume imbalance. From this point here to that low, what is that? It's a PD array. It's an area where you expect price to react. React how? I framed all this here, but before I went on all the business up here, I said, watch that low. I believe we're going down below that. Now, I already know some of you skeptics in the audience are sitting here thinking, well, big deal. You know, it was this big run. I have hundreds of trades where I'm doing 100 handles or more. You can use the same logic to do those trades too. I am teaching you this year how to do a 5-handle run as a starting point. That is not to say that your entire career must only be on the basis of a 5-handle price move. It's to get someone that has never traded a low-hanging fruit objective. And I don't think there's anything wrong with that. Because if anybody in here that's an educator or teacher, they have a first threshold objective, something that they teach their students to aim for. I'm just electing to say 5 handles in the S&P market. When you're paper trading and you're demo trading and you're tape reading, if you're looking for that, number one, if that's all you ever get to be consistent with, that's enough. It's absolutely enough. You can take that same little cookie cutter approach of 5 handles and put money management behind that. Money management behind something that is effective could produce many, many 5-handle moves over and over and over again. And it compounds, and you use the power of compound interest to do the heavy lifting through money management. You're not risking more. You would be, I guess, risking more comparatively from where you first started as your equity base when you first start trading versus 5 years into trading. Your risk isn't any larger percentage-wise. It's a fixed rate of percentage risk that increases monetarily, but never percentage-wise. So the heavy lifting is done by money management, not the bigger positions coming in. I can do that. I can do heavy-handed trades. But a learning student, first introduction to trading, first introduction to what I'm trying to teach, it would not be efficient for me as a mentor to try to waste my time trying to build you up to try to do these big heavy-handed trades in the beginning when you don't even know how to reprice. So the way you learn how to reprice and you feel rewarded because it's more frequent that you'll see a 5-handle move than a 100-handle move. There's many 5-handle runs intraday versus how many 100-handle runs is happening intraday in one sustained run. It's not happening that often, right? So by framing the logic like this is where the stops are. What kind of stops? They're sell stops, so that makes it sell side liquidity. The market's going down up here, so where would it go? Down to here. Why? Because smart money and the algorithms that are in the marketplace, they engage these levels here. So what's above that? Buy side liquidity. In short, it's what? Buy stops. So what happens is the buy stops get tripped in here. Smart money, traders like myself and who I'm teaching my students to be, they will accumulate short positions against these buy stops with the expectation that they will ride price lower to this low. Why is that advantageous? Because below this low is sell side liquidity for anyone that has been long here and rode it up. I'm not saying that there aren't traders up here trading without a stop loss or trailing their stop loss up tight and had been knocked out. That's not what I'm saying. Algorithmically, the market will remember and refer back to that low. It does not know how many stops are actually below the low. It doesn't need to know that. It just needs to reprice at that level. Then the people that are in the marketplace, quote unquote smart money, the composite man, they will use that liquidity as a counter to their shorting against the buy stops up here. So basically it's the game of tag. Tag, you're it. Buy stops are it. Okay, so now who's next? Sell side. Tag, you're it down here. So in essence, smart money sells to buy stops with the expectation that they're going to run lower in price and then buy sell stops. Now you don't learn that in books. You think buy down here support, sell up here resistance. And I take my students' understanding about the marketplace and turn it upside down, because inside the upside down is the clarity that you're looking for. The frustration is immediately removed. So now let's go back. The volume imbalance I mentioned live before it actually delivered to you. Inside this area, if we hadn't already moved so far away here, I would use that as an entry. Why wouldn't you take that as an entry? If you knew and you said it was a volume imbalance cycle, you said there was a sell side liquidity, you said it was going to likely go down there, why didn't you take this as a trade? Why wouldn't I take that as a trade? Because of what I've outlined up here in reference to the premium and discount range. Once we leave, if we're bearish, once we break through the midpoint of discount, I cannot take another new entry. You can. I'm not. I'm managing now. I'm managing my core position. That's it. It's over. This becomes a point of interest where I'm going to see the trade be managed with it. I am not going to put my stop loss below that volume imbalance. I'm not going to trail it down there. If I see that volume imbalance, as I mentioned real time, I said watch that area. My stop could be above this high. It could be at the middle of this up close candle mean threshold because it shouldn't go there. Why? Because I'm expecting this volume imbalance to keep price from wanting to rally all up. Why? Why would I expect that? You see this opening here? We rally up. We drop down. All this range between from the low and the high, that range has already been delivered to this low, so 41.18. The next candle here, we open, we drop down, and we roll right back over top of 41.18. So we had 2 times between this candle's high and this candle's low, this entire range. Oh, you're learning today. School is in session with ICT. So inside that range, this is now balanced because we've had delivery to the downside. We came off of it. We went down through it again, and then we left what? A volume imbalance. So it's highly, highly unlikely that the market's going to do what? Think. What do you see in here? I've been recently teaching a lot about it. That low to that high. What's that price? It's consequent encroachment. Wait a minute. You said that's for gaps and fair value gaps. Yes. A wick is a gap. To an algorithm, they view a wick as a gap. Midpoint of that is consequent encroachment. What price is that? 41.19 and a quarter. So my stop would have to be above that, trusting that it would not go above that. That's stop management. That's how you understand what you're looking for. And we got about, because what I've outlined up here in reference to the premium and discount range. Once we leave, if we're bearish, once we break through the midpoint of discount, I cannot take another new entry. You can. I'm not. I'm managing now. I'm managing my core position. That's it. It's over. This becomes a point of interest where I'm going to see the trade be managed with it. I am not going to put my stop loss below that volume imbalance. I'm not going to trail it down there. If I see that volume imbalance, as I mentioned real time, I said watch that area. My stop could be above this high. It could be at the middle of this up close candle mean threshold because it shouldn't go there. Why? Because I'm expecting this volume imbalance, this keep price from wanting to rally all that. Why? Why would I expect that? You see this opening here? We rally up. We drop down. All of this range between from the low and the high, that range has already been delivered to this low. So 41.18. The next candle here, we open, we drop down, and we roll right back over top of 41.18. So we had 2 times between this candle's high and this candle's low, this entire range. Oh, you're learning today. School is in session with ICT. So inside that range, this is now balanced because we've had delivery to the downside. We came off of it. We went down.
Balanced ranges. A wick is balanced. So we don't expect wicks to get traded to.
Through it again, and then we left what? A volume imbalance. So it's highly, highly unlikely that the market's going to do what? Think. What do you see in here? I've been recently teaching a lot about it. That low to that high. What's that price? It's consequent encroachment. Wait a minute. You said that's for gaps and fair value gaps. Yes. A wick is a gap. To an algorithm, they view a wick as a gap. Midpoint of that is consequent encroachment. What price is that? 41.19 and a quarter. So my stop would have to be above that, trusting that it would not go above that. That's stop management. That's how you understand what you're looking for. And we got about 11 minutes almost before the market opens up. So in this area here, that volume imbalance will simply just be a measure of me managing a position that's open until we get down here and we can take partials. Okay. I just want to have a second to go back over to the dollar index. Just give me a second, please. Area here, I mentioned that small little portion of price went right up into it there. So now this is important because we have technically fulfilled the repricing of this down close candle. So this SIBI, which is a fair value gap, sell side imbalance, 930, or if it's going to, I would let, does it mean what? Should offer what? Did it move 5 handles? You want to screenshot this. You want to see where is it likely to go to from response and price. The bias is what? On S&P, lower. Where is it likely to go to from this volume imbalance? To this low and underneath it. Why? Because everything I've outlined here. Did it move 5 handles? From 41.18 to 41.13. Is that not 5 handles? You want to screenshot this. You want to save this. And in all these open areas in your chart, if you're screenshotting mine, you want to fill this up with things that you have observed, what you've heard me say today. Because chances are I'm probably not going to remember everything I've said and add it to the annotations I'm using. Because I'll save these charts and log them on my trading view.
Wait, was this this is Tuesday, right? Yeah, it's February 7th. Alright, I'm low-key gonna, take that later. And I'm gonna head out of here, but I'm going to do a little mental log before I do that. Dang, 11 hours and 50 minutes. I honestly would go live a little bit longer, but YouTube, you can't. They won't get uploaded to my channel if they're over 12 hours. I feel like I would be able to go live for like maybe 15, 16 hours today, but I'm just gonna chill here. I might go live a little bit later. I might record some videos, but we'll see. I might do a little bit more backtesting off stream. I don't know. I would just mind your own business, bro. Like, it really doesn't matter what anyone else trades. Like, just focus on yourself. That's all that matters. Like, there's so much stigma around, like, oh, is ICT real? Is he a fraud? If you don't listen to him, then just stay in your lane. If you listen to him, I'll stay in my lane and I'll chill. All right, let me do this mental log. What should I do it on? I'm just gonna start recording. I guess we'll see. Welcome back. This is another mental log. I'm doing this after my backtesting stream, and I've been backtesting for quite some time because I really want to get there, and I want to continuously put in the work, put in the effort, and I also want to be able to inspire some people to put in more work and effort than they have been. And if I can make an impact to someone's life, if I can motivate someone to work a little bit harder, if I can motivate someone to maybe start their own channel, if I can motivate someone, then that's what this is all really about. I mean, we're not here to judge, we're not here to compare, we're not here to say, oh, I'm better than you. We're just here to grow, to grind, and to develop ourselves as individuals, and that's all I want to do. I just want to make a positive impact. I don't want to have negativity here at all. I just want to say, hey, bro, are you working towards your goals? Are you? Yes? Cool. I am too. And maybe I could be an example for you, or maybe a motivation for you to keep on going. And that's what I kind of want to do. That's what I kind of want to do. And that's why I've been backtesting. That's why I will to backtest. And that's why I will continue to have these kind of longer streams, because I want to be able to inspire others and to also get better along my journey and to show a real journey in progress. Because a lot of these traders, they come on after the fact when they've made it, but rarely do you see streamers that have had their whole process documented, which is kind of what I want this to be. And yeah, that's all I really have for this mental log. It was a good stream today. If you don't pull up the streams, that's cool. I made a Twitter. I'll drop a link into that. I'm gonna be posting my chart annotations if you want to keep up with that. But yeah, anyways, hopefully y'all have a good rest of your day, and I'll enjoy mine. Those are I don't know, are those corny? I guess we'll see. I guess we'll see in like 10 years. When 10 years I look back on them. I do sleep. Can I share some contents? I'm good. Appreciate though. Alright, I'm going to upload a video. Videos. I think this is day 6. Are you funded? I'm not. Cause I haven't really honestly tried for it. I've had like one little funded account because I was gifted a funded account from a prop firm. But then I didn't go with it. I kind of want to go live longer. Not really. And I don't have like a defined model, which is why I haven't really gone live yet. Because I don't think that it does me any benefit to be live if I'm taking different trades every single day. Yeah, 2023 is. I'll probably be studying that till the end of time. Honestly, it has such good content, and I'm currently going back over it. All right. Dang, I don't really want to end stream. I still got some more to give. We'll see. I might go live later